Good morning. Thank you for being here, both to the people in the room and to our online audience. My name is Gonzalo Paz Pardo, and I'm the secretary for the ChaMP network. And I'm very happy to welcome you for our second day of the inaugural conference of the ChaMP Research Network. Ahead of us, we have a very exciting day with several sessions focusing on our core topic of monetary policy transmission, in particular related with climate risks, with the growing presence of non-bank financial intermediaries, and finally with business cycles and long-run effects. At 11, we will also have our policy panel focusing on current issues for monetary policy transmission in Europe. Without further ado, let me give the floor to Galo Nuño, who will chair the first session focusing on climate risk, bank lending, and monetary policy.
Thank you very much. So welcome to all of you. We are very happy to start the second day. And let me give the floor to Marco.
Okay, I'm very pleased to present here this paper, which is joint work with Carlo Altavilla and Miguel Busigna from the ECB, who are sitting here in the audience, and Andrea Polo from Luis University and Inaugural Institute. And the topic, as you can see, relates climate risk to bank lending and monetary policy. Actually relates bank lending and monetary policy to climate risk. So essentially, the paper looks at two related questions. The first is whether banks price climate risk or not. And more specifically, whether insofar as they do, they consider just current emissions of firms to measure this climate risk, or they also consider future intended emissions. So they are also forward-looking. And whether banks that declare explicitly to be more committed to decarbonization actually price climate risk relatively more than other banks. The second question is whether, assuming that actually banks do price climate risk, whether this price that they implicitly assign to climate risk in their lending activity is affected by monetary policy shocks. And here we propose two alternative views that potentially can explain the impact that monetary policy shocks can have on the pricing of climate risk by banks. One being the so-called financial friction channel, by which essentially monetary policy acts as in the Bernanke-Gertler tradition, tightening lending conditions, particularly for firms that have relatively low collateral, low tangible assets, low collateral. And since it is well known that green firms tend to be relatively less capital intensive or tangible capital intensive, at least, this suggests that a monetary restriction should affect relatively more, should be particularly harmful, so to speak, to lending to green firms relative to brown firms. An alternative view is an expanded version of the so-called risk-taking channel of monetary policy, which actually says that, predicts that a restrictive monetary policy shock should affect particularly lending to risky firms. And insofar as climate risk is one dimension of this risk, this should actually lead to the opposite prediction, that is, a restrictive monetary policy shock should be particularly harmful, particularly severe for brown firms, which are riskier from the climate risk viewpoint than for green firms. So as you can see, the predictions are diametrically opposed, and we want to see whether the data have anything to say regarding which of these two views, if any, is consistent with the data. So in terms of the previous knowledge on these two issues, the reason why it is worth actually looking first into the preliminary issue of whether banks price climate risk or not, and to what extent they do, the primary reason for doing this is that there is considerable controversy regarding the fact that climate risk is priced in credit markets. And this is in contrast with what actually we know about securities markets, because for securities markets there is abundant evidence that both in the stock market, in the bond market, and also in option markets, climate risk is indeed priced to some extent, especially after the 2015 Paris Agreement. Now, I have no time to review all of this literature, but it is relatively, consistent in this direction. Whereas, in contrast, regarding credit markets, the evidence is, first of all, limited to the syndicated loan market, which in Europe is about 10% of the total number of loans. But also, more importantly, it is not homogeneous in its conclusion. Actually, there is a considerable conflict between the findings, both regarding the first question, which is essentially whether banks do price or do not price climate risk. For instance, there is this paper by Beyen, De Graaf, Delis, and Ongena that find that banks do not price climate risk, or did not price the climate risk arising from stranded assets in the fossil fuel industry. And instead, there is a paper by Ehlers, Packer, and De Graaf that finds the opposite, at least for the period after the 2015 Paris Agreement. But also on the question of whether banks committed or that declared to be committed to environmental policies lend preferentially to low emission firms, so to green firms relative to brown, also there is no consensus. For instance, there are these two papers by Ehler, Packer, and De Graaf, and the recent paper by Giannetti, Jasova, Lumiotti, and Mendicino, who actually find that banks do not actually do what they preach, in the sense that the banks that actually appear to be more committed to decarbonization actually do not lend at differential rates or do not lend preferentially to green firms relative to brown firms. Actually, the paper by Giannetti and others finds the opposite. Whereas these other two papers by De Graaf and co-authors, Hans is actually here in the audience, and by Kaspersik and Pedro, find in fact that evidence in favor of the fact that banks that proclaim to be green actually behave consistently with that. So also on this score, there is some disagreement. And finally, on the other big issue that we target in this paper, which is the impact of monetary policy on the pricing of climate risk, insofar as we know, there is no previous work. So there, whereas on the other topic, there is conflict in the evidence, on this second issue, there is no previous work that we know, at least. Now, let me go a little bit, since this second point, the impact of monetary policy on climate risk is, this is the more novel part of the paper, and it's also more in line with the topic of the conference. Let me go a little bit deeper into these two alternative hypotheses that I briefly outlined. First one is, let's start from the second one that I mentioned before, which is the risk-taking channel of monetary policy. What has this view to say to us regarding predictions about the impact of monetary policy on the pricing of climate risk? The idea which is behind this view is that monetary policy affects the yield-seeking incentives of banks. Specifically, monetary expansion actually encourages banks to loosen their lending standards, whereas monetary tightening encourages banks to tighten their lending standards. And specifically, monetary expansion encourages banks to loosen them specifically in the direction of lending to riskier firms, and monetary tightening in the direction of tightening relatively more for riskier firms. And the reasons behind this view have been, the theoretical underpinning have been laid out in several papers, one of which is, for instance, the paper by Chara and Naqvi. The idea essentially in these papers is that there are some incentive issues in bank lending within the structure of banks. There are some moral hazard problems. And these moral hazard problems tend to be relatively encouraged or made made worse, essentially, worsened by expansionary monetary policy. For instance, in Achar and Naqvi, the idea is that to elicit loans officers' effort, their pay is tied to loan volume, and when there is abundant liquidity, they have an encouragement, therefore, to expand lending, especially to riskier firms. And De La Richa and co-authors have another paper, which is, has a similar broad logic. It's based on the cost of monitoring of banks interacting with monetary policy. And importantly, there is considerable evidence that actually there is support for this risk-taking channel of monetary policy. For instance, a paper by De La Richa, Levin, and Suarez finds that US banks lower their internal risk rating of new loans when monetary policy becomes relatively more restrictive. When short-term interests rise, they become stricter in their lending standards. And there is, conversely, a famous paper, econometrica paper by Jimenez, Onguena, Pedro, and Saurina, who find that when ECB monetary policy becomes relatively more lenient, and therefore overnight rates drop, less capitalized banks in Spain tend to loosen their lending standards. And there is also a paper by Anderson and Cesabianchi that find that a monetary tightening triggers a relatively larger rise in credit spreads for riskier firms, by which they identify as the more leveraged firms. So the overall prediction here is that the monetary policy tightening is relatively more restrictive, so to speak, or generates a greater contraction in lending, a larger increase in interest rates for brown firms than green ones. And conversely, if we turn to the other view, which is the view that is based on Bernanke, Gertler, many other people's work, that says that monetary policy affects firms because of financial frictions. Here, the view is that in the presence of incentive problems within firms, banks tend to provide relatively less credit to firms with a lower ratio of tangible assets to total assets, so firms that can post less collateral, and vice versa for restrictive monetary policy. And since we know, for instance, from the work by Jovino, Martin, and Sauvagnat, that green firms tend to be relatively less tangible capital intensive, we can expect them to suffer relatively more when there is a restrictive monetary policy shock. So here the prediction is completely the opposite. It is that monetary policy tightening is relatively more restrictive for green firms than for brown ones. Okay, so this is in terms of so to speak, the hypotheses that guide our work. Regarding the data, we draw monthly loan level data from the AnaCredit database that many of you, of course, know. It is this Euro area standardized credit register that provides beautiful data regarding lending and interest rates to Euro area firms. And on top of these data, we have emission data. Unfortunately here, at least in the main regressions in the paper, we have to concentrate on listed firms, because for these we have from the Refinitiv database both the current level of emission, CO2 and CO2 equivalent emissions. We are using the Scope 1 and Scope 2 emission data to measure the current amount of pollution that is produced by firms. And in this database, we also have a variable that measures firms' commitment to future emission, or better, the extent to which they target, or they announce that they target a reduction in future emissions. And here we use a dummy variable, which is 1 if firms announce a target and 0 if they don't. And this commitment is actually has been shown by previous work by Carbone and others, and Bolton and Kaspersky, to be not a cheap talk, in the sense that it has some predictive value for subsequent emission by firms. Now, in some regressions that we do not report yet in the paper, we expand our data set to also include unlisted firms for which we do not have direct observation of their emission data, but we have an imputed value of emissions drawn from the Urgentem database. So these are this is a firm that imputes based on sector size, sector and size of firms, a certain level of emissions to firms that are unlisted, based on what happens to the listed ones, the amount of emissions that is produced by the listed ones. So we find broadly consistent results. But of course, there we cannot control for industry and size, simply because those are being used to effectively impute emission data. Now, we also have in our data set data about bank commitment to reduce emissions, information about specifically whether they signed a commitment letter in the context of the Science-Based Target Initiative. So we have a 0-1 dummy for that, which is the same variable that is used by Kaspersky and Pedro in their 2021 paper to measure this commitment by banks or declared commitment by banks to reduce emissions. And finally, the monetary policy shock is drawn from the database, the Euro Area Monetary Policy Event Study database, which has been built by Carlo and co-authors that measures monetary policy shock, looking at the change over a 30-minute window around ECB press conferences expressed on a monthly basis, similar to a variable which has also been used for the Fed in other studies to measure monetary policy shocks. So this is in terms of the main data that we use. Regarding the actual data, here you can see the first variable that we have in this table is the spread, which is essentially the interest rate that banks charge on loans relative to a benchmark risk-free rate of corresponding maturity. And as you can see, the standard deviation of this variable is 0.76. This is important to bear in mind in order to understand the quantitative magnitude of the effects that we're going to find. We have a 75 basis point standard deviation for the main variable of interest. Then we have data regarding the PD that we use as a measure of credit risk. This is the average PD, which is reported by IRB banks lending to a given firms. And you can see that this is pretty flat for most of the deciles of the distribution. It is only greater than the mean for the top decile of firms. So the risky, the firms that you can really call risky ones are those with, which are in the top decile, at least in terms of credit risk. Then we measure emission risk by looking at the current emissions, the carbon intensity of these firms. And again, this is very much right skewed, like the PD, only for the top decile. You can see that the carbon emission intensity is larger than the mean. But we also take this forward-looking variable to measure emission intensity, this target variable, which is whether a company has announced or not announced an emission target. And you can see that 58% of the companies have indeed done so, and most of these are actually high emission, relatively high emission firms in our data. And then we have a variable that we call commit, which is a commitment that tells you whether a bank has actually underwritten this commitment letter, and only 11% of the banks appear to have pledged that they're committed to decarbonization. And finally, the monetary policy shock, you can see that the mean is positive because our data, I forgot to tell you that, refer to the period from 2018 to 2022. And so most of the monetary policy shock have been restrictive monetary policy shocks, so shocks in which our monetary policy variable actually takes a positive value. Okay, now in terms of results, let me start by showing you like just unconditional means over time for two outcome variables of interest, which both refer to loan premia. The graph on the left shows the loan premium, the interest rate which is charged over and above the risk-free rates to firms with low carbon emissions. And here by low, I mean those in the bottom quartile by emissions. So that's the green line. And firms with high carbon emissions, those in the top quartile by emission intensity. You can see that the red line lies consistently above the other. The difference is on average 12 basis points. On the other side, on the right-hand side, you have a different breakdown between firms which have announced that an emission reduction target, that's a green line, and firms which have not announced an emission reduction target. And here you can see again that the red line lies above. Essentially, this is telling you that firms which have announced that they want to improve on the front of emissions do actually get a discount relative to those that have not. So this is like preliminary evidence that banks in the euro area do price climate risk, but of course here we're not controlling for a zillion things in terms of firm characteristics, bank characteristics, time, and so on and so forth. So let's go then to estimates of panel regressions where the dependent variable is the interest rate premium. And as you can see, the main variables that we put on the right-hand side as regressors are PD as a measure of, as a measure of credit risk, carbon emission intensity as a measure of climate risk, and target, which is essentially the intended reduction in emissions in the future. As you can see, consistently in all the specifications, we have gradually saturate the specification with fixed effects. We find that first, the PD is associated with, as you would expect, with a higher risk premia, interest rate premia. Carbon emissions are associated with higher interest rates, and target the announcement of a target in terms of emission with a discount. The impacts based on the estimates, for instance, in column 1, are not very large. I mean, there is a 4 basis point premium for firms with high emissions, by which I mean those in the top decile by emissions. There is a 10% basis point discount for firms that are committed to reduce emissions. And there is a 3 basis points premium on firms with high PD. So it is not, in a way, the pricing of climate risk is not very large, but it is of the same order of magnitude as that of credit risk as measured by the PD. Then we look at whether banks which declare to be committed to decarbonization actually are stricter in pricing climate risk and are more lenient with firms that actually declare that they want to decarbonize. As a matter of fact, you find precisely that. If you look at the interaction between this commitment variable and the carbon emission variable, you find that it's positive, meaning that they are indeed stricter, not very much, by 2 basis points in terms of additional price based on climate risk on average. And if you look at the bottom row, you see that banks that are committed actually are relatively more lenient, and here the effect is considerably large, it's 16 basis point discount, less than uncommitted banks in lending to firms that actually declare that they want to reduce emissions. Finally, let me come to monetary policy. And here, the first, essentially, the first column is just a sanity check type of regression. We want to see whether a contraction in monetary policy shock, first of all, is associated with an increase in risk premia. So in interest rate you would expect, and in fact it is a 25 basis point increase, surprise increase in policy rates is associated with a 35 basis points increase in premia. That the impact is particularly large for risky firms. You can see that from the interaction between the monetary policy shock and the PD, and this kind of is very important because it already preliminary evidence that the credit risk view of monetary policy is consistent with the data, and of course it is associated with a larger, in general, the PD is associated with the higher interest rates. That's the first coefficient, as you would expect. Then what we do is we introduce fixed time effects in the regression. So we can no longer, in the subsequent specification, we can no longer estimate the direct impact of monetary policy on interest rates, but we look more specifically at the interactions, and we ask, is monetary policy indeed increasing the price that banks place on climate risk? And indeed, we find that the impact is positive. As you can see by the interaction between monetary policy and carbon emission, the coefficient is positive and borderline significant. It's significant at the 10% level. And in particular, that monetary policy shocks seem to the restrictive monetary policy shocks seem to have a relatively smaller effect on firms that announce a target in terms of emissions. So we find that, broadly speaking, the evidence is supportive of the credit risk channel of monetary policy view among those two. However, we have to recognize that monetary policy tends to act with long and variable lags, as we all know. And so here we have been looking just at the impact effects on interest rates, on premia more specifically. What if we look at both the longer run impact on interest rates and the impact on the quantities lent by banks to these firms? So we do this by using local projection estimates to capture these dynamic effects. And again, we do this both for, in this case, both for interest rates, interest rate premia, and for quantities. And here are the results that we find for interest rates. So again, first, the first graph refers to the direct impact of the monetary policy shock on the lending spreads, which is reassuringly positive, although not very large. It is, it's a 25 basis points surprise tightening leads to a 39 basis points rise in premia after 12 months. But the impact effect is not very large. It does increase over time. Interestingly, we keep finding that there is an additional increase in premia for high emitters of 2 basis points, again consistently with the results I told you before from the panel estimates, and there is a 5% mitigation effect for committed firms, which becomes actually 9 basis points after 12 months. But more interestingly, if you look at the dynamic effects for loan volumes, these are considerably larger. A 25 basis point surprise tightening is associated with a gradual drop in lending of 2.5% after 12 months. It is negligible upon impact, but becomes considerable after a year. And there is a doubling of the effect for high emitters. So for high emitters, actually, there is a further 2.7% drop after 12 months. And there is a 1.5 mitigation effect for the firms that announced to have a reduction target. Now, let me conclude with evidence which is really not drawn from our estimates, but is drawn from a survey that the ECB carries out, the bank lending survey. In July 2023, the ECB added to the usual survey a question regarding precisely environmental risk, and it asked the respondents, the banks, whether they changed their lending policies in a different way for green firms, what they call firms in transition, so that have announced that they are making investments in order to become greener, and brown firms. And as you can see, both in terms of terms and conditions, so broadly interest rates, and in terms of credit standards, so broadly lending quantities or attitude towards credit applicants, you can see that banks announced to be reported to have tightened lending standards relatively more for brown firms than for green firms, and to have been more lenient for firms in transition than for brown firms. This is particularly important because this survey comes right after a period, a series of contractionary monetary policy shocks. So it can be read as a kind of the reported response by these banks to these shocks, among other things. And then, interestingly, the right-hand side graph provides a further breakdown of these responses between committed and uncommitted firms. So for each of these classes, green firms, firm in transition, and brown firms, it asks banks how they have behaved vis-à-vis committed and uncommitted firms in terms of announcement of a target. And you can see that the policies of banks has been relatively more favorable to green firms and firms in transition for the committed than for the uncommitted. So just to conclude, essentially the bottom line from the paper is that euro area banks appear to price climate risk in the sense that they are stricter with the high emission firms and relatively more lenient with those that announce to want to reduce emissions, that their commitment, banks' commitment matters, and that they differ in the pricing of climate risk consistently with what they appear to announce, and that monetary policy shock actually fits with this credit risk view, or expanded credit risk view of monetary policy transmission, with the contractionary monetary policy leading to higher premia and lower loan volumes for brown firms and relatively less so for green ones. So just a final warning that we should not read our paper as saying that restrictive monetary policy is climate friendly per se. Just that it really helps investment by green firms or lending to green firms, but it simply says that it affects relatively less green firms than brown firms. So its contraction effect is there for all firms, but is relatively milder for firms with low emissions and those that are committed to reduce them. Sorry for being slightly over time. Thank you.
Thank you very much. So the discussion will be by Vincent, please.
Sorry for being a little bit over time.
I just want to thank the organizers for the opportunity to discuss this paper. So I will offer a very short recap of what Marco already has described, so the research questions and the key answers that come from this analysis, and then offer some comments. So the key question, the first actually, you could think of the paper as divided into two parts. The first part is asking the question, do banks price climate risk, and why would they do that? One reason is pricing the default risk that comes with being brown or issues that relate to transition. And other has to do with reputation risks that may be increasing. So the answer to this question that the paper is giving is that yes, banks do price it, and they don't only price the current emissions, they also price future potential exposure. So it's a very positive message. They also find, the authors, that banks that publicly commit to follow environmentally responsible lending policies, they do so more than other banks. Okay? So this is, for the first part, the key results. And on the second part is actually, so for the first part of the analysis, as Marco has said, there is a lot of analysis looking at them, and I will come back to that on sort of mixed results in the literature. But the second part on the effect of monetary policy, the results, this is more new, and the question is, does current monetary policy view on the current tightening, does it hurt green firms? Here, I mean, yes, the premiums are lower, but one thing I could see from the analysis is that it squeezes the differential between, so higher interest rates effectively lead to smaller differentials between green and brown, as I read it. And so this is kind of the takeaway in a sense. Now my comments. So just a brief overview of comments. The first, the question is really important to understand: do banks price it? What are the implications of changes in monetary policy, which may be targeting inflation? What may be side effects on when it comes to the environment? The analysis is very competently executed. I have no quibbles with the analysis. The paper is very, very well written, very clear, it's to the point. So I do encourage all of you to read it. It's a pleasure to actually read and go through that. And an important aspect, which may be even more important in this context, given the role of ChaMP, is that it provides evidence for the entire Euro credit area using AnaCredit. And so it's an important departure from, if you want, some of the existing literature. Now, some of my comments, I'm going to have 4 suggestions. They're going to be sort of on a broader level, thinking on okay, this is what the evidence is and the current state of the paper. If you were to think to sort of to change something or enrich something, make some suggestions where there could be potential places to enrich the takeaway from the paper. So as already Marco pointed out, there is an existing literature looking on the first part of the question as to whether banks are pricing risk, and whether banks that have made a commitment to climate risk are pricing it more so. And overall, the results are quite mixed. Okay, and me as an occasional reader of this literature, I would love to know more, and I suppose also the policymakers, to know more why are we getting mixed results typically. And I believe that the paper, using data from a big data set that covers a broader spectrum of firms and across many different countries, may be uniquely positioned to offer the reader some idea why it might be the case that from different analysis we are getting sort of mixed results. And there, one suggestion I will make is potentially try to estimate the various betas and create sort of a heat map. If you look at the composition of firms and a spectrum of bigger firms, smaller firms, or banks in settings where regulators have taken a stronger stance, do you see the systematic relationship? Where do you get the stronger results and where are they weaker? And that will be useful for us, maybe if we map it to studies who have found yes or no in one of these questions, to kind of understand potentially where the mixed results are coming from. Most of the existing literature is using syndicated loan data, which draw on larger firms. Here you have more, and potentially you could exploit that further. So Another point I would like to bring up, and this is not specific to this paper, my reading is in the entire literature, this is something that affects the interpretation, is when we are looking at has a firm adopted a target or has a bank committed to an environmentally responsible lending policy, both of those are choices. Either it's a choice of the firm or it's a choice of the bank. And so there are, as I read the literature, my impression is a key weakness across the literature, it's not specific to this paper, is that that's an endogenous choice, and and that affects the interpretation. It may be, one may be picking up the selection aspect. And I think it will be useful potentially here to make some progress on that in trying to get a sort of an instrument to the choice of for making that choice. Often in the literature, people use external pressure to construct an instrument. And again, the nature of the data set may be better suited given the heterogeneity across countries and different stuff that I may have taken. So that may be a dimension one can push the literature further and push the paper further. On the mechanism. So, one of the main equations the paper estimates, this is the baseline model if you want to. There is one looks at the interest rate the bank charges to firm F, and this is regress on the probability of default of the firm, what are the carbon emissions of the firm, and what is the target if the firm has made a target, and then the carbon interacted with the target. Let's take that. How should I think of, so my question here is in a setting where we have both the probability of default and the carbon, how should I be thinking of the beta 2? So what does it exactly capture? So on one hand, you may be expecting bank to price the emissions, and one reason they will do that is because it's riskier. It involves risk, future risk, credit risk. But if already we have the PD there, how do I interpret the beta? What are they pricing exactly? Are they pricing the fact that the PD doesn't reflect the carbon? You are discussing a little bit that, and I will encourage more discussion on what is it on top. Is it capturing the reputation concerns? And so both, I suspect both, but it will be useful to first discuss this a little bit more, so how I should think about that. And second, maybe also do some analysis a little bit, how much is in the PD already the carbon reflected and so on. And sort of to unpack further the mechanism, one could go further to estimate specifications separately by type of loan, by the type of collateral that is used, and that may give us some more information as to what exactly is the bank worrying about and pricing. So one could imagine that in a short-term loan, the climate risk associated may be smaller, depending on the type of collateral that is pledged. So these could be dimensions that one could use, given the available data, to kind of unpack more the mechanism. And basically, my understanding is that the data in AnaCredit could potentially give you some more information on not only to the loan to a firm. So you could imagine a firm has some brown loans and some green loans, and maybe you can have even more loan-specific or even collateral-specific information about exposures to exploit there. So on the monetary policy, my understanding is that it's the current monetary policy may be effectively, ultimately slowing down the pace for decarbonization. And here, I was wondering if there is an element, again, exploiting the nature of the data to try to understand the settings under which this is less. So to look at the heterogeneity again, and what I'm thinking in this context is more, okay, in settings where banks are facing, beyond monetary policy, other reasons, whether this is broader regulation, whether consumers are more sensitive to these issues, whether they face climate stress tests, and so on, to try to use this to see if on the margin, when beyond monetary policy, you have stronger, if you want, fiscal policy or other broader financial policies making climate risk more relevant to them, to see if that squeezing is lower. That's my comments are more on sort of thinking, okay, here we have the analysis, in which dimensions can we expand and where could it be useful? Thank you very much.
Thank you very much. So if you want, I think it's better if you want to collect some questions, or you want just to...
Maybe I just quickly respond on one point. Yeah. Okay, first of all, thank you very much. I mean, these are very constructive, very useful comments. There are 2 points on which I would like to reply. One regarding endogeneity, the fact that adopting a target is a firm choice. That's a good point. Insofar as you say that this could induce selection issues, we try for the moment to address this as much as possible by inclusion of fixed effects to control for all possible characteristics. Like we have the most demanding specification is one in which we have firm effects and time effects. So we essentially exploit only time series variation within time series variation for firms, but that's a well-taken point. It would be hard to think of a good instrument, though. I'm afraid. On the issue, you touched on the issue that we are controlling for PD. So what the heck is the reason why these banks over and above the PD, they are pricing climate risk? The PD should be capturing default risk already. Banks, in principle, you could say, should only care about default risk, not about a climate risk per se. Well, one reason why this can be the case, as you hinted at, is that the internal risk models on which that PD is based may not be suited to capture yet, at least, climate risk. And indeed, when we do a simple correlation between the PD and emission intensity, we find zero correlation, not significant, very small. So essentially, it looks as if this emission intensity variable is capturing a dimension which is currently not yet included in the PD. And why it is not? Well, first, because measuring climate risk may be very difficult with the current way these risk models are built. It could be, as you mentioned, on a different horizon, a longer horizon than that which is taken into account by these models. It could be also that to some extent, these banks also have securities which are exposed to climate risk, and therefore they take into account the covariance which is induced by the presence of climate risk in their loan base, and that's why they want additionally to price it in their loans. I mean, we still don't know, but clearly the evidence is telling us that the PD is not fully capturing climate risk, so I will stop here.
Thank you. So we are going to collect some questions. I beg you to stand up and identify yourself before making your question. The first question was already pre-booked by Paolo. There, please.
Thank you very much. Paolo Surico, London Business School. Was very... Oh, I need to stand up, I'm told.
Thank you.
Do I have to bow? No. So, interesting. I love it. I wanted to ask whether there is an even bigger price down the road, either for this paper or another paper. You look at prices, I think the next step would be to look at quantity. What I have in mind is loan, investment, but also dividend. And the reason why I'm mentioning this is because maybe here I'm biased from my own research. But I have a strong sense that the ones that are high emission firm are also the ones that are most capital intensive. Yeah. We also know from some research, including my own, that when there is a change in monetary policy, capital intensive firms tend to respond more through investment, whereas non-capital intensive firms tend to respond more through dividends. Does your result imply, or could you look into whether climate risk amplify the effect of monetary policy? Because if the effect is stronger on capital intensive firms, and those are the ones that respond more with their investment, this implies, especially through a collateral channel, that they are responding much more through investment than non-capital intensive firms are doing through dividend. And I think this is something that could be very useful for monetary policy, especially because you can quantify relative to a benchmark in which there is no distinguish between green and brown firms, so you can see, okay, climate risk contribute to X% of the amplification of monetary policy. The second point I wanted to raise, I wanted to, if you don't mind, for the purpose of the discussion, to quibble a little bit with the interpretation on the collateral channel. My intuition, and the model maybe would be needed to confirm or prove me wrong, is that the collateral channel will suggest that brown firms will be more affected. And the reason is simply because those firms that are less capital intensive is not that they don't access credit. We know that a big chunk of those firms, they access credit from an income-based constraint rather than a collateral-based constraint. And we also know that following a monetary policy change, asset prices move much more than income. So in fact, I would suspect that when, exactly for the Bernanke, Gertler, Kiyotaki, Moore type of mechanism, I would expect a collateral channel to affect much more brown firms than green firms. And in fact, I think it would be still consistent with your result. So I wonder, I mean, the estimates are great. I'm just challenging the interpretation, whether still might be fully consistent with a collateral channel story.
Thank you. So, Philip?
Thank you, Philip Hartmann, ECB. So, fantastic paper, very impressive. Thank you for contributing it to ChaMP, because we have also ECB involved. I have 3 points. So first of all, since I see Frank Elderson from the ECB board sitting there, the vice chair of the ECB banking supervision, there's also messages obviously here for banking supervision. So of course we are here interested in monetary policy, but I think there was big time also messages for the risk monitoring and supervision of the banking risks. But then if the question is always in these studies, in this literature, there's a lot of focus of is that risk priced? The question is then the big elephant in the room, is it large enough? Is it large enough relative to the quote-unquote objective risks? Is it large enough for the Paris objectives and things like that? So I would be interested to which extent you have something to say about it. Obviously that is a challenge. And my last point is on this this squeezing of the difference, of the spread between the green and brown discrimination that one saw so beautifully in your first plot. I think the discussant also did, Vasu did also comment on it towards the end. So the question is, how does it come that the green and the brown rates, so to speak, become more similar in a period of very fast monetary tightening? And I was wondering whether, apart from the traditional banking variables, there's also something we can learn from the inflation discussion we had and the pricing discussion we had in the high inflation period. So if you have there could be different stories of a behavioral type of uncertainty or something that allows banks to exploit a previously more precise tightening to their benefit and pricing less accurately for business reasons, for profitability reasons or something. So I wonder whether something could be looked at in the context of the paper. But thank you, very impressive.
There was also a question here, please. Yeah.
Okay. So I want to go back to this issue of the mixed results. So of course, there is now a famous Journal of Finance paper that there are non-standard errors that even in very conventional setting lead to different results. But I think that here also economic mechanisms are important, and I want to offer two that should be stressed. One is an issue of sample related to borrower visibility. Of course, banks that make some claims, they can greenwash only in the least visible part of their portfolio. So sometimes when we measure emissions, we don't have information about that. The other mechanism is what channel we are trying to pin down. That is value or values. And here I'm paraphrasing Laura Stark's presidential address, meaning that if we look at credit risk, it's something that affects financial intermediaries' payoff. And I think that at this point, we all agree that investors care about money. But when we talk about values, then I think that there is more room for mixed preferences and for greenwashing. So,
Thank you very much. So we collect the last question. Paloma?
So, good morning, Paloma López García from the ECB. This is a question about complementarity of different types of policies. So my question is, the carbon intensity of a firm is really also a sign of exposure to transition policies. No? It's going to be more affected by the risk of stranded capital, etc. So my question is, maybe it would be worthwhile exploiting the cross-country dimension of the data set to see whether this effect is stronger for countries in which transition policies, environmental regulation, carbon taxes, etc., are stronger. Because this is also going to give us a tip, if you want, some suggestion about where are we going to go looking forward, no? Because transition policies are going to become more stringent. Thanks.
So we can't have a premium question at the end, but please be very brief.
Okay, Laurent Morin, European Investment Bank. Thanks for the nice paper. I have one question which is related to the bank attitude. You said that some banks were committed to green target. Do you see a change in their client base? So like a brown company going to brown banks and green banks attracting green clients?
So if you can...
Okay. Not easy. Okay, let me try to answer at least some of these questions. One by Paolo. I agree. An implication of our estimates is that insofar as brown firms are relatively more capital intensive, so presumably also those that when they invest more in physical assets, then the implication of our estimates is that this mechanism that we document would make restrictive monetary policy relatively more harmful, or for its effect on investment, on physical investment. But interestingly, it would not have the same effect on the mix of investment. So it would be effectively compressing investment relatively more than otherwise, but the mix of investment would be more skewed towards green investment than brown. So there is something in a way positive in that dimension on the quality of investment. Regarding what Philip said, he's right. Those initial pictures, seem to point to a squeezing of the differential. This was also one of Vasso's points. Why is that the case? Because if you think the estimates are really telling us that when monetary policy becomes more restricted, conditions should become relatively harsher for brown than green, so the two should actually diverge. But actually, if you take into account that many of these brown firms have announced an emission target, that effect goes in the opposite direction, and that effect is pretty strong. And in my view, that can explain why in these descriptive statistics we have actually a compression of the differential, because many of those firms in the red line, which that have actually that have high emissions, have actually announced that they have an emission target, and therefore those actually enjoy a more favorable treatment in response to the restrictive monetary policy. Okay, this final point regarding exploiting cross-country differences in other dimensions of policy, I think it's extremely interesting, and we should think about how, whether we can take that into account. And finally, on the very last question, we will investigate on that, whether actually there is an impact on the customer base as a result of these policies. Oh, just one thing regarding what Paolo said, we are already looking at quantities. We are looking at lending amounts. We are not yet, at least, looking at quantities in the sense of firm-level investments and stuff like that. But in principle, by linking up our data with data regarding the financial variables for these firms, say in Orbis, we could address this interesting point. Yeah, that's all I had.
So thank you very much. I think we should move to the second paper.
Yeah, sorry.
So Gautier, please. Yeah.
All right, so thank you very much for having the paper to be included in the program. I'm really happy to participate to the inaugural session of ChaMP. This is a joint work with Jean-Guillaume and Frank. Frank is in the audience. And we intend to update the new Keynesian model to include the climate externality in it. And so yesterday we had a speech from Isabelle Schnabel, which was really interesting about disinflation, but she also provided other interesting speeches, and one of them was about the future of monetary policy in a world with a warming planet or under green transition. And so in the future, we can imagine two extreme scenarios, one of them in which we will engage into no reduction of carbon emission, and so in that situation, the planet would warm a lot. And so by increasing sea level, by the increase in adverse weather events, by a lower yield return for crops from the aridification of region, that will yield to lower productivity, and that will yield higher prices. And so this is referred to as in the literature as climateflation. But on the other side, we can also be more optimistic and imagine that the economy, the fiscal policy could engage into increasing carbon tax. This will reduce carbon emission, and so there will be an increase in the price of fossil fuels. There will be also an increase for the demand for specific raw materials to green the economy, and in turn, this will yield to what is called greenflation. So there are two possible sources of inflation that could happen in the future related to the climate, either if we increase or reduce our carbon emission. And so how should the central bank react in those scenarios? So we're not going to evaluate whether the central bank should reduce carbon emission in a way, this is not the topic of the paper, but how it should manage the implication of those policies. And so to answer this question, we need to understand what will be the effects of climate change and the climate mitigation policies on the economy. And so obviously the new Keynesian model that we use in central bank has not been designed to answer those questions. And so in this paper, we propose to develop a new Keynesian climate model in which we will extend this model to include another equation in which we will have carbon accumulation to take into account the effect of global warming. And so we're going to pick this element from the integrated assessment literature that is extremely well known for evaluating climate-related issues. So if you have been, in the media, you have seen many predictions from IPCC. And so these predictions are based on the IM model in which they project long-term projection of output, of temperatures, carbon emission, and so on. And so we built on this literature to extend the new Keynesian model. where we want to also have, we want to data ground this model, so we're going to estimate it for the world economy because the externality is at the world level. And this way, we want to keep track of all the nonlinearity that we have from climate change because, I mean, climate change is a structural issue. The green transition is also a structural issue, so we want to keep track of those nonlinearity when we solve the problem. And once we have estimated this model, we can use it to make some out-of-sample forecasts. And so we're going to project what could happen in the future under a mitigation policy, so basically under the greenflation scenario, or under the laissez-faire scenario in which no carbon policy is implemented. And this way, this will allow us to gauge the effect of climate change and climate mitigation policies on inflation and hence on monetary policy. But you know, in macro, we have rich models, but in the end, when we want to go into numerical simulation, we always, or mostly, linearize our model. And I mean, with the climate issue, this is not something that is possible because climate change will permanently affect the propagation mechanism. If we engage into a carbon transition, this will permanently shift our economy to some new equilibrium, and so there is not the usual steady state approach that we can have to apply our perturbation method in that case. So we're going to use the fair and Taylor approach in order to keep track of those nonlinearities, and we're going to use an inversion filter to estimate the model in a nonlinear ways. So related, I mean, our paper is going to be related to 3 core literature. The first one I discussed earlier is the IM literature, so those long-term models that you may have seen in the media. But those models are extremely low, I mean, they take the low frequency component, but they do not take into account the short-term component that we have in the data, so they are not really informative about the short-term conduct of policies, in particular monetary policy. The second literature is the DEG with some environmental constraints, so this is the EDG literature, and this literature extend our usual business cycle model to include some environmental constraint, but they usually do not take into account the very long-term effect from the structural changes that we have in our economies. And the last strand of the literature is the usual New Keynesian literature with the macro textbook of Woodford, but also medium-scale estimated model from Smet and Wouters. But obviously, those models are without climate change. So for this presentation, I will first start with the New Keynesian model. And so I will start with the basic one, I mean the basic New Keynesian model, and step by step I will show you how we're going to change it in order to take into account the climate constraint. So the micro foundation are quite the same, so you have some household, those households are utility maximizing, you have firm which are profit maximizing, and in between you have a central bank that adjusts the interest rate to dampen nominal rigidities. So once again, we have our 3 core equations, so the IS, DPC, and the monetary policy curve. And so the first equation is the determination of quantities. So we have the detrended GDP that appears, and this is the Euler equation in which current decisions are based on the future marginal utility of consumption adjusted by the interest rates set by the central bank. And you know, we want to think in quantities, so we don't want to have consumption, so we introduce an additional auxiliary variable to translate any unit of consumption into output equivalent. The second equation is the Phillips curve, and here under Rothenberg pricing, so simply inflation is related to the current and all the discounted sum of future marginal costs that will happen in the future. And because we want to keep the model as tractable as possible, the marginal cost here is based with one input in the production function, that is labor. And the last equation is the interest rate equation, so the Taylor rule. And this Taylor rule is also adjusted by the change in the target of the central bank, that is P star. We also have the shocks, the usual shocks. The first one is the demand shock, I mean supply shock and monetary policy shock, so nothing really new here. And finally, we eventually can have trend in the New Keynesian model. So some people include some inflation target, for instance, and here we're going to impose a deterministic process on the inflation target to capture the long decline that we have in inflation in sample. There is also a technological trend that appears for the discounting, and so in our model here, we're going to have a vanishing productivity, so basically the rate of productivity is exogenous and is declining over time because of, to match the declining growth that we have in our economies. So this is the basic model. But since we want to work on carbon mitigation policies are always announced in advance. And so if we have a policy that is announced in advance, we end up in the same issue as the forward guidance puzzle, in the sense that any policy that is announced is going to materialize in present value into extreme large values. And so to deal with this, we're going to build on the literature by just introducing two attenuation channels, one on the discounted Euler equation and the other one on the Phillips curve equation. So to introduce those two discounting, we're going to have income risk for the household. And so the household, we have the probability to get unemployed. And if he gets unemployed, he will get some compensation from an insurance. And so this way, you can see that omega here is going to reduce how much forward-looking variables are going to affect the value of GDP now. The second discounting is simply on the PC curve. We simply assume that firm has some probability to exit the market. And this way, once again, this will attenuate how much they are looking forward in their pricing decision. And if they leave the market, they are going to consume their dividends. But we can also now discuss the climate problem. And so you can see at the bottom here that we have one more new equation. That is the climate change equation, the CC equation. And so M here is the stock of carbon that we have in the atmosphere. And so basically, if M is 0, it means that there is no carbon emission that was emitted by human activity. There is also emission here have to be tracked in level, because the climate issue is a cumulative problem in which we must keep track of the level of emission and the level of the carbon stock, because this is what is going to determine how much global warming we have, and so how much of damages we have in the economy. So basically, we cannot use our detrending fashion that we have in macro to get rid of trend. We must keep track of this level, and this is why we have to reverse the trending on emission. And so emission here are going to be determined by a deterministic decoupling trend. So if you look at data for world data on emission to GDP ratio, I mean the level of emission per unit of dollar produced is naturally declining through energy efficiency. But this decline is not enough to avoid climate change. We also have an exogenous deterministic trend for TFP that is taken from integrated assessment literature, in which TFP is increasing but declining over time. We have also a population dynamic that is also exogenous, that is meant to capture the long-term growth of population. And so population here is going to be at the end of 11 billion of people on the planet living at the end of the century, which is consistent with the United Nations forecast. And this is the extensive margin part of emission. And the last one is an emission shock, because we want to have some stochastic effect on this variable as well in order to capture and estimate the parameter on this equation as well. But because we have climate change is also going to affect the economy. And the way it works in integrated assessment model is assumed that climate change is going to damage the productivity of the production side of firms. And so basically, it will appear in the new Keynesian model as an increase in the marginal cost of producing goods. And so if the level of carbon emission increases, this is going to increase the marginal cost of production, and so hence it will increase inflation. But policymakers can implement a carbon tax, and so tau-T is going to be that carbon tax that will mimic the that will be making the economy to go greener. And so this carbon tax is going to shift some mitigation expenditure. So the fact that if you go to a green economy, you have to close coal plants and replace them with new facilities, and this is going to be costly and will call for additional investment expenditures. The fact that we have to go also to a green economy will force firms to decarbonize their production lines. So there is also a cost for the firm to decarbonize their production lines, but also there is a cost if they don't comply to the to reduce their carbon emission, they have to pay the tax as well. So there are two effects that will also increase the marginal cost of production during the transition. And finally, if we increase the carbon tax, this will reduce carbon emission and stabilize the climate. So this is the goal of the climate policy. This is to reduce carbon emission through abatement. So once we have the model that is given, we can estimate the D parameter of the model. So basically, we're going to use world data with data starting 1985 up to 2023. And we're going to have, we have 4 core equations, so we're going to have 4 observable variables to estimate the model. And the way we proceed is that to estimate the model, we're going to have 2 steps basically to estimate the model. So the first equation is the very long trend, the structural trend that we have between the initial condition that we provide up to the very long stationary equilibrium that we will reach in a very long period of time. And we want to have stochastic variables that are included. So we want to capture as well the business cycle component. So basically, in the second step, we're going to use the extended path to include stochastic variable. And so what we're going to do here, instead of re-updating the path from the realization of the shock up to the terminal period, that would be extremely computationally costly, we're going to reduce by opening a window, which is the extended path algorithm. And so S is the number of periods that we allow for fluctuation to live. And so as long as S is large enough, this is going to reduce the computational burden without having some implication for the accuracy of the estimation. The third equation is the measurement equation. So basically, we have a subset of variables, endogenous variables, which are observable. And the fourth one is the distribution of shocks. And when we estimate the model, so we find the sequence of shocks that replicate the data, we can build the likelihood function and use our usual routine to estimate the model. But there is one issue that we have to deal with, is the path of the carbon tax. The decision that we're going to take, the policymaker we're going to take in the future, are also affecting our estimation, because any decision that is taken out of sample is actually having implication on the expectation in sample. So the way we're going to manage it is simply to introduce the path of the Paris Agreement consistent carbon tax, and we're going to use a parameter that is verified here that will measure, that we are going to estimate how much of the people in our economy believe in the realization of the carbon tax. And this is a way for us to let the data be informative about how much will be in the future, from a market-based perspective, the fraction of people believing in the realization of the Paris Agreement scenario. So this is the calibrated parameter and the estimated parameter. And to illustrate you this separation between the deterministic component that we initially compute and then the stochastic component that we add, you can see the implication of this and the fact that the shocks are always making our economy to gravitate around the deterministic path. So now we can have a look at what's going on in the future with respect to the carbon tax. So we can use the model to make some auto-sample forecasts. And to do this, we're going to use our 2 extreme scenarios. The first one is the Paris Agreement scenario, in which the carbon tax is implemented, so VARFA becomes 1. And the other one, we are in a laissez-faire scenario, so Trump gets back to office and there is no engagement at all with respect to the implementation of the carbon tax, and so VARFA is equal to 0. And in between, you have the one that we estimated. So this is here the path for all the main variables of interest with different carbon tax scenarios. And so you can see on the A graph that we have a scenario in which the carbon tax could increase consistently with the Paris Agreement. So this is the green line. And you can see in the B panel that this will make carbon emission to decline consistently with the Paris Agreement with a target of 0 emission by 2050. But this tax is going to be recessionary. You can see it on the panel D. The fact that we increase a lot the carbon tax, this will force firms to decarbonize. This will divert a fraction of resources toward the decarbonization. And this will be costly in the short term for firms and so for the society. In that case, you can see in panel D that we will have more inflation. So it's at a world level. So the level of inflation in the world is much higher than the euro area. So don't be surprised that the numbers are bigger. And this will provide an additional inflation because of the carbon tax effect that are inflationary. And so in panel E, you can see that the central bank is going to increase interest rate in response to reduce inflation. But if we are in a laissez-faire economy, so there is no carbon tax that is implemented, this is probably the scenario that is the most likely. There is an increase in emission in panel D, and so you can see that output is naturally going to be below the trend, and this is a result of the damages that we have from climate change. And so in that case, I mean, monetary policy will be relatively more accommodative. So the question is now, how can we explain the mechanism? I mean, how can we explain the quantities and prices? So what we're going to do, because our model is simple, we can use this simplicity to extract each forces into separate blocks. And so we first start with the aggregate demand equation that we can split into 3 complementary forces. The first one is just the effect of the IS on the determination of quantities. So this is just the forward sum of interest rate, of real interest rates. The second one is the green investment, so how much investment is going to boom our economy because we engage into the transition. And the last one is a kind of residual from the nominal rigidities and the exit probability for firms. And so in panel A, you have the figure that I showed you before, and B, C, and D are these 3 forces. And so if you sum B plus C plus D, you end up with A. And every variable is expressed in deviation from the technological neutral trend, which means that it includes, I mean, the deviation includes the consequences of climate change, but also the consequences of stochastic variable and the consequences of the carbon tax mitigation policy. And so you can see on panel C that if we engage into the Paris Agreement, we have a shift in the green investment. And so at the peak, we should spend 6% of additional output into reducing carbon emission, which is a sizable number. And so if we have a boom and we have also an increase in the carbon tax, monetary policy is going to react by increasing the real interest rate. And this will shift strongly the IS effect downward and will dominate in the short term. And this is why, on average, the aggregate demand in the short term is lower than usual. And you can see at the end in panel A that if we engage in that carbon policy consistent with the Paris Agreement, we will save the planet, but we will still have 1% of GDP that will be lost permanently because of climate change and the stock of emission that we have already emitted. But in contrast, if we live in the laissez-faire world in which no carbon mitigation policy is implemented, I mean, monetary policy is going to face more and more, the marginal cost is going to increase, inflation is going to increase, and so the monetary policy is going to react by increasing the real interest rate. And this is going to shift the IS curve downward proportionally to the increase in temperatures. And so as damages are growing, the IS is going to permanently deteriorate over time, and you can see that by the end of the century, we could have about between 3 and 4% of output that could be lost because of climate change. And this is consistent with usual integrated assessment model, and it's a pretty optimistic perspective because some of those forecasts are much more pessimistic with respect to the cost of climate. So we're quite conservative. now we want to understand as well the determination of prices in that situation. So we have the marginal cost of production that is actually a function of the standard component that we have in the New Keynesian textbook, so basically the real wage. But we also have the damages from climate change. And so we want to know how much the standard component, the climate change component is going to be affected, as well as the greenflation component that is composed of the cost of abatement, that is the first term in this equation, and the second term is the cost of the carbon tax. And so if we can decompose the marginal cost, we can express the marginal cost into inflation equivalent. And so the second equation splits inflation fluctuation into 4 components, 4 complementary forces, the standard part from the real wage, the second one from the climate, and the third one from greenflation, and the last one from the exogenous shocks process. And so in panel A, you have once again the path of inflation, and you have in B, C, D, and E panels the contribution of each forces. And so if you sum all these forces, you get back to the panel A. And so you can see in this panel that if we engage into the Paris Agreement, so basically if we increase carbon tax in order to reduce carbon emission, you can see in panel D that the greenflation term, so the cost of the transition for firm, is going to increase and materialize in a large shift in inflation. So greenflation term is going to be extremely high during the transition because of the carbon tax. But if you increase the carbon tax, you increase abatement expenditure, and so you end up with less fraction of resources which are devoted to consumption, and this deteriorates the wealth effect on the labor supply, and so the wage is going to decline in response. And so this is why the contribution of the wages is going to dampen the inflationary effect of greenflation. And you can see that there is some gain in engaging in the transition because the climateflation block is going to be stabilized because there is no more global warming. I mean, we have stabilized global warming, and so there is no more increase in the climateflation force. However, if we engage into no mitigation policy, you can see that the rise in the climateflation term is going to increase a lot. We are going to live in a planet with more and more adverse weather events. We are going to have a lot of damages, from sea level rising, from massive change in immigration from regions which are arid to regions which are less arid. So there are going to be large shifts that will lead to an increase in inflation that is explained here by the climateflation force. But also the fact that there is a disengagement from the carbon policy, there is also a reduction in the greenflation term that is going to dampen some of the inflationary effects. And finally, the standard term, that is the one that is related to the wage, is going to follow the marginal product of labor, and so is going to decline naturally as the planet is warming. And so in turn, this explains the realized path of inflation and drive most the path of inflation for the laissez-faire scenario. All right, so conclusion, we have developed a simple 4-dimensional New Keynesian model in which we include the climate externality, and we have identified 2 core phenomena. The first one that is related to the effect of climate change on inflation, that we call climateflation, and the second one that is related to the inflationary effect of the carbon tax, that is called the greenflation. And so right now we are working on analyzing how sensitive is the outcome to different parameter scenario, as well as of the design of the monetary policy rule that also drive a lot the result in terms of inflation. And thanks a lot for your attention, and I look forward for Philip's discussion.
Thank you very much. So, Philip?
Okay, thank you very much for inviting me to discuss this paper. If Jean-Guillaume, Frank, and Gauthier team up to analyze the climate effects in the New Keynesian model, then I know it's time to sharpen my pencil and look at these things very carefully. The usual disclaimer applies. So let me try to wrap up what the authors are doing in one slide, and then I will offer some comments. They look at the monetary policy challenges posed by climate change, and they can be broadly grouped into two parts. The first is climate inflation, the inflationary effects that come from a warming planet, for example, through productivity effects from climate damages. Think about floods, heat waves, migration patterns. Gautier mentioned some channels. Second part is greenflation, the inflationary effects that arise from climate mitigation policies that affect the supply side and also prices. What they do, they break down the quantitative importance of these channels using an extended textbook monetary policy model. And what they find is large inflationary effects from both channels already today. I think that's also a very interesting methodological contribution. So I want to briefly highlight the added value for the standard macro analysis, which are, of course, the climate features, climate mitigation, which is here captured by abatement costs, and also the productivity damages from climate change. But what is also interesting, the authors do quite some acrobatics to introduce features that attenuate the forward-lookingness of our models. And I think that's also relevant for standard macro analysis. Me coming also from a climate modeling perspective, I see great added value through using the tools that we have in standard macro, such as Bayesian estimation. And Gautier has shown that they make quite some advances in the state-of-the-art technology available to us by using also nonlinear estimation techniques for these models. So that's very important. And typically, climate models are calibrated models. So it's interesting to bring in here an estimation perspective. It also captures the anticipatory behavior of agents. And often in climate science, these models are solved recursively, meaning that forward-looking dynamics are not captured. At the same time, it maintains tractability. So Gautier has shown that they can boil down this model into 4 equations, which contrasts to the thousands of equations that are typically in the integrated assessment models. So in my discussion, I will focus first on the quantitative results that I find very striking. Then I will discuss some modeling choices, for example, monetary policy conduct that really matters here for the results. Also would suggest to clarify the role of the behavioral features. And then I will shift to some of our own work, which uses multi-sector models to analyze climate transition dynamics. If I have time, I might also comment on welfare, and more broadly, climate change here is captured more as a slow-moving phenomena, but it might have also effects on volatility at the local level, and it could be another interesting avenue for another paper. So I'm not asking to do this here all in the same framework. Okay, so let's look at the results. The first thing that is striking are the huge effects of climate and green inflation in that model. So look at panel D, inflation differences between the Paris Agreement and the laissez-faire are about 4 percentage points and for decades. So that's a very striking result. So we see that there's an extreme relevance of climate and greenflation according to their model. At the same time, there's also a large effect on output, as you can see in panel C. And what is extremely relevant and useful is the decomposition of the effects. Where do they come from? So they propose a semi-linearization of the Phillips curve to break down the different parts of inflation arising from either climate damages or climate mitigation policies. So what is remarkable here is that the effect is already very large today. So if you look at the contribution of climate inflation today in panel C, that's about 4 percentage points of quarterly inflation. So that's a very large effect. And the same goes for the greenflation in the panel D. What is also interesting is that historical shocks, because the authors estimate their model, have a very persistent effect, as you can see in panel E. So the historical shocks, they only die out in about 80 years' time. So that suggests that there's quite some persistence in the model. Okay, let me wrap up my observations. The Paris Agreement long-run output costs of around 1% of trend GDP here, which might be below other estimates when including climate damages, but there's a lot of uncertainty around this. So. The Paris Agreement scenario also suggests that we would have on average 3 to 4 percentage points higher inflation for decades to come. And the very important decomposition reveals that the substantial contribution arises from climate inflation and green inflation even today. Then a first technical comment. We should keep in mind that in your modeling, the carbon tax is actually fairly low today. Plus, you introduce several features to attenuate forward-looking behavior. Plus, the Phillips curve estimated is very flat. So it is still striking that even with all these features, there's a very large effect coming apparently from forward-looking elements here. And maybe it's also difficult to disentangle this effect of a highly nonlinear curve using this proposed semi-linearization, because even the standard term, so the usual non-climate feature part of the model, is extremely deflationary. So perhaps I misunderstand the effects depicted in panel B, but they look extremely large, but maybe they also include some of the effects arising from climate and green inflation. In general, the current literature, empirically and from a modeling perspective, tends to suggest that the impact of green inflation is rather mild. So the adverse supply effect is inflationary, but at the same time, there's a demand suppression, which works in the opposite direction and can be deflationary. The net effect is small, but to be fair, there's not much agreement on this yet, so your study is extremely relevant to inform also this literature. Empirical evidence, so that's for the today contribution of green and climate inflation, suggests that these are rather limited. There's also a nice ECB overview paper that finds limited effects of carbon pricing. This depends also on the geographical coverage, but given that carbon taxation is higher in the EU, Canada, and the OECD than in the entire world, we would expect that these effects are not larger in the full world sample. Next, I want to show you some simulations with larger models coming from a policy institution. First, the colleagues at the ECB have extended their newer area-wide model to look at inflation. And to keep in mind, in all these panels, they're not necessarily depicting the same carbon tax path, but they give you maybe a sense of an order of magnitude that comes from larger models that also explicitly include investment, multi-sector perspectives. And there the effects are about an order of magnitude smaller. So at the ECB newer area-wide model with the environment extension, these effects are about 0.5 percentage points, but this also crucially depends on how you specify your Taylor rule, which I will come to next. I also dug out our results from the extended Quest model, which is a multi-sector model, and they're really small and depend crucially how the carbon tax is treated in the consumer price inflation in the Taylor rule. Which brings me to the point that Gauthier had not yet had a chance to discuss, but it's already in the paper mentioned as work in progress. So I really look forward to look more closely at that, because the inflationary impact in this kind of model depends very crucially on the conduct of monetary policy. And interestingly here, as the authors clearly state, climate inflation and green inflation create some inflation output trade-off. So in their New Keynesian climate model, the Taylor rule follows a usual specification, and I want to highlight two parameters here. First is the output gap stabilization motive. And there's some credibility to that because they estimate the model non-linearly. So that's, I think, very important to not just calibrate these parameters, but also estimate. Yet the prior is also pretty large, if I read these parameters correctly at least. And it suggests a very strong output gap stabilization motive. So that's important when looking at the inflationary effects, because the monetary policy here also has in mind to stabilize the output gap. The inflation stance, by contrast, seems rather weak. I see here a posterior value of 0.6. And if I understand this correctly, this would even violate the Taylor principle, but perhaps using the forward-looking attenuation channels you can get away, but maybe I'm misreading. Gauthier is already shaking his head, so I will focus then on the next point, which is the measure of inflation that is used here is GDP inflation, and carbon taxes operating here only on the producer side in that model and not on the consumer side, but that's fine. Just want to point it out that it could be interesting to at least comment on it. So my suggestion would be, and we have seen that they have indeed the plan, to explore the role of systematic monetary policy here, because it will be crucial for these effects. So if we say the effect of green and climate inflation will be very large, that's all conditional on the conduct of systematic monetary policy in these models. And interestingly, also monetary policy is conducted here at the world level. So for future work, it could be also interesting to see whether some coordination problems arise or whether climate challenges are more actually related to volatility at the local level that are harder to stabilize than these long-run effects. There are several features of forward-looking attenuation in the model. There's an exogenous exit probability of firms. There's a discounted Euler equation. There's a credibility of climate policy. And it's important to study these channels maybe more systematically. So I would suggest to also show these features in a model version without climate change, because I think we can learn something from that also for our standard modeling approaches. Yeah, just a bit of self-advertising here. We use our eQuest model here, and we do a more pedestrian way in which we allow expectations to adjust in a staggered manner to carbon tax surprises. And you can see that, for example, the green transition is more costly because if policy is not perceived to be credible, because investment is delayed and has to be raised faster on. So this could be also interesting for future policy analysis. Another part comparing our models to the new Keynesian climate model proposed by Gauthier and Frank is the multi-sector perspective that is typically found in climate models. So here, I would think that the green transition hinges really on shifting electricity production, mainly from fossil fuels to renewable energies. And here the key parameter is the substitution between green and, let's call it, dirty energy. And with more sectoral disaggregation, the abatement can also happen via substitution towards another good. Whereas in the new Keynesian framework, which is more stylized and more tractable, there's one sector with abatement costs. So perhaps it could be useful to comment on that, which elements you lose and what you gain from the additional tractability, and how this could be mapped, for example, in the larger models that have a much more sectoral view on transition costs. And the multi-sector view could also be relevant. We have seen Marco's presentation this morning that there are differences in capital intensity and financial frictions faced by green and dirty firms here. And another element could be the different price stickiness across sectors that might be relevant for monetary policy. And what Del Negro and Olafsson suggest also that the differences in price stickiness across these sectors also have implications for the optimal conduct of monetary policy. So it could be interesting to discuss what we miss out by not having a multi-sector perspective on this. And another question that could be answered would be something like, can monetary policy support the required investment? Because recall in the new Keynesian climate model, investment is not explicitly modeled, but there's an abatement cost, which is more of a flow function than a forward-looking investment decision. So that could be interesting as well. Yeah, I'm going to skip that slide, but it's just to highlight that the key challenge in the multi-sector models is the substitution elasticity between green and dirty goods. This is not accounted for in the new Keynesian climate model, but it could be still relevant to explore the sensitivity with respect to the stand-in, which are the abatement costs, and there's also a lot of uncertainty surrounding these. And these are also among the calibrated parameters and not among the estimated parameters. So it would be nice to see a bit of sensitivity on the quantitative role of these assumptions. Last comment on the welfare costs. So in the laissez-faire scenario, in the red scenario, we should look here at panel B in their model, which is basically consumption. The consumption is actually above the Paris Agreement for quite a long time. And so it would be interesting to also compare to other models. At what time are the mitigation costs dominated by the damages that are saved? And what maybe support your view is that a recent paper in Nature suggests that most of the climate damages until 2040 are sadly already committed, and our mitigation policies will have very little effect on these. But for the long run, they will have dramatic effects. So that's interesting. It could be relevant to discuss the time scale of how mitigation costs unfold and at what time the consumption patterns are improved relative to a laissez-faire. And last comment in 20 seconds is We are looking here at monetary policy conducted at the world level, but it could be also interesting to look at notions such as disasters or volatility, because ultimately monetary policy is conducted at the regional or national level, and there it might be more interesting to also consider how monetary policy should deal with these disasters that arise occasionally and reduce the predictability. Yeah, I have a few other comments, but these we can discuss bilaterally, and let me thank you again for the opportunity to read this paper and comment here. Thank you.
Thank you very much. So what if you want to...
So thanks a lot for having so much comment on the paper. I do agree that we had with Frank a lot, and Jean-Guillaume a lot of debate about the effect that we find from the model. We are extremely conservative, you know, because we have pushed a lot the attenuation channel as much as we could, and still the numbers are really big. And so when I talk to environmental issue to a macro audience, usually, I mean, people are quite amazed by the size of the result that we have. But I think that people also do not imagine the effort for the society that it is to switch to a low carbon economy. And so that's why those numbers are extremely big, because it's a very large structural change that will be extremely costly for the society. And so I think that people do not imagine that in 2050, for instance, I mean, we will not be able to use flight as much as we do right now. And so there is no way of avoiding people to stop using flight, because there's no technological break that will allow to use flight without emitting carbon emissions. So there is a lot of cost for the society that already emerge, you know, in models. This is the reason that we have huge effects. And so the wage, so the standard component that you showed that was pretty large, is just a general equilibrium effect. I mean, the economy responds to those changes in a very large fashion, you know, to dampen the effect of the carbon tax that is implemented. We also have, I mean, inflation that is much higher than any other models, but I guess also that the models that people have in mind are for developed economies. And so here we worked at the world level, and so think about developed economies. They have not even started, you know, their transition. The US has not started at all, but even for developed economy, the cost of changing to low carbon economy is going to be extremely expensive for them, much more than for us, because we have already started with the ETS market to reduce carbon emission. So if you have the Können paper in mind with the magnitude of inflation they have, because they are working on the euro area, and obviously the magnitude or the distance to reach net zero is much smaller than for the rest of the world. So maybe it's a bit of a question of perspective in the way we see the results. You also some comment about the Taylor coefficient, and I guess it's probably a typo in the paper, but the Taylor principle is respected. So the coefficient that we have, that is 0.6, is supposed to be 1 plus 0.6. So we just do a switch in the parameter in order to avoid the estimation to alone value that will not accept, you know, validate the Taylor principle. And the coefficient, you know, on the output gap is quite higher than usual. But once again, it's for also developed economies. I mean, it's at a world level, and so central bank for developed economy are probably more dovish than central bank in developed countries. And so once again, I guess, but that's just a guess, it's a matter of which type of country we're looking at. You also have a very good point on the multi-sector aspect. I mean, we try to keep the framework as simple as possible. And so I really acknowledge the fact that most of the transition effect will emerge within the input network, input-output network through substitution. But once again, once we work on substitution, the question is how quick is the substitution parameter going to change over time? And it's extremely difficult to know how much we will switch from complementarities to substitution. And once again, if we replace with those multi-sector models, we have new questions that emerge and that are difficult to answer. And so since we want to keep the framework as simple as possible, we're going to share the code later. And so if people want to make some extension with different sector to green versus brown and so on, we will be happy to see extensions. I do agree that everything is uncertain. I mean, in the parametrics perspective, most of the parameters on abatement are quite unknown. You can see that when we go into investment, green investment, I mean, in France, for instance, when we built new nuclear plants, I mean, the initial cost that was provisioned with the one that is realized is extremely different, which means that it's really difficult to anticipate the true cost of infrastructure changes. And so once again, we'll do some robustness check. I mean, this was included in an older version of the paper, but we intend to include it in the next one. And so abatement costs are going to be one of the key parameters that play a role in the cost of the transition. So thanks a lot also for the welfare suggestion to see the no arbitrage condition between the two scenarios. We'll have a look. I'm not sure that the laissez-faire is going to be, I guess it will be welfare enhancing to remain the laissez-faire at least until the end of the century, but we have to check. This can be a bit difficult to understand and to swallow, for the usual audience. And thanks a lot for the idea of including volatility that would be increasing with climate. This is something that we have think about, but once again, it's really difficult to make the calibration and know how much volatility would change with respect to climate. But thanks.
Thank you very much. So now we open the floor for questions. First, I want to abuse my power, making a very short clarification, which is about how do you project the path for this inflation target, because all your results are proportional to this inflation target, but if this inflation target is going down, then inflation can remain constant. So I wanted to know a little bit more about that. Then there is an order. It's Paolo, Marco, Benoit, Ricardo, and let's start from there. So please, Paolo. And remember, please, those to stand up and identify yourself again for those who are online.
Paolo Surico, still at London Business School, relative to 40 minutes ago. I like this very much. I think it's very useful. Here look like fiscal policy is really a pain in the neck, in the sense that it's a massive supply shock to which the central bank massively respond. So it's a very useful benchmark. I was wondering whether it could be useful to look at what's happened if the government also change the consumption basket to which the price index that defined the inflation target is linked to. And I wasn't sure what the government does with the revenues from the carbon taxes, which will be another obvious way in which the government could try to mitigate the negative effect on GDP. So I was wondering whether the combination of the two could be one of the scenarios that you might wish to feature in a new version, a revised version of the model.
Thank you. So, Marco?
Quick question. I mean, in a way, this was already in the discussion. I think the really heroic assumption here is treating the whole world economy with a single neo-Keynesian model, because many of the things that have to do with climate have to do also with different policies in different countries. I mean, if you take seriously into account the fact that China and India are going to go their own way regarding carbon taxes and we are going our way, we may have actually the worst of both worlds, because we will have high emissions, essentially your red scenario, if I remember correctly, eventually, and so all the negative effects that come from that, but we also have high carbon taxes in our economy. So, and their policies are going to be different from our policies also on the monetary policy front. And immediately the issue of real exchange rates comes in, because essentially we are going to have real appreciation because they have lower carbon tax than us. And we already see that in our kind of protectionist responses to Chinese policy. So I think this is, if you really want to address with these very interesting tools the issues that you're trying to address, you should definitely have a multi-country and perhaps also multi-sector model of the world. I mean, that would be my suggestion. Of course, that's challenging, but that's the name of the game, I think.
Thank you. Benoit?
Yes, thank you. Very nice paper. So, Gauthier, you said you would put the code online, and I think that's very much welcome. And many teams in central banks are working in this type of models. That's including in the NGFS research network, where actually the Bundesbank multi-sector model and the IMF CGMET model, which are online already, are also providing benchmarks. A question which is related to the previous two is, I wonder whether in the model you can, would you have a distinction between what would be a carbon tax and the type of transformation that we are seeing currently with the Inflation Reduction Act in the US, and also very likely a dumping of Chinese-made electric vehicles to the rest of the world. And so it's not clear whether the world would go towards a universal carbon tax. We don't necessarily see it, but it seems that through subsidies and industrial policies, there is this wedge which is coming. So is it equivalent in the model? And can you, or would there be a distinction? And can you use the model to analyze those two different passes of subsidized transformation versus introducing a carbon tax?
Thank you. And Ricardo?
Ricardo Reis from the LAC. I'm going to repeat Marco's question, but I'm not ashamed of doing it because I think I'm going to frame it in a very different way. When we were writing, say, the closed economy New Keynesian model 40 years ago or so, the unit of analysis coincided across all the equations. We had one monetary policy, we had one fiscal policy, the model was built for the US, approximately. We had one unit of trade. In that economy, there was a lot more trade within borders as opposed to out of borders, and so a closed economy was okay to get that discrepancy. We had one country that shared a technology, and therefore to assume a common production function was similar. And finally, we had the same unit of account, and in that regard, thinking about price rigidity in terms of when you adjust your price unit of account was appropriate. As I'm trying to build a new Keynesian climate model like you did, you kept that assumption through there being a one country model, let's put it that way, and then we can discuss whether that's the world or the euro area. But when one considers these climate choices, it's clear that that unit is really not the same as you look across these dimensions. For the monetary policy, of course, it's the euro. There's one interest rate, approximately. Apologies to all the finance people, there are many, but one set by the central bank. But when one thinks about the IS, the fiscal policy, has already been noted by Paulo and others, you know, your carbon tax is capturing one dimension of climate policy, but there's really very large fiscal policy differences, both in terms of the debt, and therefore can I do what you do, which is assume your carbon equivalents have lump sum taxes? Well, not really, because there's going to be massive differences that's going to affect output and inflation. When you think about trade, really here on the climate, the spillovers are very large, and this is what Marco noted, and so insofar as the policy you do, how much of an effect does it have on the carbon on you? Actually very small insofar as the other ones don't. When we think about the productivity, likewise, the extent to which, as you were saying, the innovation that you spur or not and how your marginal costs get affected matters. And finally, when it comes to the price differences, the real exchange rate ends up being the really big one, as opposed to really the price stickiness across the other ones, point to a small open economy model. So you're trying to kind of cram all into one unit, but you have these different units going. I don't think it's as simple as what Mark was putting, as saying, well, let's just build a world economy model or not. It's really a choice of each of your equations is asking for a different unit, and we need to think about how to reconcile them. And so I worry a little bit on this analysis, how we're trying to cram them all, and how would you point to, I don't want to be negative, how would you point to thinking about what the right unit is and in which dimensions? Thank you.
Thank you very much. So Gauthier, please.
Let me do it by order then. So Galo, we have an inflation target that is time varying and exogenous, and it's going to 2% in the end of sample, and really quickly. So this is just, you know, for the estimation to avoid that the model captures those changes through unit root shocks. So there is, I mean, it's converging to the usual 2% totem target. Paolo, yeah, there is a question of revenues, and once again, how the carbon tax is going, I mean, the revenues of the carbon tax are going to be recycled. Here, we're extremely conservative in the sense that it's given back to households in a non-distorsive way, but it could be used in different way. For instance, reducing the inflationary effect on the production side. It could be given to reduce some taxes on consumption, to also dampen the effect. So this is also something that we're going to look in the robustness check, but I'm sure will play a role on the greenflation term, on how at least the economy is adjusting to this greenflation term. So this question of one country that is a world country and is extremely probably too big, you know, in terms of focus. I acknowledge this, but in environmental macro, I mean, the IPCC is making forecasts based at the global level, and the DICE model, that is a baseline for environmental macro folks, are always using this model at the world level. So we just try to be in the continuation of DICE, probably in an imperfect way, but still in the continuation of it. But we could adapt the setup without having the big multi-country model. We could, for instance, do the same model for equation for the US economy. That would probably make more sense. And the last equation, that is the climate change equation, could be simply a combination of the US decision plus some exogenous decision from foreign countries. And we would just have to make one simple extension on the emission side for the rest of the world. And in that way, I guess it answers the question of the multi-country issue, because it could be easily adapted with really few changes to a simple country. But once again, there is also the issue of international effect. The euro, for instance, I mean, at the Europe level, there is some decision to implement some carbon border adjustments in order to penalize imports which are carbon intensive. These are some way, you know, for countries to attenuate the negative effect from implementing a carbon tax domestically. So this kind of effect can be taken into account, but we have to do it in at least a two-country perspective. And so for us, it's a big beyond the scope of the paper, because we wanted to be as simple as possible in the continuation of the DICE model. With respect to your question, Benoit, yeah, we could use subsidies in many different ways. I mean, the question is how subsidies are going to be financed. And here we use the carbon tax, and I mean the carbon tax is there is no question about the government debt. But if we go into subsidies, I'm sure that we have to discuss the question of government debt and how we're going to finance those subsidies in the same way as what the US did. So this is something that we can implement, but of course it cannot be done in a 4-equation problem. So once again, we go a bit beyond the initial scope of the model. But once again, we can make some extension, having some government debt, and see how the debt can change over time by financing subsidies to the production side. And I think I answered all the questions, if I'm...
Okay, so thank you very much. Let me conclude this session. Has been very fruitful. Let me remind you that there is coffee outside for those of you who want or want to go to the bathroom. And then we reconvene here again in 6 minutes, so at 11 for the very... No, in 10 minutes. Okay, so... 11:10, so 15 minutes. So you have 15 minutes, much better. So thank you very much.
So, ladies and gentlemen, dear guests and esteemed attendants, welcome to our panel discussion on current issues for monetary policy transmission in Europe. My name is Katrin Assenmacher, and I am heading the stress test modeling division at the ECB. Today, I have the honor to moderate a panel with a distinguished group of experts who will delve into the intricacies and complexities of monetary policy transmission in the euro area. Central bankers need to know how their actions reverberate through the economy, influencing key variables such as interest rates, inflation, and economic growth. This has always been challenging, but even more so in recent times, owing to unprecedented shocks, multiple ongoing structural changes, the extension of the monetary policy toolkit, and a dramatic turnaround from too low to too high inflation. Let me first introduce our panelists who are bringing a wealth of knowledge and diverse perspectives to our discussion. They are partly here with us at the ECB and partly joining remotely. I'm going in alphabetical order, and I'd like to start with Silvia Adagna, who is Managing Director and Head of European Economics Research at Barclays and joins us from London. She leads a team covering euro area economies and the UK and some of the small open European economies. Next, I'm sure that everybody in the room here knows Mario Centeno, who is governor at the Banco de Portugal and member of the Governing Council of the European Central Bank. He held various notable positions before, in particular as president of the Eurogroup and chair of the Board of Governors of the European Stability Mechanism, and was finance minister of Portugal. Then, next to me, we have Benoît Moujon, who is head of economic analysis at the Bank for International Settlements. And before joining the BIS, he was director of monetary and financial studies at the Banque de France. And finally, our panel is completed by Ricardo Reich, who is the A.W. Phillips Professor of Economics at the London School of Economics. He surely is also very well known to this audience. For his academic work, he received various prizes, and he also acts as an academic advisor at many central banks and other organizations. So now, without any further ado, let us start listening to the statements of our panelists. And we will start with a set of opening statements of about 5 to 7 minutes from each of the panelists before engaging in an exchange of views among them. And finally, we will also open up the floor to questions from the audience. So starting will be Benoît. So Benoît, the floor is yours.
Thank you very much. It's a great honor. It's a great pleasure for me to be here, and I'm very fond of this conference. It shows that research on the transmission of monetary policy in the euro system is alive and kicking. It's very dynamic. It's very topical and super interesting. I learned a lot yesterday and this morning already. So I want to basically focus on the recent experience and what it means for monetary policy and the credibility of, in particular, the inflation targeting framework of central banks to stabilize inflation. So many of you would know this quote from John Gospel, and it's basically taking place in the history of Jesus Christ after he's been crucified. Some start to believe that he was back to life, but Thomas was skeptical. He wanted to see. Jesus Christ alive and test his wounds to believe that indeed he was back to life. And to some extent, this recent experience that we have had with a very high inflation, central banks tightening interest rates vigorously, late but vigorously, which brought back inflation back very close to the target in the case of the euro area, is actually, it's an experience of the transmission of monetary policy working through the anchoring of inflation expectations. And while until 2022, 2023, you might have thought that this expectation mechanism that we know is very powerful in the models that we use to think about monetary policy, that this was essentially an assumption and a matter of faith. Now we live through it. Until then, you could say, well, it's a great moderation. Inflation expectations are anchored. They are flat, but inflation itself, it's flat. And between these two flat things, the correspondence was a matter of, you could argue, was a matter of faith. Now, for very many observers, we've seen that if you tighten monetary policy, you manage to get disinflation. And you manage to get disinflation not as much through lowering or slowing aggregate demand. Okay, there was some of that, but given the slope of the Phillips curve that we estimate, the bulk of the disinflation did not come from slowing the economic activity, and actually we think of the current experience as a soft landing disinflation. So actually, I think, I'd like in this house to mention Otmar Issing, and that's where I started my career. And, Otmar Issing was really stressing there's no such thing as a track record. And I think that the recent experience is one where the track record of stabilizing inflation has reached another level. It's more credible now after the experience that we've had than it had been until now. So basically, that's the first point. I want to illustrate briefly, how it worked in the model, and that's basically that we have this tightening, and the way we think of it at the BIS is that you have two regimes of inflation. You have a low inflation regime with a lot of nice properties, including mean reversion. And so inflation will return towards the 2% target of the central bank. But if you leave this low inflation regime and you fall into a high inflation regime, that's not granted at all. And so the way it works here in simulations that we described in a December 23 BIS bulletin is, inaction is reported here with the yellow line. Okay, so if the central bank did not increase its interest rate, what you see in the middle panel is that core inflation would not have returned towards 2%. The red and blue corresponds to two hypotheses we have on the formation of inflation expectations, whether with different degrees of credibility of the inflation target. But really, the main message is that you needed to convince the private sector economic agents that you will stay in this low inflation regime, and what this vigorous increase in interest rates that we've seen in 2022 and 2023, that's what it produced, that we stayed in this low inflation regime, and we saw inflation coming back very close to the target from double-digit peak in the euro area. So then what does this mean for researchers and analysts and the staff of central banks who is trying to think about, what is it useful to look at? What is it that you want to do research on? And so basically, I think it's about understanding better this credibility capital of central banks. And so there are different places where you can look at. So there is the time series dimension, which you may be familiar with inflation at risk type of models, which actually is based very much on research which was conducted at the ECB 15 to or 20 years ago, or published in 2008. And so, it became known under the label inflation at risk. But I think there's also the cross-section moments of inflation expectations. There's work also on this about 15 years ago. But one thing that really very much struck me is when in 2021, Ricardo Reis actually said, look, we start to see bimodality in the distribution of inflation expectations. And when have we seen bimodality in the past? Well, we had seen bimodality in the early 70s. And so this really started to raise anxiety. So just very few evidence on how you can go about trying to understand whether this credibility capital is at risk. First of all, there have been instances in the past in advanced economies. So AE here stands for advanced economies. So the red dots, that's the distant past. Then, the mean of inflation expectations was sensitive to observed inflation. And this sensitivity has come down in the inflation targeting regime. We also have evidence that in EMEs, it took quite some time to lower the sensitivity of the mean of inflation expectations to observed inflation. That's moving from the yellow dots to the blue dots. Now, if you look at the variance, the cross-section variance of inflation expectations, which you can measure with disagreement, which is the interquartile range of inflation expectations, there you see that in the recent episode, and going back to the observations that Ricardo had made, you saw some increase, okay? You saw some increase. So this was an alarm that we had to take very seriously, in my view. Now, if you look at disagreement, the disagreement time series on the left panel here, yes, it did increase a lot, but it stayed relatively small, okay? Which is another sign that, the credibility capital maybe started to be at risk, but maybe not so much. So quantitatively, at least. So let me conclude. So I think that really this disinflation experience that many people have had, and that's financial markets and observers, I think it lends a lot of credit to this inflation targeting framework and to the type of models which put some emphasis on the expectation channel of monetary policy. And I think it's been critical to bring inflation down towards the definition of price stability at 2%. And in terms of research program, moving forward, I think it's a very critical research program to try to get leading indicators of when this credibility capital is at risk. Okay, when we are moving out of regions of stability, as we labeled them in the BIS annual economic report of 2023. Thank you very much for your attention.
Thank you very much, Bernard. I'd like now to give the floor to Silvia.
Thank you very much, Katrina, and good morning, everyone. I want to start by thanking, obviously, you, Katrina, and Philip Hartmann for inviting me to participate to this panel. It's really a great honor, and I'm really sorry I wasn't able to join you in person. But also on my side, I was able to listen to some of the papers, to read some of the work of the network, and it's really excellent. I'm sure it would be very influential also for us in the private sector. So I think someone will share my presentation with you. In my introductory remarks, I will focus on a possible divergence of monetary policy decisions across the two shores of the Atlantic. Now, this is a topic that it's making the media headlines, it's top of mind of investors, but clearly its possible consequences are of interest both for policymakers and I think for academics. Now, as Philip Hartmann suggested in our prep call, there is a lot of drama around this potential divergence, but my goal in the next 5 minutes is to show you some data that hopefully will clarify why there is not much drama to make around it. Now, if we can go to the next slide, the work I will present is just based on a joint report that we published very recently with my colleague Mark Giannoni and other teams of our European and US groups. I will try to make 3 points. One is that a potential divergence in monetary policy actions between the Fed and the ECB that would lead to a wider nominal and real policy rate gap would just reflect contrasting macro conditions across the two shores of the Atlantic. The second point is that such a gap would not be unprecedented in historical terms. And the third point is that a gap that is similar in size to what, for example, the market is now pricing would not likely trigger a large depreciation of the currency, of the exchange rate, and that could call into question the entire normalization process of monetary policy in the euro area. So let me start with showing some data on the divergence in macro conditions. If we can go to the next slide, there are obviously many indicators that one can pick. Here I'm just showing you the differential between real GDP growth rate between the US and the euro area and differentials in real output gaps. Now, the latest data points available in both jurisdictions would put these gaps at 3% on the real GDP growth rate and 1.2% on real output gap metrics. And these are sizable differences when look on average since the euro was introduced. In the next slide, you can see the gap in inflation differentials. And whether you look at headline or core metrics, again, inflation rate very recently have been about 1 percentage point higher in the US than in the euro area. Now, this obviously does not tell us anything about implication for policy rates. But if we take standard, Taylor rules that are used in the literature, and even though we know that there are obviously, pitfalls to these rules, we can show the possible scenarios of rates diverge quite a lot across the two shores of the Atlantic. In the next slides, I just copied, what the Atlanta Fed produces. Many different types of Taylor rules interacted with the many different macro factors that allow to simulate the policy rate. And you can see from this heat map that the federal funds rate in many cases would be kept constant, in others would be even suggested to be increased. And those who are red that would suggest a decrease from the current value would see a decrease to as much as 1.25 basis point. If we go to the next slides, we do some simulation of various Taylor rules using various forecasts for the euro area. And here you can see that the median of these simulations would suggest a much more sizable decrease in interest rate. No rules would suggest an increase in deposit rate. And the decrease that all the Taylor rules would deliver would actually be even below what the market is currently pricing. Now, so first point is that, again, I could show you many more metrics, but at least from these metrics, it seems that clearly the macro conditions across the two large blocks are different and would warrant differences in monetary policy rates. If we go to the next slides, I will just show you that even if this happens, or the gap that we would see perhaps over the next 6 to 12 months would not be unprecedented from an historical perspective. Actually, when we consider not just the difference in monetary policy rates, which is the slides on the left, but also the differences in shadow rates that account for differences in balance sheet policies and forward guidance between 2015 and 2018, the gap was sizably higher of what we could see in the next few months. So again, second point, this gap is really not unprecedented from an historical standpoint. Next slides will tackle, what if it happens, what could be the consequences? Obviously, there could be many, many channels of transmissions, but one that is often cited is the FX challenge. We all know how difficult it is to predict exchange rates. Now, I think there is a strand of the literature that is quite successful. It started from the work of West and Engel in 2014 that basically uses Taylor rule, real-time Taylor rules to proxy future returns of currencies. So I just put, in the bottom of these slides some potential metrics using this estimate from these coefficients, and it would tell you that if you take some sort of like all else equal differentials in inflation rates over the next 6 months, the euro could depreciate by about 2 percentage points. But I think a more interesting question is, I put it on the top, what central bank will deviate? I mean, if you see from, if the divergence in monetary policy conditions between the US and the euro area comes because it is the US that has macro conditions that are very different, not just from those of the euro area, but also from those of the main trading partners of the euro area. Now, the nominal effective exchange rate would certainly depreciate according to these models, much less than the euro dollar. And if you look at the time series of the euro dollar and the nominal effective exchange rate, clearly you see that the latter is much less volatile than the euro dollar. I think it's also interesting to see that the exchange rate is very volatile, but even between 2015 and 18, when there was a very large monetary policy divergence across the two shores of the Atlantic, the FX did not move in large size and as a trend continuously. Last point that I want to make to the next slide is just to remind you of some research that the ECB has done, which tries to quantify the impact of currency depreciation on inflation. Obviously, this is a very relevant topic. There is much research also beyond the one that I listed in this table. But I think what is really interesting is the fact that the literature has shown that when you move along the value chain, the impact on exchange rate declines quite a bit. And so the impact on HICP inflation tends to be quite small. The literature, however, has also point out that the effects could be nonlinear. So let me just conclude. And to conclude, I would say that if monetary policy decisions were to diverge over the next year, because macro condition and the limits of the two major central banks would require so, the FX channel is unlikely to generate sustained large impulses to the nominal effective exchange rate. Now, the literature tells us that the impact on HICP inflations of plausible moves from the currency would not be sizable, and certainly not of a magnitude that could really generate lots of drama around it, as Philip put it. However, there is obviously a caveat. I mean, the literature has also shown us that the effects could be nonlinear. And so there could be at some point some responses of monetary decisions to FX moves where these two become so large and or too sharp or too fast to basically avoid any drama. So with that, Catherine, I will pass the mic to you.
Thank you very much, Silvia. So then, yeah. We now move on to Galo, who is here in the room.
Yes, I am. Great. Thank you so much. Thank you for having me. It's a pleasure to be here. The last few years of inflation are really quite remarkable. It's, of course, because so many people in this room look at it so closely and so often, it's easy to forget how remarkable it is that we went from very justified fears of deflation to a very clear, very high inflation in the space of 12 to 18 months. It is quite remarkable how inflation expectations measure tracked it so well to the point where the Phillips curve, which tends to collapse whenever we have an inflation episode, hasn't collapsed at all. The Phillips curve estimated in the 2010s fits very well the last few years. Output gap didn't move much, but the Phillips curve was very flat to start with. If you look at the expectations measured in some supplies, you can explain most of the inflation. Or thirdly, how even though there was fiscal developments in different countries that are similar insofar as increasing the present value of outlays, The timing of fiscal policy was quite different across regions, and yet the inflation effects were very similar. So whether you think about fiscal determinants, expectations, Phillips curves, or even the speed of adjustment, the behavior of inflation, while understandable, is still quite striking as you try to make sense of it and look a little more deeply into it. My comments are going to be on the very last part of the transmission of monetary policy, and that is a transmission from individual prices to overall aggregate inflation. And namely, I want to draw your attention, I only really have one slide, by the way, to what's been happening to the relative price dispersion, both in the euro area as well as in the US during these last few years, and to the likewise quite remarkable increase in that dispersion. Now, when we want to measure relative price dispersion, you have to be a little careful. There are several dimensions to it. Price dispersion could emerge because some firms raise their price by a lot and some by very little. Or it could emerge because some firms raise it today, another 6 months from now. So that the frequency you should look at that dispersion and the extent to which we see whether today's leader is tomorrow's laggard makes quite a bit of a difference in terms of not getting simply mechanical effects. You'll have to trust me, given my 5 minutes, that you have to do a little bit of econometrics to measure how much that dispersion is. But the fact is that starting right away in 2021, you see a remarkable increase in that dispersion, as proxied there by those two orange and yellow, hopefully visibly clear indications of that dispersion. And that was common both in the US, these are across PCE sectors, or the euro area across HICP. And you can do CPI for the US as well. So this is both for the different regions as well as different measures of inflation. They were very large in terms of their increase, and they have been declined, the dispersion has been declining quite significantly, coinciding, could be a coincidence, with the level of inflation, telling us that there's at least hints that there's some important signal here. And third, that if one looks at it recently, very recently, since the beginning of this year, 2024, there is quite a bit of a difference between the US and the euro area, with a much larger decline in relative price dispersion in the euro area, already getting back to close to pre-2020 levels, whereas in the US, it seems to have been stuck at a persistently high level, perhaps mimicking what we see at headline inflation. How do we make sense of this? Or here are at least some attempts to spur the discussion about how to interpret that dispersion. To start with, if one takes a statistical approach to inflation, let us be careful not to make the sins that were made in 2021, and with this dispersion, one has to necessarily look at the components to try and make sense of what's driving inflation. But let's not go and cherry pick which index one looks at, as one sees much too often, because with this dispersion, a statistical consequence of it is that you can pick your favorite measure of inflation and me my favorite measure and end up with radically different versions. Luckily, we do have good statistical work. For instance, here at the ECB, the principal components model, I forget what they call it, the underlying persistent price index, I think, or something, I don't know. So someone here from the ECB probably is going to build it. It's actually a very smart and well-built one. And it's one that, in terms of the current debate, is one that has been falling since 2022 Q2. If you look at the different measures, potential measures of, again, taking randomly things out and not completely randomly, and putting some random things in, core measures, and look at those systematic statistical measures, the statistical measures actually do quite well insofar as for the ECB data, it's been falling, not just coinciding, but actually predating the actual fall in the measure of the HICP, and gives a word of optimism for what seems to be going on in terms of the data. But thinking more about those principal component type approaches, I think is a good thing to do, and one that has already shown its merit both in the last 2 years, and I think over the next 6 months as well. Second, turning to economic theory, the relative price dispersion of 2021 was certainly a big driver or motivator of the theories that point to supply shocks. After all, if you have that the prices of some inputs go up in some sectors rather than others, you'd expect the relative price changes. Relative prices were taken almost as a confirmation that supply shocks had to be what was driving the high inflation. True, and very much indicative and should be inspiring. But at the same time, when one looks now a lot more deeply under the hood, the different supply shocks hitting different sectors seem to have been reflected more into stockouts, quantities across different sectors, and actually not explain a lot of the price variability that we observe in terms of that picture. And likewise, what has happened is that dynamically, and now I look at the present and the future, the disappearance of many of these supply shocks, because they have turned out to be quite transitory, has not coincided with how much the relative price dispersion has fallen, and has trouble explaining the difference between the euro area and the US. So that immediate answer, while certainly has merit and explains some of it, does not seem to be enough. Third, the frequency of price adjustment. As we have an inflation episode, firms should start adjusting their prices more often. As they adjust their prices more often, we should expect at first that the relative price dispersion is higher as some start adjusting. But at the same time, if we transition to a more flexible price world, on the one hand, we'll have that idiosyncratic shocks cause more dispersion. But on the other hand, the big trends in expected inflation in monetary policy should come with less dispersion, because now everyone is adjusting at the same time as opposed with the lags of frequency. And so the link between the frequency of price adjustment and this relative price dispersion, a classic question in economics that we've understood ever since we were looking at these things back in the 90s and 80s and thinking about menu costs and what they imply, is one that can be used fruitfully and has already started being used, but I think much more can be done to make sense of that. But secondly, does also would have trouble explaining all of it, or at least raises an important question, which is that if indeed we've had a big change towards a more flexible price, or theories based on frequency of price dispersion should say that inflation is slow to rise, but quick to fall. Slow to rise because firms only start increasing their frequency of adjustment to the past shocks and what's going on, but then because the economy has become very flexible, inflation falls very quickly. Inflation has fallen quickly, but has it fallen, the fact that it's falling seemed quicker in the euro area and the US is that to the frequency of price adjustment, we'll see. Fourth, expectations, but on that I won't mention much since Benoit has already mentioned it. The really key role of credibility. Many of you, maybe most of you, although this is now disappearing from syllabi, have learned about the Lucas Island model, which is exactly a model of credibility and the extent to which if we have very anchored inflation expectations, we'll have a certain amount of price dispersion that arises from the inattention of agents that are each getting individual signals. But when we go through a high inflation episode, as we all start focusing on the big island, not just the little islands, we should have the price dispersion shrinking quite significantly because we're paying attention and the credibility is more at stake, if you want. As Benoit said, developing these indicators of credibility and linking them also to the price dispersion will be important. And I conclude with one final relative price that is not in this picture and a relative price dispersion that is central. There's a very important price in the economy, which is the price of your labor, wages. And what we have seen also in the last few years is very large movements in real wages, another form of price dispersion, where the relative price of labor lagged that one of goods and is now catching up. Moreover, that relative price, more even than the supply shocks, is a key component that affects marginal costs in a very differential way across sectors. If one tries to explain some of this dispersion, it turns out that as much as the stock-out supply shock kind of indicators is the fact that some sectors are more labor-intensive than others, and real wages have adjusted at very different speeds in the euro area than the US. Right now, again, to make sense of why the euro area's inflation is falling and that you see that in relative prices, quite a bit seems to be linked to the decline in relative wage indicators in the euro area, which is much more pronounced than you see in the US. To conclude, I think thinking about relative prices is an important part, as I said, the last step of the transmission. And hopefully I try to illustrate in these 9 minutes, the extent to which we can look at the different explanations for the inflation and not in terms of their implication for relative prices. And that hopefully gives you hints not just of what happened, but also of what will happen in the next 12 months. Thank you.
Thank you. So, and our last speaker now will be Governor Centeno, and you have listened to all the deliberations from the speakers, so we are looking forward to your take on all these views.
Well, thank you, Catherine. Sorry for not being in Frankfurt. It's been an outstanding conference, and Thank you all also that are working in the network. It's a very important topic to our job. So congratulations on that. I had previous commitments to celebrate the 50 years of the Portuguese Revolution. Yes, central banks also celebrate revolutions, especially of this kind. And I couldn't make it to Frankfurt. But thank you also to Sylvia, Benoit, and Ricardo. They indeed will make my job easier. And I'd like to respond to your challenge and wrap it up somehow in my views and connecting to what we just heard. We arrived to this inflationary process after 8 years and a half of very low inflation. That has been said already. Inflation on average in the previous 8 years and a half was below 1%. This was very low inflation. And believe me, we were really unhappy in the governing council. And we actually even changed and revised our monetary policy strategy. And we must remember that the first goal of this revision was to increase and to state that we were ready to tolerate inflation above 2% temporarily. The only thing that we were not completely aware was the fact that that we will be approaching 2% from above instead of from below, because that was where we were kind of trapped before all this inflationary process took off. We even introduced a name for it. We call it symmetry. We were symmetrically willing to tolerate again inflation above or below our target, which were even more precisely defined as 2%. So that's where we live in terms of our monetary policy strategy, and we must recall that at all times. Then we even increased a little bit of a drama, but the euro area is very much prone to dramas, and they take very easily even an existential format. And we now are skeptical about models. So that's why it's so important to listen from Sylvia, Benoit, and Ricardo. And we shouldn't. Because if we really look at the errors that we made in forecasting inflation so far, they have not been related to models. They are mostly hypothesis driven. This was a very long process of inflation going up. It took more than 1 year since we first had inflation above 2% to reach the peak in October 2022. And this succession of shocks increased the potential for contagions beyond the initial shocks of inflation. It was an energy shock. It was a supply-driven shock mostly in the euro area. And given the long period in which those shocks occurred, this was rather painful. And we were really, in a mode that increased all concerns about inflation entrenchment and whether or not we will be able to bring inflation down to 2%. Well, as a matter of fact, we made a significant progress in this inflation. Sylvia showed graphs very clear on that. The ECB did its part. I think we must be happy with what we have been doing so far. But we were not alone. And the transmission of the channels of transmission of monetary policy work and worked in the euro area because the economic system helped a lot, and also because our fiscal policies in the euro area were much more contained than in other jurisdictions. One of the key elements, probably novel for us, was the labor market. Let me spend 1 minute on the labor market. The labor market in Europe, the results were very clear. We had a great deal of real wage flexibility. Real wages in the euro area fell by 7 percentage points. We also were able to see from the side of firms a cycle of margins that are already slowing and that follow what we will expect from the usual business cycle behavior of margins. And those results were obtained because we have a labor market in Europe today that is way more flexible than the sclerotic and hysteresis-driven labor market that were used in the latest years of the 20th century. Flexibility, mobility, reduction in long-term unemployment, reduction in subsidized unemployment, all these are features of the European labor market today that help us explain why we were able not to have and to feel the heat of wages, and that made the adjustment in the labor market much easier. I even call it the dividend of the labor market, and I truly think that Europe today is living out of a dividend coming from the labor market, from the way it adjusted through these years and through all these crises. The reality today is that the euro area is not growing. It is stalled for 1.5 years. Investment has not grown for 2 years today, and credit over GDP in the forecasting horizon, in the latest forecast that we have in the ECB, will reach the lowest levels on record for euro area time. So these are very worrisome indicators for the European economy going forward. I think they really reveal the true sacrifice ratio that Europe is facing in this fight against inflation. And those numbers are in sharp contrast to the US. So in my take, monetary transmission was effective in the euro area, facing a supply-driven temporary inflationary process. The leveraging is strong, and inflation helps in this deleveraging, of course, but remember, even with inflation approaching 2%, our forecast is for credit over GDP to continue to fall in the euro area in the next 2 years. If you go back to the labor market and you concentrate on wages, as Ricardo was also mentioning, beyond the 7 percentage points real wages reduction in the euro area, way above what happened in the US, we still don't see a true and consistent recovery of real wages. The most recent information we have for negotiated wage growth in the euro area already for 2024 show negative real negotiated wages in the euro area. Take Germany. According to the Bundesbank statistics, negotiated wage growth, is tracking just 2.6% year on year in February, after a peak of only 3.5% in July 2023. Remember that our forecast bases the recovery on consumption. And this will not happen with falling real wages. So our forecast is really challenged today, given what we are observing in the labor market. To conclude, let me just point to the following. Most shocks identified for the euro area, for example, those that result from the decoupling from the US, will be deflationary. A further tightening in financial conditions or the continuation of a very tight policy track will face harder conditions. Existing buffers are mostly exhausted. In the fiscal side, we will have a new Stability and Growth Pact. My expectation is that it will take further tightening in the fiscal side in Europe, adding to the more than 20 percentage points divergence in fiscal stimulus between the US and the euro area. The existing savings from COVID are also, especially in the household side, exhausted. We will be facing a small amount of excess liquidity, and the labor market dividend will be probably not there to help us in balancing the conditions for the euro area in the next few years. So my take is that the euro area faces risks similar to what we observed back in time as a highly coordinated austerity. Those were errors that we had experienced during the sovereign debt crisis. I risk to say that policies may soon become pro-cyclical if not adjusted. And that's not what we expect from policies. And Europe will have a lot to gain if we can go back to a higher degree of coordination between monetary, fiscal, and regulatory policies, the type that we observed during the COVID crisis period. Thank you, Catherine, and I'm more than happy to get questions next. Thank you.
Thank you very much. I think before opening up to the audience, I would go for a very quick round of questions to the presentations, and maybe starting with you, Ricardo. I was wondering how your analysis squares with the idea that the last mile, bringing inflation down to 2%, is the most important one. So you painted a very benign picture, saying in the euro area it's already declining very quickly, dispersion is going down, and if you listen to bank analysts, to the media, everybody says, well, the last mile is the hardest one. So,
well, often the last, so first of all, the benign picture I showed you was only insofar as I was comparing it with the US. It's not that the data is showing that for sure inflation is under control in the euro area. It's simply that it seems to be more so. It's a relative statement, not an absolute statement. Point number one. Point number two, the reason why often the last mile is harder to deal with is precisely because if one has a high inflation episode, and one certainly looks back at the 70s and others, and has this very large relative price dispersion, whether that is driven by frequency of price adjustments, expectations, anchoring, or any of the other facts that I mentioned, it means that then being able to go back to this benign period of inattention, credibility capital, as Bernard would have put it, or simply infrequent price adjustment, consistent with a certain level of relative prices that simply reflect different shocks in different sectors, becomes harder to achieve. One has to reach that new steady state from a scar of the past. If you want, the period of high inflation through all of those different channels leads to a new equilibrium of relative price dispersion that needs to be broken. And if one is not broken, that comes not necessarily with high inflation, but with an inflation that's less anchored, one that is somewhat more volatile. That last mile is harder because it is indeed an adjustment of all of those structural factors towards the previous one. And I think that's true this time, and it is true before in other high inflation episodes that we have observed. And so that's certainly the case right now. And that's why in some ways right now is a decisive period, not literally right now, but even the last 3 months and the next 3 or 4 months for the ECB and policy to contribute to reach the previous equilibrium as judged by relative price dispersion and their indicators, as opposed to staying in a forever higher level.
I see Benoit moving when credibility capital is mentioned. And I think your thesis was that the ECB has built credibility capital by its reaction. So do you agree with Ricardo?
So, I mean, in terms of credibility, also, with all due respect to Ricardo and other commenters in the press, I think that especially, I mean, my sense is that in the Governing Council, they like to talk about this as the last kilometer. Rather than the last mile, and it's you know, it's also being affirmative about, you know, a measure which makes way more sense, and we know the metric system is very much superior, but for some reason, you know, maybe a pink page news media is having a big influence on this debate, but that's aside. I think that in what we've seen yesterday in the presentation by Isabel, there was this effect of wages on services prices, which was very high. I mean, 0.8, 0.7, 0.8 maybe was estimated. This is producer price indices, so you know it means that it need not go all the way to CPI. So I think it's still fair to assess, even though that's a place where there are risks, that we are still unlikely to see a price-wage spiral, but we don't want to be complacent, and we need to look at it very carefully. It may be the case that, you know, through services, because labor becomes more scarce with aging, higher bargaining power of workers, they may be able to obtain catching up on their real wages. Whether this would go all the way to a wage price spiral, that's a higher bar to go, but I think that's where we want to be particularly focused.
Thank you. So Silvia, in your presentation, I was a little bit surprised that you were very, benign about the spillovers and say no drama, nothing. So I think your presentation somehow highlighted that you have flexible exchange rates, and this can buffer and allow for monetary policy independence, which is not what the recent dilemma versus trilemma discussion was suggesting. So I was wondering, what is your take on that? So no spillover of kind of dominant monetary policy to other parts of the globe.
I think it makes a great difference whether you're speaking about a large versus a small economy, right? I was having in mind, you know, the euro area, and I think not much has changed from what, you know, the conditions that we had in this respect, you know, since 2008 or 2015. So I also show you that even in periods of very large divergence, think of 2014-15, the euro area was having negative rates, the Fed was increasing rates, the euro area was doing QE. Even then, we didn't have an unduly, you know, reaction or a very large reaction of the exchange rate. We know that the invoicing system makes a difference. Yes, if we compare the exchange rate impact in the US versus, you know, the pass-through in the US versus the euro area is a bit more, but still the euro area is not Switzerland or Sweden, right? So I think these considerations are important. I think in general, to what the other, you know, panelists have said, I just maybe throw a question to Ricardo or a comment back. I think it's very important what Ricardo says, that, you know, central banks maybe in the last kilometers are going to do, you know, a lot, and it's very important to bring back, you know, the system where it was before. But I think it's also important for the euro area to remember what the governor said, that pre this shock, the euro area had a deposit rate at minus 50 basis points and inflation below target for a long period of time. So I think we need to be careful in wishing where do we want to take back, which is our steady state equilibrium that we want to aim for. And in that, again, I know I would have not had time to present, but like I put some wage data on a forward-looking basis, and some contracts for Italy, they're very interesting. Some sectors that just renegotiate after many years for long-term contracts that last 4 or 5 years, and you have average annualized growth of wages of 2%, in a sector that covers about 16% of the workforce. So higher than 0.9, but still 2% nominal wage growth on average over the next until 2026. So yeah, that are my considerations. Obviously, the US is in a different spot completely on wage growth.
Now that brings a nice segue to the intervention of Governor Centeno. So you mentioned a large range of issues and indicators and so, and I was wondering, so as a policymaker, you have to take decisions under uncertainty. And I guess, so this is the inaugural conference for a network for research on monetary policy transmission. So where do you see gaps? Which kind of analysis you would like to have at hand to take monetary policy decisions?
Yes, that's a very nice question. And I'll take the opportunity to ask for some more knowledge around one key issue is this labor market. It is really not being taken fully into consideration in our analysis. For example, take the Naira. In our models, the Naira barely moves in the last 5-10 years, and that's not compatible with the degree of flexibility and adjustment capacity that we see today in the European labor market. There's a number that strikes me as probably the number that we need to remind ourselves at all times in the current process. 50% of the employment gains in Europe, which was 10 million jobs in the last 5 years, those jobs are held by people that are working in a country different from the country in which they were born. This is migration and mobility numbers that are US type of numbers at the US best. and we didn't have that in Europe before. So we really need to go back and to see what does this mean to the capacity of Europe to adjust. And also to fill the gap between what we see in these numbers for mobility and the productivity impact in the euro area as well. Because we always claim that productivity in Europe is trailing the US, and this is not a novelty. This is something that is going on already for many years. But we need to go to the numbers and see how much this new adjustment mechanism in the labor market help us in that respect. And if we go back to this issue of the last kilometer, let's face it. I mean, this is a convergence process, and as Sylvia was pointing out, we really don't want to go back to pre-COVID period in terms of inflation. And landing inflation at 2% is very difficult. The latest number we have is 2.4. 2.4 is, in round terms, 2, as much as 1.6. Are we going to be able to land inflation at 2% or allow it to fluctuate between, say, 1.6, 1.8, and 2.2, 2.3? I mean, we are there. Let's face it. I mean, we will not have inflation at 2%. As a joke, I sometimes say that if our statistical office produces inflation of 2%, I will have serious doubts about that, because that's a very unlikely event. The economic conditions in Europe prior to the inflationary process were not delivering inflation at all. We did not change that substantially. So there was no de-anchoring of expectations through this process. I mean, maybe 1 month, maybe a couple of events, but in substance, inflation is and remain really anchored those expectations at 2% for the euro area. We are paying much more than other jurisdictions to disinflate, and that's a concern for Europe, and we need to face it, and we need to be ready to adapt to that. Thank you.
Thank you. So we have a large audience in this room, and I would now like to open up the floor for questions to the audience. And again, please stand up, say your name and your affiliation. And for the panelists, I look for signals from your side who would like to take the question, except if they are explicitly addressed to somebody of you. So there's Philip, Paolo.
Thank you. Philip Hartmann, ECB. I'm so glad that we have a directive in the European Union that imposes the metric system on us, on all of us. Because if you look at the latest inflation figures across the Atlantic, then the last kilometer seems to be not easy, but slightly easier than the last mile.
It's also shorter.
That joke didn't go down very well. But 2 remarks. So first, on Ricardo, I just wanted to report that we have in ChaMP actually a project going on that unfortunately we couldn't display today because it's still ongoing, and preliminary, that looks precisely at the impacts of monetary policy on the different components of core inflation, which is one form of dispersion and granularity. And the first things I've seen looked extremely interesting to distinguish which parts actually reacted more, because we still have that the core inflation measures are still higher than the headline inflation, so they still have to go some way to come down. So there would be something that in your direction to make progress under ChaMP. More on the policy side, I wanted to raise an issue to Governor Centeno, because I mean, one of the challenges, okay, some of these energy shocks have reversed, no? But the total terms of trade shock that the euro faces relative to the rest of the world through the different crises that we have faced, there will be a persistent part in it. So that does imply that resources are, allocated in a way that we, quote-unquote, become relatively poorer relative to the rest of the world, like energy-intensive countries and other countries. So, moreover, the latest productivity figures, as also Isabel showed in her introductory speech yesterday, don't look very promising. So actually, one critical element is going to be the recovery in productivity. And so against this background, you emphasized rightly so, obviously, the recovery in real wages and how much hangs on it for balancing the inflation objective with growth and employment developments. But the question is, when we look at these numbers, don't we have to take into account that there are 2 important factors that may also put some limitations, which is these terms of trade losses and potentially, relative to the US and some other constituencies, weak productivity that we have right now, which naturally puts some limits on wage recovery.
Okay. Would you like Stefano as well? Yeah.
So very interesting. Stefano Neri, Banca Italia. So I want to connect Benoit's remarks with those of Governor Centeno. And the point is, I'm really worried about these mistrusting models. And I think that is not really good, doesn't bode well for credibility of the institution of a central bank. So I would, wanted to ask more in detail your views about this link between credibility and trust and models. I think it's really problematic to show mistrust in models. They clearly failed, but they failed, as Governor said, because of the assumptions. So if I want to convince you with an argument that is based on wrong assumptions, I don't think I will manage in my task. So I think we have to really bear in mind that. And I think even looking forward for possible next strategy review, I think that is a part, that would be a very important part of the story. And then a general remark on this last mile / last kilometers. I'm not a long distance runner, but I was told once that it's not the last mile or / last kilometer that creates problems. That happens about 30 kilometers since the beginning. That's where your body wants to stop. And that's when you need your mind to continue going. So I think the ECB is already behind that time. So when they resisted the temptation to stop raising rates and continue in the fight against inflation, to keep inflation expectation anchored. So I don't really buy this story about the last mile. I think the ECB has done a great job in resisting temptations, and I don't think the last mile is really a major concern. Thank you.
So I'd like to collect in view of the time. Are there any more? So there, over there.
Hi, Federico Gugliesi, Banco Italy fellow. So my question is related to Riccardo's discussion of mainly tangentially attention and dispersion, and Silvia's discussion of the potential divergence between real rates in the US and euro area. So I was wondering, as exchange rates didn't change in the previous period and media attention though of investors is increasing, right? The attention is increasing on this gap that potentially might appear between the US and euro area. Should we be concerned at all about capital flows or coordinated capital outflows from the euro area elsewhere? Yeah, thank you.
Thank you. Anybody else? So then I think we can go for a final round of replies, and I would go in the same order as we started. So Benoit, would you like to?
Yes. So thanks for the question on the role of models. I think and my experience in the euro system showed me that. Using models and bringing conclusions from models to the policymakers is done with judgment and also with some care in not trusting the model too much, and so you want to have several models to look at. I think for the point that the main point I was making in the recent episode is that even with a relatively wide uncertainty on what you believe to be the slope of the Phillips curve, even if you have a fairly high Phillips curve, the type of slowdown that we've experienced in the euro area and that Governor Centeno mentioned would not bring more than maybe 2% inflation, and we've seen inflation going from 10% to 2.4%. So it has to be that it came from another part of the equation, and this other part of the equation that is, there's no final proof, but it's in my view convincing, is this expectation attractor, and we see imperfect measures of inflation expectations that we collect from surveys, from financial markets. We see that they're anchored. We see that they have increased and came down. And this explanation of, which is model-based, it's based on a Phillips curve of the disinflation. I think it's convincing, but yeah, again, there's never a final proof. In terms of what role models should have in the forthcoming review of the monetary policy strategy of the ECB or of other central banks, for that matter, that's I think it's going to be a very interesting exercise, and I'm very much looking forward to the work that will be done and published in this respect. But I don't have more of a view of what should be done.
Thank you. So, Silvia, you got a question on capital flows, but feel free to also react to any other remarks that you found interesting.
Thank you. I mean, on the capital flows, again, I think it's a matter of divergence. I think we have seen large capital, and also considering that we are talking about two large, relatively closed economies on the trade, on the capital, very open and integrated. I mean, we really have seen large capital outflows away from Europe in the period of the European sovereign crisis, right? When we were thinking about the periphery versus core, but, it was also an Euro area thing. So I don't think we should be that worried unless we have, again, in shocks that are size of the size that are the one that I mentioned before. On other comments, maybe I would, just pick on the question that remarks that Philip Hartmann had. I think it's we would all agree with you that if the terms of trade shock is not fully reversed, maybe some, as you say, somehow we should be poorer. But I think it's a matter of degree. If we look at how weak real wages have been and are relative to pre-COVID, there is still a long way to go before we recover that. I think on your own forecast, real wages, if I'm not wrong, are supposed to go back to pre-COVID level by the end of 25. But also, if think about some trend, right, it would take even longer. And then on labor productivity, again, I think I agree. I mean, it's very low, but it's maybe the $1 trillion question: how much is structural, how much is cyclical? We don't have a good grasp of it. To the extent the structural other policies are better to deal with it than monetary policies, but to the extent that some weakness is cyclical, I think that the monetary policy stance could help reversing part of it.
Thank you. Ricardo, I'm sure you are happy to hear that your ideas are already taken up in ChaMP projects, but I'm sure that you will have further ideas.
Sure, no, I want to make 3 comments just following up on the discussion, more than answering a question, but 3 comments that I hope will be useful. First, on this last kilometer, now it's been used so many ways in the last 30 minutes that I'm not sure what it means anymore. But let me tell you what I think it means and in the way it relates to my presentation. By last kilometer, what I think is that right now, the transmission of monetary policy and the convergence of inflation is very fast right now. That the relative prices are just stabilizing, that we're at a time, like Benoit said, where you see a bit of a sensitivity, quite a bit of a sensitivity of financial prices and the pricing of inflation risk and others to what's going on now. You see it even, going again to the other side of the Atlantic, to the very large swing we had between a Fed that effectively cut in December through speeches to now reverting to almost raising through speeches within the space of a few months. I think the transition is very fast. That's what distinguishes the last mile, not that we're not going there, not that whether the inflation is here or not, we'll see, but the fact that, as I try to say and the dispersion says, this is actually a decisive moment and is really the opposite of, I'm happy to say it's a benign, but not a complacent moment, exactly the opposite of complacency. That it is different insofar as it's what I was trying to say, the new steady state. Second, and on those terms, like Governor Centeno said, I could not agree more that 2.4, come on, that's rounding error. Look again at my relative prices. It's really 2.42. It's just, we should not fool economic agents that the central bank has any ability to control that. At the same time, and the reason why I'm very, very sensitive to that argument and agree with it wholeheartedly, is that there was an argument, of course, that I felt, and some others in the room did as well, in 2015 when it was 1.6 instead of 2.4. What's the big deal? It's 1.6, it's close enough to 2. And yet, as both Silvia and Governor Centeno said, back in 2020, they were having, I think it was Governor Centeno said, they were having an existential crisis about 1.6. And what made an existential crisis about 1.6 is that it was 1.6 for 5 or 6 or 7 years in a row. So absolutely, there's nothing wrong with 2.4 this year. Trying to hit 2 this year should not be in any way an overwhelming existential problem. But worrying about being stuck at 2.4 for the next 6 years, that is an issue. And that is, again, why I go back to mine. Now I think is a crucial time to both be benign, but not complacent. in terms of what we think. And then thirdly, in conclude on those terms, and relating a little bit to some of the other points made, I think an important lesson about monetary policy, I might even say the most central one, and this goes back to the use of models, is that models, in the sense of theoretical principles, are very important in telling us what you can do and what you cannot do. The big mistakes, as Christina Romer, a great historian of monetary policy, wrote very emphatically 15 years ago, the biggest mistake a central bank can make is think that it cannot do anything about inflation. And central banks did that sometimes, and sometimes do that, including dangerously when we had inflation being too low and some central banks started saying, well, there's nothing we can do about the 1.6. Yes, you can. And when you think you can't, that's when inflation problems happen. But secondly, on the other side, and going back, of course, to another great monetary historian, Milton Friedman and Anna Schwartz, when the central bank thinks that it can do something about movements in the Nairo and real developments, that's also when often problems, very, very serious problems arise. And so when I hear some of the issues that were raised by different participants, again, Governor Centeno and Sylvia Benoit a little bit, of we may be having tough times ahead in terms of what's happening to real wages, productivity, investment, credit. To what extent do those lead us to, or those should lead us to adjust monetary policy, to think about it, but not with the perspective that we can change those, monetary policy and control inflation, but rather that those developments may mean that we have to reassess our measures of our star, and that maybe, going back then to the last kilometer, the 1.6, 2.4, that maybe if our stars are higher for all of those negative developments, maybe we do need higher interest rates for longer that are actually not so contractionary as you may think, precisely for those developments. Which is a very different view from saying, because of all these developments, we need to cut rates very quickly because we need to revert them. Do you think that in some of those developments, I think a very useful model exercise is to go through the list that we went through, and Governor Centeno did it very well, and think for which of these do we think that monetary policy can do something about, and for which can it not do something about? And I think that's a very enlightening, very model-based way of thinking through those challenges and concluding from them whether we are doing too much, too little, where the last kilometer it's more important to cut faster or rather to hold for a little longer. Thank you.
Thank you, Ricardo. After so much talk about the last kilometer, I think what is sure, so Governor Centeno, you will have the privilege of the last word in this panel.
It's much better to have the last word than being in the last kilometer, believe me. But I think I'm with both. Just a short introduction to decision making, and you know I've been into it for quite some time, and there's always a degree of risk, and we should take it, we should acknowledge, we should communicate it. It's the only way we have facing decisions that sometimes we portray as difficult, and they are never easy. But we need to communicate them very well. Even more so in monetary policy, the number of times we mentioned the word expectation in this panel is very clear, a very clear statement towards this communication requirements, and we need to bring others to the table. I've been arguing for that in Europe. In Europe, we didn't achieve yet the maturity level that will bring different decision makers to the same room to discuss and to understand each other's role in this process. And again, Europe is facing a high sacrifice in fighting inflation. That is not being the case in other jurisdictions. And we need to be very clear about it so that our stakeholders, which are those to which we direct our policies, will understand us. Otherwise, we lose credibility. We don't have an audience able to understand what is going on with us and with our decisions. So now, on the questions, it is clear, and Philip stated it very well. I mean, in terms of trade, I don't know the exact numbers, but there was some recovery in 2023, and there will be a further recovery in 2024 of the terms of trade. That's what we expect, but we are not yet there. So who is paying for that? Certainly wages. I mean, the loss in real wages in Europe is huge. Go and tell workers, after losing 7 percentage points in the real wages, that we are worried about the path of recovery of those wages. In a healthy labor market, that's what is going next. And it's not only in a healthy labor market, it's in a recovery, the recovery capacity of the euro area. So we need to be able to communicate what is the level of wages that we think is compatible with inflation going to 2% and the real risk of second round effects not materializing. So far, it didn't materialize. We need to be very clear about that so that we can communicate. And we need to get to this paradox of productivity. There may be composition effects, time to learn so that productivity increases after some period in the job. We know, nevertheless, that especially in 2023, the majority of jobs in the euro area is being created in sectors that pay above average and that we classify as either technologically advanced or knowledge-intensive services sector jobs. So if this is the case, we need to be patient. These things do not happen instantaneously. We need to preserve the labor market conditions. And a few months ago, the previous president of the Australian Central Bank made a very interesting comment on monetary policy in Australia being able to preserve the progress made by the labor market in Australia. And I think we need to also, and I'm very clear about this, we need also to think about it in the euro area. Because it is with the labor market that we have to share part of the success that Europe had fighting inflation. And we need to design our policies to preserve this success. So yes, Philip, please go to the numbers with all our colleagues in the Eurosystem. There are very talented economists there. We need to get an answer to the productivity paradox that apparently we are facing, because firms are not charities. They don't create employment for the sake of creating employment. They don't hoard labor just for the sake of hoarding labor. We need to understand that better. And I'm sure that the numbers we see, both in terms of employment and wages, are compatible. So wage restraint in the labor area made it possible for employment to continue at these very high levels that we still see today. And on this last kilometer, well, look, inflation took more than 1 year to peak, 10.6% October 2022. It's at 2.4 now. It came down much faster than it went up. This is especially true for services. It is true that now we see a little bit of a stagnation in that disinflation process, but nevertheless, services inflation came down faster, and core as well, than it went up. So we need to understand that this is a convergence to a new equilibrium that we didn't have before. It is true that on occasion, as Ricardo was pointing out, inflation was close enough to 2% before COVID, but that was not the norm by then. And we need to understand that landing at 2% without creating a recession and without overshooting on the response from monetary policy side is not an easy task, and we need, by all means, not to undershoot. The inflation in our projection in 2024 will be below 2% already in the summer. Then it will fluctuate around 2 before stabilizing slightly below 2%. This is what we have in our forecast. And we cannot start breaking and easing the financial tightening when we are at 2, because there's a huge mass of impacts that will follow still because of the lag of monetary policy transmission, because the system will be still working under some degree of tightness, and we really risk doing more than it's needed in an economy that doesn't grow, doesn't invest, and I don't see how if we don't somehow adapt the policy trajectory to it, we'll deliver not even these meager results that we see today. Thank you, Catherine.
Thank you very much. So this brings the panel to a close. And I would like to thank very much all the panelists, and I'm sure that you're going to join me in thanking them, and see you later.
Central Bank of Ireland, and welcome to the fourth session of the conference, Monetary Policy Transmission through Non-Banks. The first paper will be presented by Ruggero Iapelli from Goethe University, Frankfurt, Quantitative Easing, the Repo Market and the Term Structure of Interest Rates. Please, the floor is yours.
Okay, so first of all, I would like to thank the organizers for the opportunity to present. This is joint work with Loriano Pellizzon and Marty Subramaniam. And in the paper, we are interested in the effects of monetary policy on both the yield curve as well as the market for securitized financing, so particularly the repo market. And now, there is a strong evidence that quantitative easing, both in the euro area and in the US, have clearly impacted the term structure of interest rates as well as the repo rates. So central banks bought a lot of bonds, and therefore they reduced the quantity of bonds that was available to market participants in order to cover their outstanding short selling positions. And in doing so, have induced scarcity of high-quality collateral, which has therefore resulted into high levels of repo specialness. So previous studies, so those are, by the way, strongly documented empirical patterns, have been considered in isolations. In this paper, we think of them in combination with each other. And so, particularly, we are going to consider bonds not only as investment opportunities, but also as collateral for overnight repo transactions. So, in doing so, we are building on literature on the effects of the quantitative easing on the term structure of interest rates, more generally quantitative policies, and particularly we are going to build on the framework by Vallanos and Villa. And we are also building on literature that considers another market for repo rates. I don't think I need to convince this audience that repo markets are actually the lifeblood of economic activities. So therefore, they're quite large, they're important, and there is a clear understanding that demand pressures affect repo rates, particularly in the context of quantitative easing. Now, the problem, so why are standard theories not able to deal with this evidence? In standard models of the term structure, we are used to assume that the short rate is unique, typically follows some exogenously specified stochastic process, and it's therefore exogenous to the quantities of bonds that are purchased by the central banks. So in this paper, we are going to develop a framework that is going to help us to think very clearly about the interactions of bond and repo markets along the yield curve. So just to cast our paper against the backdrop of the existing literature, so typically the bond market is represented through a yield curve that plots the duration of a bond against the yield of a bond. And at the very short end of the term structure, there is an overnight market for the short rate, which is akin in those models to a general collateral rate. General collateral rate, it's a rate that is used to collateralize repo transactions. Now, we are going to leverage. Think of, for example, the secured overnight financing rate. That is what most of you have in mind when thinking about term structure models. We are going to leverage a friction of the repo market that is its segmentation. So on the one hand, we have the so-called cash-driven transactions for general collateral, whereby market participants use bonds in order to collateralize their securitized loans. On the other hand, some transactions are so-called security-driven transactions, particularly, why so? Because market participants are willing to forego some of their returns in order to borrow the bond. So they really need the specific bond. And they are willing to forego some of the returns in order to get this bond. And particularly, they might be interested in this bond in order to meet pending short-selling commitments, et cetera, et cetera. So just to motivate it against the empirical evidence, we know that there is an entire cross-section of money market rates. The black solid line over here shows the interest rate on the general collateral bonds. On the other hand, we are also plotting the rate that applies to special collateral bonds, German bonds, for different time to maturity of the bond. And as you can see from this chart, there is an entire cross-section of money market rates, and particularly the repo specialness corresponds to the vertical distance between the general collateral interest rate and the special collateral interest rate. Okay, so for example, if I had a 10-year German bond during the sample considered, I would have been able to obtain financing at cheaper conditions. Why so? Because the bond was in high demand, perhaps because the quantity of collateral that was available in financial markets was shrinking, also in particular in a way that is connected to large-scale asset purchases by central banks. And in order to complement it with a little bit of empirical evidence coming from the BIS, I'm showing European specialness spreads just to comment on the magnitude, and as we can see, it's quite large. So particularly peaking at about 5.5 percentage points at times where interest rates were negative. So the magnitude of special repo rates in the Eurozone, I don't think I need to convince you, was quite large. And here we have the share of special volume for Germany that peaks at about 80% of collateral on special until coming down gradually after the introduction of the securities lending facility by the European Central Bank. That enabled market participants to borrow the bond against cash. So our results, our contribution, if you will, is to develop a first attempt of a quantity-driven term structure model which endogenizes the money market. So why do we care? We find in the paper that repo specialness strengthens the local supply effects of quantitative easing, relative price anomalies between bonds that have similar duration risk, and dampens the duration extraction channel of QE, which is the primarily intended goal of quantitative easing, to flatten the yield curve. So this is basically saying that dysfunctional money markets impair the transmission of quantitative easing to term premia. Well, how do we get to these conclusions? Let me show you a little bit, let me bring out a little bit of the flavor of the model. It's a model for riskless zero-coupon bonds that are indexed by their tenor, tau, and a status that is equal to general as opposed to special collateral. So particularly, general and special collateral bonds have totally equivalent cash flows, but their price might differ as a result of demand effects. So here, the definition of the yield to maturity, it's quite standard. It relates the yield to the log of the price of the bond, and there is an exogenously specified short rate. So that's a very classical setup. Okay? How do we think about the entire cross-section of money market rates in this context? We are going to solve for special repo rates endogenously. In order to do so, we are building on the preferred habitat view of the term structure, from which we actually depart by assuming that bonds are, there is a segmented demand for the bonds. So there are some bonds that are on special, that are targeted by preferred habitat investors. Those are special bonds. And there are some bonds that are, for example, bonds that are ineligible for QE, that are not directly targeted by preferred habitat investors. Okay, so it's a very simple structure. The demand has an elasticity, alpha to the log of price, and has an intercept that can be used, for example, to think of quantitative easing. arbitrageurs are going to connect prices over habitat segments. So particularly, they're going to smooth out price differences that are not compensated by risk. Therefore, markets need to clear in equilibrium. And they're taking the opposite side. So we think of the private sector of taking the opposite side of the central bank. They solve a mean variance problem that is outlined here. And what is particularly interesting about those arbitrageurs is that in order to short sell a bond that they do not own, they first need to reverse the bond on the repo market. Then they're going to sell the bond outright. And then they need to deliver the bond back in the repo market at termination of the repo agreement. So if you will, arbitrageurs are the modeling device in order to connect the bond and the money market, among which we know there exists a strong no arbitrage relationship. So we guess that the price is affine in the short rate, and conditionally on demand pressure, it's also affine in conditionally on the status. It's also affine in the demand pressure. What does it mean? It means that bonds that are directly targeted by QE respond, for example, QE eligible bonds respond directly to prices. As a result of demand pressure, bonds that have equivalent cash flows may trade at different prices. And if you just replace this equation over here, you can see very clearly that rearranging terms, this expression can be rephrased a little bit more compactly with the use of a dummy variable that is equal to 1 if the bond is on special and 0 otherwise. Coming to the equilibrium, well, we have equilibrium in two markets. So first, let me describe the equilibrium in the bond market. And as you are familiar with, the equilibrium requires the optimality in terms of the trade-off between risk and return. So in the equation above, as you can see, the excess return of a position over and above the repo rate must be equal to the compensation for duration, this AI over here, times the market price of short rate risk. Okay, so here comes our first important contribution. Since the expected returns of the bond is allowed to be bond specific, and the standard deviation of the bond is allowed to be bond specific, well, why don't we also have a short rate that is enabled to vary in the cross-section? So we also generalize a classical definition of Sharpe ratio in order to have a risk-free rate that responds endogenously to quantities. One other thing that I would like to highlight about this equation is that it jointly describes both the general term structure of interest rate as well as the term structure of special bonds, as you can see from the index I. Now, another important thing is about the duration extraction channel. So the market price of risk in this class of models, preferred habitat models, it's tied to the demand of preferred habitat investors. So particularly the holdings of arbitrageurs are going to influence how much they are willing to bear interest rate risk. And here, as you can see, the compensation for risk that is common to both general and special collateral bonds reflects the holdings both of general as well as of special collateral bonds, ensuring the transmission of quantitative easing to bonds that are not directly eligible for asset purchases. So when the duration risk of arbitrageurs goes down, the premium for shorting long bonds, remember that arbitrageurs take the opposite side of the preferred habitat investors, the risk premium goes down and therefore the term premium also goes down. So what's going on is a duration extraction channel. When the central bank buys a lot of bonds, it reduces the duration that is held in the portfolio of the private sector and compresses the compensation required for risk, and in doing so, the term premium. Now, another market that we consider very carefully is the repo market. So in the repo market, first on the axis, you're seeing repo specialness. If you recall the vertical distance between special and general collateral interest rates and the quantity of specific collateral on the x-axis. And the demand for special collateral that is exerted by arbitrageurs, it's completely inelastic. So why so? Because arbitrageurs have entered the commitment to deliver the bond on the buyback date of the repo contract. So therefore, they need, come what may, to borrow the bond in order to close the repo transaction. We also assume that the supply, as it is consistent with the data and with the approach, for example, of Duffy, the supply is upward sloping, reflecting structural frictions in the repo market. That is fairly intuitive. The size of the issue, it's bound. So therefore, in order to supply incremental units of the bond, market participants will require higher premium in terms of repo specialness. So crucially, the equilibrium is going to depend on how preferred habitat investors are going to behave in the repo market. So there are two scenarios that we consider. So the first, over here, preferred habitat investors are not lending their bonds on the repo market. In doing so, they have effectively generated an excess demand for the bond in the repo market that they are not willing to meet, offsetting the excess demand with the supply of those bonds. On the other hand, securities lending facility is shifting in parallel both the demand and the supply, and therefore it's able to reduce the level of specialness. Why so? Because the central bank is willing to take the opposite side of the arbitrageurs, not only on the bond market, but also on the repo market. Bond prices and repo rates, as we know, are connected by the following relationship. So the price is equal to the expectations of the discounted stream of interest rates in the future. And therefore, the price premium of special bonds, it's related to the present discounted value of the specialness going forward. Now, in the last 10 minutes or so, I would like to characterize the equilibrium and its dividends. So particularly, first, as a benchmark, let us consider a general equilibrium in the absence of securities lending facility. This corresponds to the Vaiano-Senvilla model that is published in Econometrica that you know very well, where there is a unique short rate and the coefficient B is constrained to be equal to 0. So therefore, there are no price differences between bonds that have equivalent cash flows. Now, if we actually generalize this concept to a two-market economy, we also consider and generate an entire cross-section of repo rates that responds to the quantities that are bought by the central bank or by preferred habitat investors and that are not lent on the money market. As a reflection, bond prices are going to have different. Bond prices are going to be different for bonds that have equivalent cash flows, in proportion to the elasticity of supply of collateral in the repo market that reflects structural frictions. So, for example, how much pension funds and insurance companies are willing to lend their bonds against incremental repo specialness premia. So, just to characterize the predictions of the model that are generated, think of conventional monetary policy. Now, there is growing evidence that repo specialness impairs the transmission of rate hikes to the bond and to the money market. What does it mean? That when the central bank hikes its rate, special collateral responds by a little bit less. So it's less responsive, and also the price of special bonds are less responsive to rate hikes. That is, in principle, not very easy to understand. Why wouldn't they just shift in parallel? Now, in our framework, that is quite naturally generated by the model, because special collateral interest rates respond not one-to-one to duration risk. And why so? When the central bank hikes its rate, the price of the special bond goes down, and therefore the demand of preferred habitat investors increase, also increasing its specialness. So it responds by less than one-to-one to conventional monetary policy. not only in the money market, so we are not only treating special collateral repo rates in the overnight repo market, but also special bonds have a comparatively lower duration risk. And so therefore they respond less along the yield curve to changes in the interest rate. Coming to quantitative easing, repo specialness, we show in the paper, dampens the effect of QE on the term premium. That is fairly intuitive, if you will. Why so? Because specialness is shrinking the holdings of the arbitrageurs. If the bond is now costly to borrow, arbitrageurs are going to be willing to borrow less of the bond, and therefore the extent to which the central bank is able to compress the duration of the portfolio of the private sector endogenously responds to the degree to which the central bank is willing to lend the bond in the money market. Okay. So quantitative easing is more effective when money markets are more functional. So there is no repo specialness. And that is fairly intuitive, because when specialness rises, ultimately repo specialness it's nothing but a limit to arbitrage. So therefore it discourages the activity of short selling. But what does short selling do to the duration of the portfolio of arbitrageurs? Well, short sellers are short the long bond and long the sequence of overnight repo rates. So short selling is an activity that has a negative duration. And therefore, if we limit short selling in the system, we are also increasing the duration that is held by private investors. And therefore, overall, there is an effect on the term premium that goes in the opposite direction of what is most of the times the main objective of QE, that is the one of compressing and flattening the yield curve. The first order condition of arbitrageurs, it's able to highlight a very interesting trade-off that is inherent in quantitative policies, so both quantitative easing and quantitative tightening. That is repo specialness for a given level of the interest rate is generating stronger local supply effects and a weaker duration extraction channel of QE, which results into a steeper yield curve. So that is fairly intuitive. So consider what happens if repo specialness increases. For a given level of interest rates, think of an economy that is at the zero lower bound. So two things can occur. Either the returns from short selling a bond must increase relative to the duration risk of the position, so mu relative to the A, the duration risk. That is entirely localized as a supply effect. Okay? So this means, for example, the bonds goes a lot on special, and that's entirely reflected in the price of the bond. At the opposite end of the spectrum, we have a transmission to the entire yield curve. So that results into a complete transmission into the market price of risk that steepens the entire yield curve. Now, this effect can be used by policymakers. So, for example, our paper would also recommend to policymakers that, for example, if the main objective is the one to compress the yield curve, then the bond should be lent out in the repo market. On the other hand, there are certain instances in which policymakers might be interested in generating local supply effects. For example, it was in the debate the idea of buying corporate green bonds. Well, if the transmission is perfect along the bonds that have equivalent cash flows, that's not going to ease the cost of financing for those corporations. On the other hand, if those bonds are not lent on the repo market, then a strong local supply effect is going to be generated and therefore it has a high potential into resulting into real effects for green firms and economic activity. So this trade-off, it's a very general concept that applies both to quantitative easing as well as to tightening policies. Now, to illustrate the mechanisms of the model, I'm going to present a qualitative calibration that shows and brings out a little bit of the flavor of the model. So particularly, we model two term structure of interest rates. The one of general collateral bonds, that is, for example, the one that is typically bootstrapped from derivatives, and a special term structure of interest rates, that is the one that is directly affected by central bank quantitative easing operations. Now, we can only do that by considering a repo market that is therefore dual to the cash market, whereby rates of special bonds are comparatively lower, therefore preventing arbitrage opportunities from being executable. Now, we also assume that there is a stronger level of local supply effects for the 10-year bonds, just to show how does it look like, local supply effects look like in our model. And our model generates strongly localized supply effects that are in line with what we observe in the data. For example, that are typical of financial markets, for example, for cheapest to deliver bonds, or for green bonds, or particularly for large-scale asset purchases. So the punchline of the slide is that repo specialness strengthens the local supply channel of quantitative easing, which is fairly intuitive. One other thing that this calibration enables us to understand is why policymakers would smooth their interventions across over time. So basically, in doing repeated interventions. Why so? Because the repo market reflects the quantity of collateral that is available on the market, and on the other hand, bond prices are forward-looking expectations of future interest rates going forward. So one other thing that we would like to highlight using this only qualitative calibration is that the effects of quantitative easing on the term premium crucially depend on the conditions in the money market. So particularly, we start an economy from the zero lower bound, and we consider what would happen if the central bank was willing to compress the yield curve. So we have a scenario in which the term premium goes down from 0.39 to 0.24, but the repo market is not, so money markets are not responding to asset purchases. On the other hand, we also consider a situation in which the repo market endogenously responds, so that QE creates repo specialness, as it is well documented in the empirical literature. Now, the term premium goes down by a little bit less, and it goes down by a lot more less if we consider an even more upward sloping supply curve of repo collateral. So in conclusion, in this paper, we have developed a new framework that will help us to think about the term structure and the money market that I would argue is intuitive. So bond scarcity increases local supply effects and dampens the duration extraction channel of QE, therefore constituting actually a threat to the primarily intended goal of quantitative easing of flattening the yield curve. Moreover, the framework is quite realistic, where specialness arises endogenously and increases in the short-selling behavior of arbitrageurs. The framework is tractable in admitting solutions in closed form, and therefore enabling us to perform counterfactual analysis. And it generates a rich set of policy implications, whereby monetary policy on the yield curve should always, we think, be considered in combination with monetary policy on the overnight repo markets. Another interesting implication for policymakers of our paper, before I conclude, is that they might want to induce long-term investors, such as, for example, pension funds and insurance companies, to lend their bonds on the repo market in order to increase the availability of high-quality collateral. And with that said, I would like to thank you and make room for the discussion. Thank you.
Thank you, Ruggero, for the presentation. Now, Rafet will discuss the paper. Thanks.
Thank you.
It's customary to thank organizers for the opportunity to discuss a paper and recommend that the audience read the paper. In this case, I will genuinely thank the organizers and tell you that you really should. And in fact, if you were looking at your cell phone, your laptop while the presentation was going on, you missed out. This is an awesome paper. It really is important, and you should know it. The big question here is, why on earth QE is working? Okay, it really goes back to that. And in particular, it relates to a whole bunch of deep questions in macrofinance in a coherent, consistent, tractable way. I have to tell you, this paper, it really is awesome. It's not easy reading. It's not bedtime reading. I tried and failed. But it's well worth reading. If you're interested in macrofinance, you really have to read this. If you're a policymaker thinking about QE or QT, you really have to read this. It relates to some age-old questions in a way I really was impressed. Some of these questions I had thought about, but I hadn't been able to articulate the questions as cleanly as done in this paper, let alone coming up with an answer to them. Okay, so it really is, that rare paper that makes you say, I'm very glad somebody took the time to think about this and write it up this way. Right? I only have very good things to say about it. In general, I like to whine in my discussions and say, I would have done it this other way. I don't think I'd be able to do this, actually. If I were, certainly not surpass this. Okay, so yeah. So now we have three issues in macrofinance that come and bite us every time we try to think about the term structure. One is the overall upward slope of the term structure, right? Because you look at this and say, it can't be that people expect interest rates to go up all the time. So there has to be something going on there, right? The second one is when you're looking at the movements of the term structure in a principal components way, the level overwhelmingly dominates. So the two ends of the yield curve move in the same direction, okay? And our macro models really hate this. Right? Because our macro models say, whatever happens today is going to die out soon, so the long end shouldn't be moving around. The macro model says the dominant factor has to be slope. And the yield curve says, well, it ain't. And we need to find a way of squaring these. And the third one is the question about supply effects, okay? And this has many guises in things like, if the treasury needs to borrow a lot and dumps a ton of securities on the market, will this have a price effect? Or if the central bank is withdrawing a ton of securities from the market in the form of QE, will this have an effect? And this paper talks about the supply curve being upward sloping because it's a finance paper. If you're a macro guy, you're going to think about the demand curve being downward sloping because these are all related through the macro finance researcher's bane of existence, consumption ChaMP. Consumption ChaMP is something that comes bundled in our standard macro models. Unless you do something to get rid of it, the moment you write down a consumption function, not a consumption, a utility function, right, it implies a marginal utility that the marginal utility prices everything, including securities. And that pricing kernel leaves no room for supply effects because it creates a flat demand curve, okay? Now, this we understand. So conceptually, QE shouldn't work because central bank is buying securities, selling securities. Who cares? As long as the marginal utilities are the same, pricing is going to be the same. Now, this was a big deal. And this is exactly why Vallanos Villa is such a rightly celebrated paper, because that's the one that went back to the 1950s and said, well, we had the toolkit to think about these supply effects, the downward sloping demand curve, right? But it was done in the 1950s fashion, so not sufficiently arbitrage-free, not sufficiently, chi-chi the way we want to do things now. But we can take that idea and put it into a framework that makes sense to us now, right? Okay. The issue with Vallanos Villa is it's predicated on the idea that, there are some people who like long-term stuff, some people who like short-term stuff. They don't talk to each other. Arbitrageurs have to do the talking through their transactions, and sometimes they can't, right? This is good, but it really sidesteps a whole bunch of really important issues that this paper brings to fore. In particular, even at the same maturities, we don't see all securities trading at the same price. That's it. If you ever try to fit a yield curve, this is exactly why you need a fitted smooth to the yield curve. Okay, right? Prices of nearby securities aren't as close as they are supposed to be. So somehow these are differentially priced, and that has major implications for the workings of the repo market. This is what this paper tackles head on and says, what happens in the bond market and what happens in the repo market has to be related because it's the same security is being traded. In particular, we shouldn't be thinking of a separate kind of risk pricing in the bond market and a separate kind of risk pricing in the repo market because the marginal trader is the same person, is the arbitrager. Okay. So effectively, this paper goes to number 3 and says, they call it the upward sloping supply curve. I'm going to call it the downward sloping demand curve, right? It creates this opportunity for pricing of quantities. Very good. So a synopsis of the paper that does injustice, but is clear because it's not easy reading again, is you think of a Vallanos Villa preferred habitat world, but the habitats aren't given by maturities, rather by securities. Okay? The moment you do that, you're now able to distinguish security 1 from security 2, regardless of whether they have the same maturity or not. A question not answered here is, why would you do that? And I think that's a really important question going forward. That is, what is it about this security that everybody wants this? Okay? I actually, in general, don't know it. We understand the answer is liquidity, of course. But that liquidity is endogenous. It's not that, this is more liquid because everybody wants it, right? Liquidity is an equilibrium object. Right? So once people coordinate on a particular security, it becomes more liquid. But this paper doesn't ask the question, why this security? Okay? It just says there is specialness. Some of these securities, right, people say, okay, we're going to do a collateralized transaction, just give me something. Right? That's general collateral. But every now and then they go, no, I want this security. Now, the paper takes as a fundamental that such securities exist. It doesn't answer the question why these securities are that way. That's an important question, right? But it does then relate the bond market behavior to the repo market specialness. That's the term. Okay? Specialness has a very clear measure. You fit a yield curve and you look at how far away from its predicted yield based on essential general collateral stuff a particular security is. The farther away it is, the more special it is, right? Good. Now, what this paper, in a policy-relevant way, goes through the jugular, is to say QE is a machinery that itself generates specialness, because the central bank comes in and buys some securities. The fact that it's picking those securities makes them special, and that's a problem. Because what you wanted to do was to flatten the yield curve, not to move some securities away from that yield curve. Okay? That's the idea. Notice that this is a separate issue from the downward sloping demand curve. The downward sloping demand curve is, if you are going in as the central bank and buying a whole bunch of a particular security, will you have any price effect to begin with? Because under consumption CAPM, you shouldn't. The next issue is, imagine that you do. Are you doing anything other than breaking the link between this security and the overall bond market? Okay? That's what this paper is about, and that's why it's so important. Now, here is a fitted yield curve with particular securities. What you can see here is that this is a yield curve that is fit on a well-functioning market day to general collateral stuff. Nonetheless, the 10-year always trades away from the yield curve. So the 10-year segment, not only the on-the-run 10-year, not only the first off-the-run 10-year, the 10-year segment of the yield curve is always repo special, is always away from the yield curve. Okay? So that's something that we actually need to understand. But one of the issues here is just comparing general collateral to special securities doesn't give you a good enough measure of specialness, because sometimes the entire general collateral is special enough. What one should do is to ask, compared to the swap curve, how do these trade? Okay? Because whenever you're looking at treasuries, you're always thinking about liquidity pricing. Right? To buy the treasury, you have to put up the money, and that creates liquidity pricing. It's also the case that sometimes this thing is all over the place. So what you can see here is, before the global financial crisis, the yield curve looked very nice and smooth. The circles are 10-year and similar issues. The diamonds are originally 30-year issues, the long-term stuff that the pension funds buy and hold. Okay? Now, these have different holders, and they may trade differently, but because of arbitrage, you see that they are at the same prices until Lehman happens. The moment Lehman hits, arbitrageurs go, we don't know what else is going on, we don't want anything to do with this, and then you end up with two separate yield curves. Okay? That's specialness, and that's a big-time specialness. And it's this kind of stuff that this paper is well situated to think about. Now, what happens? Okay, I told you this already. Here's something really nifty. In 2012, there's the date, June 7th, Sweden said, with interest rates this low, our pension funds have liabilities that are insanely long duration. And to do duration matching, they have to hold an inane amount of long-term securities, which is not good for them, not good for the market, not good for anything. Okay? So out of nowhere, the regulator came out and said, we're going to let the pension funds use an off-market higher interest rate to do duration calculation for their liabilities, effectively saying, okay, overnight, suddenly you have lower duration. Okay? What happened? All of these pension funds said, okay, we no longer need these long-term securities on the asset side. Now, consumption CAPM is going to say, and nothing happens. Okay? That is the single largest movement in the yield curve, long-term yields of the Swedish yield curve in history. Okay? So that's what this paper says. This actually happens. We're going to take that as given. The fact that those securities are these particular securities, somebody is buying and selling them, it does make a difference. Okay? So that's very good. Now, yeah, liquidity, good. Now, the issue that I'd like to bring to fore is that this is a finance paper on a macro finance question. And I wouldn't want them to change this paper, but going forward, I think one of the more important things is to ask, what does this look like in a macro framework? Okay? So if you actually had a utility function somewhere, if you actually had a policymaker somewhere, there was a Taylor rule governing the risk-free general collateral rate, would we actually have all of these things in a model consistent way? Or would we suddenly go back to the world of consumption CAPM where all of these results would die? Okay? That's not an easy thing to do, but this is not an easy paper to write either. So if they were able to do this, I'm hopeful that they're going to tackle the other question too. Now, the bit here that I'd like to whine a little bit about, because it's not a discussion if you don't whine about anything, is the following. I think the paper correctly notes that by doing QE on particular securities, you're going to create specialness. This I agree with. That specialness is going to work against your QE. That I'm going to agree with too. Their policy recommendation is have a securities lending facility, which several central banks, including the Fed, does have. And that's a good way of doing things. That I'm not entirely sure. And this is something that I may not correctly have understood correctly. But here's my issue. Think of what QE is. long-term securities go from the market to the central bank. Money goes from the central bank to the market. Now think about the securities lending facility. What happens? The same securities go from the central bank to the market. Money goes from the market to the central bank. OK, that's going to offset the specialness by offsetting the QE. So it's not very obvious to me that this way of dealing with the specialness problem is the desired way of doing so. What is very clear, and this is a very obvious policy implication of this paper, is that if you're going to do QE, do a broad-based QE. Don't pick too few securities, because you're going to pull them away from the curve and make the arbitrageurs' life difficult. And when their life is difficult, their risk pricing is going to be worse, and there isn't a separate risk pricing for specials and a different one for general collateral. It's the same risk pricing, and thus you're going to be working against yourself. Now you might ask, who would ever do targeted QE? And the answer is Australia. There is a lovely paper by David Luca and Jonathan Wright forthcoming in the Journal of Finance that observes Australia announced a particular QSIP, one particular security that they said, we're going to fix the price of this security. That's how we're going to implement QE. Okay? Among other things, what happens is, you can see that security out of the yield curve there. Okay? What you do is you create specialness and more or less nothing else. This paper is the theoretical foundation of why that happens and why that's bad. Okay? So it tells you that go for the broad-based QE so that you're moving the general collateral curve rather than creating specialness. Okay. Very good, very good, very good. So, yeah, I'd like to encourage the authors. This paper had more repo market language than I'd seen in a long time, which I admired. One term that wasn't there was repo fails. A repo fail is a repo contract is a collateralized lending when the borrower, the party who received the money, is willing to pay it back with interest, but the lender, the party who received the collateral, is unable to deliver the collateral. That's a repo fail. That's a big issue in the repo market. And in general, once it fails, it turns into a chain of repo fails because it's the same security that has been rehypothecated. Okay? This is a good framework to think about that. Not in this paper. It's convoluted and deep enough already. But as a next step, it would be great to have you think about, how does the specialness interact with repo fails? So let me conclude. Again, not out of courtesy or tradition dictating it, let me say that this really is a wonderful paper, and you really should think about this. It's a very well thought paper. It's actually, the presentation wasn't the easiest to follow, neither is the paper. But given the subtlety of the question and the difficulty of joint modeling of the repo market and the bond market, I think this is the cleanest way of doing it. So you really should take a look at this, because next time your policymakers are asking you questions about QE, QT, how it should be implemented, what it is working, why it is working, this is a great framework to think about those. Thank you very much.
Thank you. Ruggero, would you like to answer?
Oh, of course. I would like to thank you for the outstanding discussion. It was really a pleasure. Thank you very much. It was like so first of all, it clarifies the breadth of the discussant and the perspective that is coming from many, many years of experience with the yield curve. So I thank you for your valuable, we thank you for your valuable comments. Let me quickly address a couple of them, just really briefly. So one question that the paper does not directly target is, well, of course, why does specialness arises at first place? So liquidity, in principle, could be used to microfound preferences for specialness. Of course, another possibility would be quantitative easing. So central bank, we know actually central banks actually do create specialness, but I totally agree. I mean, you are right. It's something that we don't do explicitly in the paper, but it would be interesting to discuss. Particularly, one thing that our segmented markets enable us to do is to have a pure pricing of interest rate risk that goes a little bit in the direction of pricing with the interest rate swap curve. Which I hope we will be able to do a little bit more about in the future. And I thank you for these and other valuable comments. Particularly, it would be very interesting to incorporate a Taylor rule, which, I mean, I think it's a question to the entire term structure literature, so that I'm not sure, we would love to address entirely in the scope of the paper, but one quick way of incorporating this is through the long-run mean of the process for the short rate that could be influenced by the central bank, but I think this requires a more serious undertaking. With respect to repo fails and rehypothecation, I think that in practice, hypothecation it's less than perfect, so it's less than 1, and to this extent, our findings continue to work with rehypothecation. We haven't really considered repo fails, so it's an interesting extension of our paper for which I'm really grateful for pushing us in this direction. So thank you very much. I think it was like a great discussion, so let me just thank the discussant yeah, thank you. That's amazing, thanks.
We have now time for a few questions. As before, we'd like to ask you to stand up, say your name and your affiliation.
I can ask a question. I will not stand up. Ralph Meisenside, Federal Reserve Bank of Chicago. So I actually want to reiterate, Refat on the very end stole the point about the repo fails. I wanted to ask about this anyway. But so historically, repo fails happened big time when somebody managed to corner the market on one specific security, right? And that's kind of what made it special. You were asking where specialness is coming from, and that's like one way to think about it, that somebody figured out that there's too much short positions out there, cornered the market, forced the fail, made a ton of money. The one question, of course, is we had various repo market reforms, to what extent that has mitigated it. And then, of course, now what we perhaps care about is how would this interact with the standing repo facility that the Fed now has? Will this mitigate the issue? Is it sufficient to mitigate the issue or not? Again, next paper, perhaps together with repo fails more generally, and what a facility would look like that a central bank would have and how that relates to what we currently have built up.
That would be very interesting to explore in the future. Thanks.
Any question from the audience, or? Well, we'd like to thank you. I think it was a great paper. It's very dense, and I think it takes a very long time to read. Very much. In particular, we would like to thank Refat. I know that you're leaving now, so thank you. And now we're moving to the next paper. Ishil Erel from Ohio State University will present monetary policy transmission through online banks.
Well, hello everyone. I'm Ishil Erel. I'm from the Ohio State University, and I'm very excited to be here for the first time at ECB in Frankfurt, and to talk about my paper on monetary policy transmission through online banks. So this is a joint work with Jack Liberson from UC Irvine and also Konstantin Yanelius from Chicago. And last but not least, we have Sam Ernest. He was a pre-doc at Chicago. Now he's joining MIT as a PhD student. So let me be very upfront about two things. So I am saying monetary policy transmission, and there are many aspects of this that we have been discussing in the last 2 days. I will be focusing on the interest rate pass-through. That's what I will be focusing on. And also about the banks, online banks. Although the session title is non-banks, I will not be talking about non-banks. I will be talking about online banks. These will be regulated banks with only one branch, one administrative branch generally, and fully or mostly concentrating on their operations online, okay? So now that I put this, the far front of my presentation, you can take your after, lunch nap, and I will be talking about the paper. Again, interest rate pass-through is what we are focusing on, and it has been shown to be imperfect by many papers. And this is not a full list, but I will be talking about a few papers, mostly about Drexler and Coulter's, like talking about banks' market power on the deposit side. When the Fed funds rate changes, they do not reflect this on their deposit rates fully. This creates a spread between the Fed funds rate and the rates that the banks charge. And they talk about this deposit channel of the monetary policy. And Duffy and Krishnamurti talk about the sophistication of the customers. They talk about surge costs. They talk about the fact that sophisticated depositors actually end up switching to the money market funds or other investment opportunities, while banks are left with unsophisticated customers or depositors, and they don't really bother to change rates for them. Sharfstein and Sundaram talk about the market power on the other side, on the loan side, and they talk about the fact that banks do not reflect the changes on their loan rates as much because of this. And last but not least, the Kunta and Coulters talk about some human frictions that are complementary to all the effects that we have been discussing. They basically say that we assume that investors or customers or depositors will behave in a certain way, but they don't in real life, and that can complicate things as well. So what do we do in this paper? We argue that there should be some other factor that we should think about when we think about interest rate pass-through, and it's the effect of fintech, which has changed commercial banking tremendously, and we believe that it has the potential to impact monetary policy transmission. What am I talking about here? I'm talking about, as I said before, banks that fully or mostly operate online. They cater to different types of depositors, or they do their business in a different way. They certainly increase banking competition. They lower surge costs for customers because customers can basically move their money online very easily. And if you think about their business, perhaps instead of competing with traditional brick and mortar banks, they compete more with money market mutual funds. So in this paper, we ask this very simple question. How do online banks respond differently to monetary policy, to changes in the federal funds rate in the US? Of course, you can guess which empirical setting I'm using. I'm using the recent Federal Reserve rate hikes, which started in March of 2022. When it started, the rates were almost zero, and then over a year period till April 2023, the rates increased from 0 to 5%. So using a difference in differences approach, I will be comparing the response of online banks with the response of traditional brick and mortar banks to these changes in the Fed funds rate. I will look at the deposit rates. As I said before, I will be mostly concentrating on the interest rate pass-through, focusing on the deposits. But I will say something about also the deposit inflows and outflows. And also, I will go to the asset side in a very limited way and talk a little bit about the growth in the assets and the rates on the loans as well. In case I do not finish my presentation on time, let me give you a summary of my results. I find that online banks raise their rates more relative to the traditional banks. They respond to the changes in the Fed funds rate more than banks do. And we believe that's important because there's a huge growth in online banks, and that's why I'm talking here, arguing that regulators should care about this, or the policymakers should care about this. We find that a 100 basis points increase in the federal funds rate leads to about 22 to 35 basis points larger increase in the annual percentage yields for online banks relative to the brick and mortar banks. And as a result, not surprisingly, we see a deposit inflow coming into these online banks, more so than traditional banks. Actually, in traditional banks, we see the outflow. And we also find, and with limited data, I should say, that mortgages and auto loan rates of online banks are also more sensitive to these rate changes. OK. So in the interest of time, I will be very brief on the literature. There is a huge literature, as you know, on the monetary policy transmission, talking about different channels, using the supply of bank loans, bank capital, communication, perceptions, deposit market power, loan market power, as I already talked about. There are papers that talk about unconventional monetary policy. There is also huge literature on fintech, on the development of fintech lending, where I contribute to, actually, where the non-banks are big time, especially in the US, lending in the commercial loan market. We see increased competition in direct lending to not only commercial borrowers, but also consumers as well. And this, we believe, increases the access to finance. But again, in this paper, I'm not talking about non-banks, but I'm talking about regulated online banks. Focusing more on the literature that's more related to my paper, Wang and co-authors quantify the importance of some of the interest rate pass-through channels that I talk about, and I think they provide the importance of the deposit channel that we are being concentrating on. Kairong Zhao has a job market paper that looks at the monetary policy transmission through shadow banks. This is also related to these old papers showing the rigidity of bank deposit rates, going back to Hannan and Berger, 1991. Lately, with the failure of SVB, there is a huge literature growing looking at the run on the banks, and our paper is most related to the paper by Kuhn et al. And the co-authors. They show that the introduction of digital platforms, mobile apps, and they concentrate on the large banks with at least 300 reviews on their apps. They show that this reduced the franchise value of deposits. Actually, they show that this leads to an outflow of deposits from the banking system, while we will be showing inflows. OK. So online banking. I keep talking about online banking. I think I don't need to convince you that the importance of the online banking is out there, and some survey evidence shows that nearly 80% of the households use online banking services in 2019, and this is similar in Europe as well. But also 80% of these people still go to a bank branch as well. So bank branches are still important for traditional banks. But we know that online banking has grown dramatically. And what I will be showing you here is that if you look at my graph, that's showing you the total deposit growth for online banks with blue, and total deposit growth for brick and mortar banks in red dotted line. So if you look at this growth between 2001 and the current time period, you see that deposit growth for online banks is about 20x, while I'm talking about about 8x for traditional brick and mortar banks. And we know that when we go through the crisis periods, there is an inflow of deposits to the banking sector. So it's natural that some deposits flew into the traditional banking system. So we were expecting this growth, but the growth in online banking is much larger for sure. And naturally, popular press has been talking about online banks lately. As a researcher, I would like to see this appearing on the popular press as well. So this article is talking about LI or Goldman Sachs, Marcus, and also Capital One. They're all in our sample. OK. Our data will be coming from mainly RateWatch, where we see the deposit rates. But we will be augmenting it with various other data sources, call reports, and various other data sources. We will be concentrating on a set of savings accounts and certificates of deposits. Depending on the availability of data, we will be picking our certain products, but the results will be consistent across products. And I will be focusing on a year before and after the interest rate hikes. So how do we identify online banks? I should say this is a work in progress, and we have a new version of the paper with an extended sample. I didn't intentionally share it with my discussant because I hate it when it happens to me. It's just a week before the discussion, the sample changes, right? Basically, the results are the same. What we do is that we identify online banks using RateWatch or some prior literature. And today, I will be showing you results with 17 online banks. And here is the list. And usual suspects are there. This is all from the US, like Ally Bank, Exos Bank. Many of them will have 1 or 2 administrative branches. But you will see some of them, like Capital One or CIT Bank, will have more. And we will be just keeping them in the general sample, but dropping them for robustness. And here is my extended sample. This is the new version of the paper where we go to the call reports. Actually, we identify every bank with 1 administrative branch, and then we hand collect data on whether they operate fully online or not, which doubles up the sample, and the results are totally the same, very robust. So in terms of the theoretical work, we will be following closely the Drexler et al. Paper. If you are familiar with the paper, you would know that this is how they specify or they write the spread between the Fed funds rate and the deposit rates. M is the key here. M as a parameter represents the market power of the bank. What we basically argue is that M would be smaller for online banks. In other words, it would be frictionless to withdraw and transfer funds from them compared to the traditional banks in our sample. In other words, online bank depositors will be less sticky compared to the depositors of brick and mortar banks. Thus, we would expect online banks to adjust their deposit rates more than the traditional banks do. Okay, going into my empirical specification, I will, as I said, I will compare the rates that the online banks offer with the rates of the brick and mortar banks. And I will be utilizing a difference in differences specification around the shock. This is monthly data. On the left-hand side, I have the annual percentage yield. And I'm looking at the effect of the increased interest rate hikes that started in March of 2022. And then I will be also including month fixed effects and bank fixed effects. And everything I will be showing you will be corrected for clustering of observations at the bank level. And also, I will be looking at the total deposits. And in many specifications, I will be interacting my post-dummy with the federal funds rate to show you results, the economic significance of the results. OK, before I show you the regression results, let me show you some statistics to compare my brick and mortar banks, which is 4,000 banks in the US, with my 17 or 40, 30, 40 extended sample banks. So if you look at the numbers, you will see that the average brick and mortar bank is much smaller. I'm talking about $5 billion of assets versus about $66 billion of assets for online banks. They are certainly larger, and I will be thinking about that. And this is data from before the interest rate hikes, and you can still see that they offer much larger rates than the brick and mortar banks do. OK, so finally, before I show you the regression results, let me show you some figures. On the left, up here, you see the change in the federal funds rate. I'm looking at this interest rate hike from almost 0 to 5%. And then you see my different savings and certificates of deposit accounts. Again, with blue, you see the reaction of online banks. With red dotted line, you see the reaction of brick and mortar banks. Before the shock, they move very similarly to each other. After the shock, we see an increase in rates offered by both types of banks. But you can clearly see that the reaction of online banks is much larger than the reaction of brick and mortar banks, and this gap in reaction is increasing over time. And to do it in a more kosher way, here's my difference in difference specification, looking at the coefficient of the post-dummy here in the first panel, and then interacted with the federal funds rate in the second panel, looking at everything, showing you everything across different classes of deposit accounts, and you see the coefficients are all positive and statistically significant. If I want to talk about the economic significance, I'm talking about 22 to 35% basis points more increase for online banks compared to brick and mortar banks due to a 1% change in the Fed funds rate. I also want to show you the effect dynamically. This is the dynamic diff in diff, or event studies, to show you the parallel trends before, and also to show you how the effect is moving over time. Next, I will show you the coefficient beta with 95% confidence interval. As you see, again, I'm showing you the Fed funds rate here, and then the betas dynamically. The effect is just increasing over time. And the difference between the rates offered by online banks and brick and mortar banks eventually reaches to about 2%. If I do this deposit weighted, then the coefficient gets much more significant eventually, 2 to 2.5%, sometimes 3% difference. And in an extended sample, the economic significance increases as well. OK. So far I convince you that, hopefully I convince you that online banks respond differently in terms of their rates to the interest rate hikes. A natural consequence of this is that they should attract more depositors. And that's what we will be seeing as well. Actually, this is the figure I showed you in terms of their growth before. And you could see, actually, that they grow a lot. But I didn't talk about this. Like, after the shock, you see that the growth reverses for traditional banks, while it gets much steeper for the online banks. And you might be wondering why I'm not showing you anything about money market mutual funds, because that will be a natural comparison as well. Data is a big issue. Now I'm showing you some growth for the money market mutual funds, actually after the shock, using some quarterly data. And that's with the green dotted line here. As you see some of these deposits flying away from the traditional banks, they are going to the money market mutual funds, but not as fast as they flow into the online banks. So I've been showing you the huge growth in online banks deposits, but it's a little bit misleading, right? Like, because I'm not showing you I can see one of the comments, the total size of the online banking deposits. If I talk about the total size, actually with my small sample, it's about 5%. But with my extended sample, it will be increasing to 15%. And that's the results that the discussant has not seen yet. And here is the total size of the deposits for the brick and mortar banks. I'm talking about reaching to about $15 trillion here just before the interest rate hikes, and then losing like about $1 trillion afterwards, soon after that. And for online banks, the change in the deposits would be, in my small sample again, and this will be just like getting much larger with the extended sample, is about like $200 billion between 2019 quarter one to 2022 quarter one. And then it continues with the same magnitude over a year after the shock. Okay, just to put these in a regression setting, I'm running the same difference, diff and diff specification for total deposits here. And as you see, there's about like an additional $6 billion running into the online banks compared to the brick and mortar banks. And I was relieved to see that it's driven by interest-bearing deposits rather than non-interest-bearing deposits, because this is the part that they focus on. Okay, so far I showed you some results. These are important facts, but what about the mechanism? So what is driving this? You might be arguing that what I'm showing you is is just like perhaps a competitive effect. So it might be the case that online banking is much more competitive than an average traditional banking, and I might be capturing that. I will show you results against this. Or you might be just arguing that they might be having some better investment opportunities around that time, and that's why we see these different reactions, and I will be also showing some evidence against that. What we believe is going on, as I said before, like based on the framework that I also introduced, or borrowed from the Drexler et al. Paper, is that their depositors are simply different. We next question whether it's because of the demographics of these depositors, or there is something special about brick and mortar banks as well, meaning special about the relationships with their customers. And I will be arguing that it's not only the demographics, but no banking relationships would be driving some of this as well. Okay, let's look at some results for the mechanisms. So first, I will be talking about pass-through and the local bank competition. So with 17 or even like 40 banks in the US, it would be very hard to talk about actually competitive markets for online banks versus not. But I have many banks in my sample, and I can definitely concentrate on banks in more competitive markets versus banks in less competitive markets. And that's what I do actually here in the first two panels. I am comparing my online banks with banks that are operating in low competition areas versus high competition areas. And you might be arguing that online banks, where they operate, is not very clear, right? For that, we look at their advertising efforts and look at where they advertise, and also pinpoint to the areas where they focus and concentrate on only those areas in panel D and E. Most probably you cannot see these results, but results are similar across every cut based on competition. And we also have some results on competition using the deposit betas produced by Drexler and Toll paper, and no difference there either. In other words, what I'm trying to show you here is that pass-through is different for online banks, even in comparison with traditional banks in competitive markets. Moving to the demographics. Some of you might be using online banking. I assume you are younger and wealthier than a traditional bank customer. That's what the research shows, that more educated, younger, and wealthier customers prefer online banking. And it's really hard to rule out the fact that the customers of online banks are different, and that's driving the results. But what we do in the rest of the analysis in this part is just to try to see whether this is the only explanation or there's something else going on as well. Here, I'm running my regressions and including interactions with various characteristics of the customers. Unfortunately, we don't have great data at the customer level, and the only thing that we can do here is to use data on the characteristics of the people in certain zip codes that the banks operate. And that will be for my traditional banks. Here I'm looking at the characteristics of these people, like whether they have computer access or internet access, whether they are older or more educated at the zip code level where the banks have branches. And these interactions actually don't change my results at all, or including the interactions of these variables with my online dummy does not change my results. Furthermore, I also run the regressions by looking at, by concentrating only on traditional banks in zip codes of similar demographics to the online banks. and the results remain robust there as well. Moreover, it's more like a placebo test. Here, what I do is that I, instead of using online banks, I just like pick some banks, traditional banks, that operate in areas with similar characteristics to the online banking customers. And I don't see the results. So what am I learning here is that most likely online banks cater to different types of depositors, but it doesn't seem to be the only explanation for the results that I have. What we believe is that there is something unique about relationships through bank offices or cross-selling products or relationships that traditional banks create for customers on multiple dimensions. We tried to test this by looking at specialized online banks versus more generalized online banks. Specialized meaning that these online banks that sell only one type of product, they focus on only one type of product on their asset side, one type of commercial loan, for example, versus an online bank that focuses on multiple types of products. And I find that the results are much more stronger for the first category when the online banks are more specialized in the products that they offer. Moving on, we do various robustness tests, because these banks are larger than other banks. They might be younger than other banks. They might be offering higher rates to start with. So we match based on various characteristics that we talked about, and the results remain robust. We also run tests, just to see whether there's any difference in investment opportunities around that time that could be driving the differences between online banks and traditional banks. We look at their ROA in general or ROA in their credit card business or all loans, whether there is any change around any difference around the shock between the online banks and traditional banks, and we don't see any difference. Finally, before I move on to the last on the asset side, I also want to kind of say that we matched our banks based on the rates that they offer before the shock, in addition to their size and other characteristics to the traditional banks, and run our tests on a match sample instead of comparing 30 online banks with 4,000 commercial banks. Even in a match sample, I see a significantly larger reaction to the rate hikes of online banks compared to the traditional banks. Okay, in the interest of the time, I will skip the rest of the robustness tests, and I will talk a little bit about the comparison to the loan market. So online banks are obviously growing, and the effects of lowering search costs on the asset side is ambiguous. So it could be the case that more competition will push down the loan rates, or it could be the case that because they are offering higher rates to their depositors, they might be just charging higher rates to their borrowers as well. So we run some tests with only a few banks for which we have loan level data. In the extended sample, this increases from 3 banks to 6 banks. So please know this caveat about the loan results. But we see that there is some increase in the pass-through of the Fed funds rate changes onto the borrowers, onto the borrowers on the loan side, meaning that the online banks charge relatively larger rates on their borrowers compared to the traditional banks. So in other words, we find that monetary policy pass-through is greater among online banks for both loans and the deposit rates. This might create some distributional consequences because we see that savers benefit, and in this case, savers are wealthier, while the borrowers suffer, and would expect these borrowers less wealthy, younger borrowers on the asset side. Just to wrap up, because I'm out of time, hopefully I convinced you that online banks raise their deposits much more compared to the traditional banks, and we see the effect on the total deposits and loan rates as well. With that, I would like to thank you, and I'll leave the podium to my discussant.
Thank you, Shell. And now Ralph will discuss the paper.
Thank you very much. Thank you for having me and letting me discuss this very interesting paper. Even so, I have to ask the organizers next time, please don't let me follow Refet. He's impossible to follow as discussant. With that, let me first do the most important part. When you work at a central bank, say these are only your views and not those of your employer, meaning the Federal Reserve Bank of Chicago or anybody in the Federal Reserve System. So what you have seen, and Isabel did a fantastic job in summarizing the paper. So what's going on here? So first, we have a classification of online banks, which is not easy. I'll talk a little bit about this. And then we have data on rates of bank savings products. And then we look at, do these online banks have a different transmission of monetary policy to bank funding costs? With other words, what you have heard yesterday from Laura, right? It's about the beta here. This is about deposit betas. Now, let me briefly pause and say, it's like identifying an online bank isn't entirely easy, because yesterday Camelia showed you her app and she showed you all the funny things she can do on the app. But since she banks with Citibank, it's irrelevant what she does, because this is about banks without branches on a high level. Let's call them banks without branches. So all you can do is go online. That's the definition, and that's totally fine. That's consistent with what other people have done, for instance, in the mortgage market when they looked at fintech and said, like, well, you have to submit your whole application online, and that's our definition of a fintech. So there's a consistency here across the literature. Then we use the most recent monetary policy tightening and show that these interest rates on the saving products across actually all maturities increased much faster than the traditional brick and mortar banks. Also, we see that contrary with the brick and mortar banks that actually lost deposits on average, the online banks actually increased deposits. So they got an inflow. And that is actually really interesting, because that is exactly the opposite what you would expect otherwise, right? So this is, they're not behaving according to our standard our standard bank channel. That's something to note and to further explore in the future, how we should think about this, especially when the landscape is going to change and we get more and more of these online banks, whether this pattern will still hold up, or eventually, there's only so much deposit, so it might also go down. So, and then I call it suggestive evidence on path through to loan rates, simply because, as Ishel disclosed, thank you for being so honest, it's a small sample, but I think it's actually important evidence, and I will get back to why I think it's important evidence in a second. So let me just give you the two key findings here. So here's finding number one. You can see on the left the federal funds rate, on the right the savings products. In the right chart you see the blue line, the much faster increase in the rates paid by online banks relative to the red line, which are the brick and mortar banks. So you can see two things in the right-hand side chart. First, online banks are more sensitive even at the beginning of the tightening cycle, meaning they actually increase their rates earlier, and then they also increase it faster. So keep these two things in mind. The second thing is deposits, right? Traditional banks, left-hand side, lose out deposits. Online banks actually get fairly sharp inflows. Now, that means what? So why do we care about what's going on here? Well, the first thing is, if online banks are more sensitive to monetary policy changes, if they have a higher beta, then monetary policy could, in theory, become more potent through these online banks, right? The transmission to funding costs and eventually loan rates, which would then affect consumption, would be more potent. It would go faster, and it would be more potent. I think that faster is actually also important, because monetary policy, we all know, it operates with a lag, but perhaps now the lag time gets shortened, if that is in fact what is going on here. What's unclear, and that's something that's not really discussed in the paper, so I just want to mention it because, again, I work in a central bank and we care about financial stability implications, and I think there might be some, and it's not entirely clear which way it goes. In the following sense, right? If you have increased competition for funding and deposits, that could reduce the net interest margin in the whole system, and you already pointed to research that said that the deposit franchise value actually go down with the transition to to digital platforms, and that might be problematic. The other thing that could go on is like online banks could just have a different risk-taking channel of monetary policy, very much in the sense that they actually extend credit to riskier borrowers when brick-and-mortar banks pull back, and thereby offsetting part of this risk-taking channel or de-risking of these brick-and-mortar banks, which would be comparable to the effects of non-banks in these lending markets. So I have a paper with David Elliott at the Bank of England and other co-authors that document this for the US across various markets. And also yesterday, if you have been here in the introduction, there's also a paper here in the network that shows that the same is true in Denmark, where non-banks also substitute for banks more generally in monetary tightening. Okay, so now I want to, before I jump in with comments, I just want to raise the point that to fully understand what's going on here, we really, really have to think about what are these online banks actually doing. Now, I didn't copy the full list of banks because I didn't want to bore everybody to death, but let me just highlight a couple of banks that are in there. So one is CIT, that is actually a huge lease lender. It's not what you would think about your brick-and-mortar bank. They do lease financing for firms. They're highly specialized. They're good at what they're doing. There's Ally in the sample. Ally used to be GMAC. You remember that General Motors Acceptance Corporation that grew up during the financial crisis that was saved, incorporated as a bank, is now Ally. And why does that matter? I suspect that they might actually have an outsized presence in the auto loan market, and you can tell me whether that's true, because they inherited the network, the auto loan network from GMAC. So they might be very specialized, do something different, may have a different customer base. The last two that I briefly want to mention is there's E-Trade in there and Schwab, I think, in the new sample too, right? They are broker-dealers. So they're broker-dealers that also have a bank, so that you can have your savings in your checking account and then have a brokerage account. I have both at Schwab, so I can tell you this works fantastically. They do have branches only for the broker-dealer, not for the bank, but you can do banking in the broker-dealer branch. But that's fine. But the point is, they do something also very different. You see, like the theme that I'm kind of trying to get here is like what's lumped together here as online banks. There's a lot of heterogeneity, and I think everything Ishel has told us is very interesting. I just want to push for understanding more the business model, because I think that will tell us more about how monetary policy transmission is actually going to be affected. So the last one I'm going to mention is American Express and Discover, because they're credit card banks, which again are also going to be very, very different. Okay, so with that, now quibbling. Okay, so my first comment, and it goes into the same direction, what are these banks actually doing, is I was actually surprised, right? Because the competitor would be money market funds, and yes, the pass-through is still only half, right? The beta is still 0.5 by the end of the sample period and not 1. And if I go online and I search, somehow I must have a preference for a savings product. So it could be this FDIC insured, I'm not sure. But I couldn't understand why somebody would buy a 6-month CD for 2.5% if you can get 5% in a money market fund. So what is it that these online banks offer? So on the right-hand side, I put up a screenshot of late where all these online banks are, and currently they are very competitive with the money market funds. So they got there eventually, but they had a delay, and I would also just be interested in like what in their business model allows them to do this and getting these inflows, because you document these inflows. Then pre-trends. I mean, so here I'm going to be a little bit cheeky and say, well, at the zero lower bound, of course you're not going to find pre-trends, right? I mean, that would be hard to find. But note that the online banks always paid more, even a couple of basis points before. And I think that's an important observation, because that means that there's something going on in the business model that makes them either pay more for whatever reason, because they can, you name it, or there's some other feature. Perhaps there are new players in the market, and Christoph will tell you they want to cross-sell products later, and so they want to attract deposits now and create a relationship. or they are riskier banks and they just have to pay more for funding. Like, I can tell a couple of stories why that could be true, but again, linking back to the theme, I just want to know what these online banks are actually doing. Now, the deposits don't have a pre-trend, and I also wondered a little bit what they have a pre-trend. They have a very strange pre-trend in the sense that there was a lot of deposits flowing into the traditional banking system, that's the left-hand side, whereas the right-hand side was flat right before the raise. And why is that? How should we think about this? Like, one story I could tell is banks have a lot of deposits, they sit on ton of reserves, they don't know what to do with the money, and they don't raise deposit rates because, well, honestly, they want to get rid of some of these deposits. So perhaps their behavior is different because this is a special episode after QE, banks are flushed with liquidity. Maybe they were totally happy to run off these deposits. I don't think we can fully exclude it. That's a little bit of a problem with basically one tightening cycle. And whether we can generalize this is TBD. Okay, so now I want to highlight one thing more, and this is what beta is. So one thing that I would have done in the study, quite frankly, is I would drop all the GSIBs because they're special. I mean, JP Morgan Chase doesn't pay anything for deposits, right? I mean, just... In fact, when SVB failed, they got all the deposits, right? So there's clearly something special about these banks that have explicit guarantees, and their funding structure will be very different. And perhaps that would not be helpful. The second thing is my Dallas and New York Fed colleagues have this very nice working paper on dynamic betas, where they show that the betas actually depend on the level of the interest rate. And the argument is, very loosely speaking, a little bit like this. You know, when the federal funds rate moves 25 basis points and, you know, there's a spread of 25 basis points between the money market fund and your deposit account, you might not care. But with 150 basis points, you might start caring. So that means that the beta changes over the tightening cycle. And it could well be that there are different dynamic betas going on. So the current structure, the way it's estimated, cannot fully capture this. I understand this, but it might be useful to have a look at this paper and figure out how exactly the dynamism between these two differ, because it's also going to affect the relative effective duration of deposits between online banks and brick and mortar banks. And here comes the reference to also the paper yesterday presented by Lara, right? It's about, they have different duration gaps then, and that will depend on what their business models are going to be. Okay, so skip this. So here's another alternative explanation. So here's the bank I haven't picked on, Capital One. Capital One is focused on the high risk or higher risk borrowers. So you can imagine that online banks have a different customer base. It could be that they have these high-risk borrowers. Again, they could also be new and just get like the residual demand, and they're usually also not the greatest guys on the lending side, right? To be very clear, on the lending side. But what they have in their asset portfolio could make them riskier, and we know that riskier banks have to pay more. So suppose monetary policy tightening hits the borrowers of these online banks particularly hard. Default rates of these borrowers are expected to soar. These banks will run into trouble, and we know that banks that run into trouble, the first thing that they will do is they will raise deposit rates really fast. And they get an inflow of brokered deposits. That's the study by Martin Puri and Ouvier. And they can do this because they are at the FDIC, and they have the nice little detailed data to show you this. But that could then also explain the stronger transmission to consumer loan rates, in the sense that riskier borrowers, of course, their loan rates will go up faster in the tightening cycle as well, simply because. So this is just one alternative story, which again, I want to link back to my overall point. I think it's great that we have these facts. They're important facts, and I'm pushing for understanding better where the facts are coming from. What precisely is the business model of these banks, and how should we think about it in monetary policy transition? I have data quibbles that I'm going to skip simply because I'm out of time. I thought this is a very, very interesting paper. I think it's an important step in understanding the potential impact of the changes in the banking sector on monetary policy transmission. And now I would really also argue, because now you can do this, you have a new sample, to also look what happens around the SVB failure, because it will help you a little bit with the alternative story that I just tried to tell you. So also extending the sample, looking at the crisis around SVB might actually also be particularly useful for us to gain a better understanding what is going on in these online banks. And with that, thank you very much.
Thank you, Ralph. Would you like to address the comments?
Yeah, I will be very brief. Thank you so much. This is an excellent discussion. And I mean, this is our aim, right? Like, you know, to start thinking about these banks, you know, and that's why I'm here, right? You know, I'm just pointing out to the fact that there's a huge growth. We should care about them. And I don't claim that we fully understand their business model yet. So they are mostly consumer lending institutions, you know, auto loans, mortgages, and some securities as well. Different perhaps from banks that concentrate on commercial lending. And it's important to understand, you know, implications of this, you know, on the asset side. And we will definitely look at the SVB. All the comments are very well taken. I mean, now that we have a larger sample of online banks, 30, 40 rather than 17, we can do some cuts of that sample as well. Thank you so much. Everything is very well taken.
Thank you. Now we have time for questions from the floor, please.
Yeah, I find it super interesting, of course, to see that the no-branch banks have a higher deposit spread beta. Beyond the obvious point I have to make that they might be less interested in cross-selling, I was wondering whether maturity transformation might differ, right? DSS 21, banking on deposits, would make us think that they have a different deposit spread beta because the asset maturity is different, and I would think if they make auto loans, indeed, asset maturity might be different from those making mortgages. So it would be interesting to look at this and see if this is one other possible explanation and link it.
Definitely, and we thought about that, and we tried to kind of match based on that to the banks as well, and we don't see differences. I mean, we match based on rates, we match based on other characteristics. I mean, we believe there is definitely something special about like being fully online versus having a branch other than the structure of the banks, but we should definitely include more in the paper on that.
Maybe we collect the questions and then you answer all together. Yeah. So there was another in the same, and then Ans.
Yeah, thank you very much for this paper. It was very interesting. So my question is actually very related to the discussion, in the sense that there is this new paper from Tyler Muir, and probably, yeah, and so basically, UCLA Anderson, but you know it. So basically, they're saying exactly in that line that in their view, there exist two different groups of banks emerging. One is more low deposit rates, more securities. The other one is higher deposit rates and more loans. This was like the very shortcut. So I was wondering, how do you view your paper with respect to their paper? Have you tried to compare? I see that you do very carefully the matching over age and so on, but what about matching with their group of high deposit rate banks? Yeah, thank you.
There was another question there.
Hi, thanks. No, it's really following up on the discussion of whether it's because these are online banks or because they're different in other dimensions. I wonder if you've tried running some horse races, so you have the online interaction with post alongside like size and all these other characteristics, and see which one survives.
Any other questions? Please.
Oh, these are great comments. I already answered the first question about the Tyler Muir and Cotters. Yeah, we did actually match based on, they argue that the banks differ in terms of, I mean, some banks set higher rates than others. We match based on the rates as well, and the results are there. So I encourage them to think about this channel now, you know, now that we have our results matching, you know, the rates as well. And, you know, the interactions with other characteristics, the great idea. We did it for the demographics, but we didn't do for, you know, the other bank characteristics. And we we did many subsamples, based on rates, the age of the bank and the size of the bank. I mean, we kick out the large banks, at the end, instead of comparing only comparing to 4,000 banks, we match to 5 banks based on rates and size and other characteristics, and the results are there. There is definitely something special about these online banks, even controlling for other characteristics.
Okay, well, I would like to thank again the presenter and the discussant. We are now taking a short coffee break, and I'll see you later. Thank you.
We'll get it done. Fünf Leute kommen. So, ja. Hab schon auf dem Namensschild gelungen. So, bitteschön, Dankeschön. Wollen wir das Kabel unter dem Parkett verstecken? Ja, dann einmal kurz ausziehen. Das sollte halten, wenn ich jetzt nicht wild durch die Gegend schwebe. Vielleicht kurz das Parkett wegstecken, das Kabel und dann bis jetzt geklappt, wird auch weiterhin klappen. So, one of the next ones, what's your name, please? Yes, you're the chair of the session. We can do the same as your colleague. If you take off your jacket for a short, then we can hide the cable in the back. I will leave it here. Flip it on your side. You have to do it, yeah. Okay. Three are missing. Okay. Okay. Hello. I will do my best, of course. Of course, of course. Should be not really a problem, I think. So I will put this transmitter here in the background. Very soft and thin, yeah. Doesn't matter. So, okay, we tried like this. I hope it works, but I think that's okay. How do we know whether it works? Sorry? How do we know whether it works? We will know on stage. It will only work when you're up on stage. Okay? That's to you. Ne? Der Karadi und Andreoli. Die zwei brauche ich noch. Da kann man schon was zusammenreimen. Ja. Muss jetzt hin, ja. Na gut, wir haben noch einen Moment Zeit. Was ist das? Halten gleich fest, nicht, dass er weiter rennt. Hello, sir. Hi, possible to take off the
So good afternoon. My name is Maria Valderrama. I'm from the Österreichische Nationalbank, and I'm also one of the coordinators of the ChaMP network. Let me welcome you to the last session of business cycle monetary policy and long-run effects. We have two very interesting papers. The first one will be presented by Mihaela Elsbacher-Schmöller and discussed by Paloma Lopez Garcia. Mihaela, you have 30 minutes. The floor is yours. Please start. And the paper is The Recession Slow Technology Growth, Evidence from the Firm Level.
Yeah, so thank you very much for the kind introduction and in general for putting the paper onto the program. And this is joint work together with Olga Golfan-Frank and Tobias Schmidt from Bundesbank. And before I get started, the usual disclaimer applies that these are strictly our own views. Yeah, so to motivate this line of research, so I mean, if you look into the drivers of technology growth, if you look into the insights from endogenous growth theory, it's well established that the main driver of long-run growth is technology growth, and in turn, its main determinant is investment in innovation. However, if you look into how we typically in the standard workhouse models of cyclical fluctuations treat technology dynamics, is that we, in almost all cases, abstract from modeling technology dynamics endogenously in general equilibrium. And what technology usually means is that we model it in the form of a shock, of an AR1 process, which implies that, that technology is generally exogenous in these frameworks. And, but at the same time, it also is an important driver of TFP, this technology shock, but we don't really know what is behind it and what it means. And while this is a very wide assumption, it also has very substantial implications. So one point is that cyclical fluctuations do not influence, and this is by assumption, innovation and technology dynamics, and ultimately the dynamics of total factor productivity. And what this means is that business cycles are usually a short-term phenomenon, basically with a strict dichotomy between cycle and trend directly baked into the frameworks. What this paper does, we ask basically one key question, and this is, do firms cut their investment in innovation in a recession? And if you look into, when you look into the insights from the previous literature, and that typically the pro-cyclicality of innovation investment on the aggregate and of total factor productivity on the aggregate is well established. And there are also frameworks which incorporate the possibility of persistent effects of recessions through a drop in technology enhancing investments, talking, for instance, about the medium-term business cycles framework by Common and Gertler. And there's also increasing evidence that from aggregate time series that contractionary demand shocks have an impact on innovation dynamics and on TFP. However, with this main mechanism being that an economic contraction weighs on the incentive to invest in innovation because it decreases firm profits and the expected benefit from innovating. And this lowers innovation, investment, and technology growth. However, this is partially also tentative evidence because it's on aggregated data and on theory. And the challenges in general in the microdata is both identification and data availability when you look into, for instance, firm-level data. Now, what we do in this paper, we present firm-level evidence on the innovation investment patterns by firms in a crisis using a novel granular data set. And we should also, from a theoretical side, we're also employing our theoretical framework, which shows from an aggregate perspective the persistent effects of these shocks. And so in case I'm running out of time, I want to show the three main results from this paper quickly already in the beginning. So what we do is we estimate an elasticity between the crisis impact and the respective adjustment on the innovation investment side. So we show that firms which were adversely hit by the crisis are significantly more likely to cut their innovation investment, and we distinguish here between frontier innovation, R&D, and technological diffusion, which we view as other innovation investment, which is not meant to be R&D, but still meant to generate innovation from the viewpoint of the firm. And since we also have a cyclical measure of the crisis-induced output drop at the firm level, this permits us to estimate these elasticities at the firm level. And what we show is that for firms which cut their investment, we see a 1% cyclical output drop, which translates in 0.27% decrease in R&D investment and 0.3% cut in diffusion investment. And then we also go into the concrete patterns of the firm-level innovation adjustment patterns using the firm-level data. And we show that at the extensive margin, we see a drop in innovation expenditures relative to pre-crisis plans, because in the data we can identify both realized and pre-crisis planned investment. And we see on the extensive margin a cut in R&D investment in 25% of the firms and a cut in technological diffusion investment in 20% of the firms. At the intensive margin, This means like the cut that each firm on average undertakes compared to pre-crisis plans are very substantial and equal to -65% for R&D and -70% for diffusion activities. And I mean, if you want to put a number on it, this translates into large and economically substantial cuts, which means for R&D on average 750,000 euros per firm, and for diffusion nearly about 1 million. And what is also new to this data set is that we at the same time can identify the main underlying driving shocks, which means, and we show in this context, that in particular also demand shocks play a key role. And from that angle, I mean, if you look into how we typically think of technology in the New Keynesian model, we also, and what identifying assumption we make in the New Keynesian model usually is that from the viewpoint of this research, we suggest that short-run fluctuations do have an impact on innovation and aggregate supply over at least the medium term. So, and if, for instance, like we can also show the role of expectations in this context, and if a firm expects issues with demand in the near future, then the probability to cut the innovation investment increases by 10 percentage points. And as we will see, this is a big marginal effect. We also show the role of financial frictions in this context, but mainly as an amplification mechanism. And since we will see that in the specific crisis episode that we have at disposal, financial frictions were not the key mechanism here. We typically view the estimates that I just showed as a lower bound in this context. But for instance, if you talk about a financial crisis, you may expect substantial amplification mechanisms basically kicking in through the financial frictions. Yeah, so I will skip through the previous literature, but just set the scenes a little bit on what episodes I'm talking about and what the aggregate statistics, basically the key main series, look like in this context. So we have basically here, and I want to add, I'm talking about a firm level data set, which is about Germany. Basically, and we talk about the adjustment period during the COVID episode in 2020. And as you can see here from the real GDP side, this meant a substantial drop in real GDP, which is no news, but it also meant was associated with a very profound drop in business R&D investment at the same time. So this is what's going on in the aggregate. And now I'm jumping into what the firm level data set looks like that we're using here. So it's a large representative sample of firms, which is representative across sectors and size categories. And it's part of the Bundesbank online panel of firms. It's a representative monthly survey of firms in Germany. So this survey is undertaken regularly. And on top of that, we have fielded in our own innovation model, which covers in total 5,500 firms. And in which we asked firms in 2021 in the third quarter retrospectively for the episode of 2020. I mean, this is the episode that I'm focusing on today in any case. And as I said, we have the full distribution of firms across sizes, size categories and sectors. And this is important to emphasize because it's not only about manufacturing firms and not only about big firms, but across the firm distribution. And this gives us a granular and unique joint firm-level information on the following points. So whereas some other surveys may be able to capture some of the elements separately, there's no other survey which can study this jointly. So first of all, we have information on frontier innovation, on R&D, and non-frontier innovation, which we defer to as diffusion or technological adoption. And what we can do is we can identify the crisis-induced adjustment at the firm level. So we have the realized investment and we have the pre-crisis plans. And taking this together, we can identify the cyclical crisis-induced downward adjustment for each of the firms we have in the sample. And we have information for both for the reasons for adjustment and for non-adjustment, which means we can give a detailed information, a detailed mapping on the underlying driving shocks which we have in this at the firm level. And importantly, especially when thinking about elasticities, we also can measure the crisis-induced drop in production or in business activity at the firm level. In other words, we have a measure on the crisis exposure on each of the firms in the sample. And in addition, we can use the detailed firm level characteristics and from a general firm level characteristic view, but we also have detailed information on financing, on financial frictions, as well as of the firm's expectations, both about their own expectations, about the firm level specific outlook, but also about the macroeconomic outlook. And yeah, so I will just show right away one of the main results here. So what we show here is the estimation result in which we map the crisis exposure and the innovation investment cuts together. So if you look into, for instance, the first column, we see here the role that a crisis-induced drop in production and business activity has, basically 0,1. And what we see here, that a firm which observes a crisis-induced drop in business activity is 11.6% more likely to undertake a cut in innovation investment. And if you compare it to technological diffusion, as you can see here in column 5, the same measure is basically 8.5%. So on the extensive margin, so whether a firm adjusts or not, we see a stronger adjustment on the R&D side. And in general, a pronounced role of the basically of the crisis exposure variable, which is in both cases about half of the mean of the adjustment. And yeah, so we can also basically use estimate direct elasticities of linking the crisis-induced production or business activity drop and the respective magnitude of the downward adjustment in % relative to plans for both innovation margins. And here we see that for the case of R&D, if a firm adjusts and like each percentage point in the drop in business activity at the firm level translates into an estimate of 15.8, and for technological diffusion in 12. So this is these are the estimates of the elasticities respectively. Oh no, sorry, I'm in the wrong one. So in general, you have to look into column. Sorry for correction. You have to look into the column 3 and 7 here. So if you the interpretation goes as follows: if you have a 1% drop of business activity in a firm which had plans for R&D and decided to adjust, it translates into a 0.27 percentage cut in R&D investment. And for diffusion, this is relatively stronger pronounced, as you can see here, as basically a 1% drop in business activity translates into a cut in diffusion investment of 0.3. So there's a stronger adjustment margin on the intensive side for adoption versus R&D. And yeah, so to give a overview on the patterns across firms, like how this how firms respectively adjust their innovation investment. And what we see for R&D is that already, like looking into column 2, what you see here is that for firms that did not plan any investment, very few started. So this is about less than a percentage point, basically, that we're talking about. So all of the adjustment that you see on the innovation side occurs on the intensive margin. And as we see in the sample, so about 17% of the firms kept their investment unchanged, 25% decreased, and 6% increased. But as we will see later, the average adjustment on the increasing side is very small, whereas the innovation cuts are very pronounced, which gives us, on average, in the sample, very pronounced tendency towards cutting innovation investment. And for technological diffusion, I mean, there's similar patterns on the extensive margins. So very few firms started to invest in diffusion activities in response to the crisis, and about 20% cut their innovation investment, and about 4.6% increased. And well, you may also want to ask those firms which did not undertake any adjustment in response to the crisis to their innovation investment, what were the reasons for it? So we also have very detailed information on that margin. And as we can see here, if you go to the firms and ask them why they kept everything as it was planned before the crisis, you see that 46% of the firms say they report that they did not experience a sufficiently strong change in their own economic conditions, which would have necessitated such a change. And in other words, that means they were not hit by an adverse shock. Then we can also back out the role of financial frictions of financial resources in that context, because another 33% say that while their economic situation has changed, meaning that they had experienced an adverse shock, they had sufficient financial means to smoothen out that shock. And again, then if you take together those firms which did not adjust because of sticky investment, we have about 10% which would have adjusted either up or down, but this is really small in comparison to the other reasons that we have here. And again, here we're showing basically this, I won't go through this in detail, but just to quickly summarize the main points here. We can basically compute the average decrease for each firm and for each margin of innovation. And as you can see here, the adjustments are economically substantial, giving you an average adjustment for R&D of 750,000 euros, and for technological diffusion about 950,000. And as you can see also for both margins, the increases are very small, weighed out by very pronounced cuts to innovation investment, which leaves us that the increases are very negligible in magnitude compared to the cuts in innovation investment. And importantly also to relate it to the aggregates of what we document here in the survey is about minus 9% average adjustment in R&D, which we can bring together to the, which we will show are very close to the adjustment we actually see in business R&D investment in the aggregate, which is about, compared to pre-crisis trend, about minus 10%. So these figures are very close also when you aggregate them up to the aggregate dynamics. Now, again, here we show the downward adjustment relative to plans, so on the intensive margin. So as you can see, for both R&D in the first table and for technological diffusion, we see that firms are obviously, as firms vary across size categories and other characteristics, the firms are heterogeneous in plans, and they're also heterogeneous in the extent of their innovation cuts. But on average, we have a mean adjustment in R&D of minus 65% and on average of minus 70 for technological diffusion activities. And importantly, we can also look into the reasons and to the shocks that firms report why they undertook this downward adjustment. Basically, we ask those firms which did undertake changes in their innovation investment, what were the reasons for it? And as we can see here, first of all, the pattern for both types of shocks is that in a way, one direct observation is that both margins are driven by similar driving shocks. And what we see is, and this is not surprising because it concerns the COVID episode, is also that the increase in uncertainty, as in any recession, mattered a lot for the downward adjustment patterns. And importantly, also from the viewpoint of the new Keynesian models, that demand is one of the most important categories which have been mentioned by the firms as an important driving factor of this adjustment pattern in innovation. We also see, to a minor extent, a role for supply chain disruptions and the innovation investment cuts. And this goes in the direction of the long-run scars of supply shock story, and this, as for instance, also raised by the paper by Fornaro and Wolf. And what we see is that the COVID policy restrictions, we have a separate category for that as well, contributed to the adjustment of innovation investment, but negatively. So at least for the sample of Germany, we do not see the pattern which was flagged in the beginning of the pandemic of innovating yourself out of the pandemic. And crucially, from the viewpoint of financial frictions, what we see is that basically financial frictions were very rarely a reason for the firms. And this is, in our view, an evidence of non-binding financial frictions. And this also has to be viewed in connection to the specific episode and the policy support, which was basically characterized by large-scale direct transfers to the firm level and through basically direct fiscal transfers to firms in a rather timely manner, as well as large-scale guarantee schemes and similar measures, which taken together means several things. First of all, like if you had seen amplification from the financial side, we would also have expected a much stronger downward adjustment than the one that I just documented, which means that we interpret our results in that context as a lower bound for how it could be, for instance, in a financial crisis. Now, and in general here we decompose basically the share of firms which said that they experienced the demand shock, and this was the important, the central driving factor in the innovation choice and the reason to cut innovation investment, and vis-a-vis those firms which simultaneously also stated that they were suffering from financial constraints. And this is interesting from that angle because, I mean, we have seen a similar pattern also for the Great Recession, but there often it's not clear whether it's demand or it's the role of financial frictions. But our results speak in favor that even a demand shock in its own, even without the propagations through the financial side, can lead to this pro-cyclical adjustment in innovation, and through that, through the spillover to technology growth and at least medium-term aggregate supply. And again, it also suggests that the presence of financial frictions in turn can act as a substantial amplification mechanism to amplify the transmission from demand shocks to longer-term aggregate supply. And so lastly, we also using here the role of expectations. Because as I said, we have detailed information of what firms expected at the time they were undertaking these adjustments. And so we have expectations about whether they expect to have demand problems within the next half year starting from now, or whether they expect to be subject to financing problems. And what we see here is that a firm which expects a demand problem over the next 6 months is 10% more likely to decrease investment in R&D, and 7.6% more likely to undertake cuts in the diffusion margin. And if a firm expects financing problems, so even if in that sample that we're showing, we do not we do not see a direct role for financial frictions. If we do see that if a firm expects financing problems going forward, they cut innovation investment. So we do see this role of financial frictions. We just also see that in this very specific episode, they just were not the main mechanism. And so I'll skip that, and in the last 5 minutes or so that I have, we still quickly also show what we do on the theory side. So we also basically to bring together the patterns we see in the firm level and bring it to the aggregate dynamics. We also work with a New Keynesian DSG model, which has endogenous investment in innovation and technology growth, and it's features endogenous TFP growth, basically using the Common and Gertler mechanism, and meaning that we have horizontal innovation through expanding varieties in intermediate goods. And we have 2 margins of technology growth. First of all, we have an R&D sector, which determines the technological frontier. And on top of that, we have an endogenous diffusion process through costly technology adoption investment. And otherwise, we have use a medium-scale DSG model set up in the spirit of Cristiano and Smets 2005, and Smets and Wouters 2007. So we have cargo price and wage rigidities. We have investment adjustment costs, and monetary policy is simply modeled in the form of a monetary policy rule. And here I'm focusing for the sake of time on the transmission of the demand shock, and what we see here is we compare basically a model with endogenous technology, with endogenous innovation in the blue line, with a model with exogenous technology growth, as is typically the case in the New Keynesian environment. And what we can see here is that whereas in the standard New Keynesian model, you eventually revert to your initial output path, this is not the case, at least not instantaneously, under endogenous growth. And because from here, a demand shock also depresses the expected future profits from a new innovation, from an intermediate good production line, and through that, based on R&D investment and on technological diffusion investment, and through that you have a persistent effect on potential output and the longer term aggregate supply over at least the medium term. And yeah, so here we still also show a bit the role of the crisis that we're talking about, because I guess we can all agree that the dynamics for the Great Recession are differently in terms of persistence and so on compared to the COVID episode. And here we basically compare V-shape versus L-shape recession, and what we see here is a potential amplification in case the shock in itself is long-lived, and also an amplification through the supply side, through the cut in innovation investment. Now, we also, of course, since we have information on firm size and sectors, we also can show the sector specifics here and the role of firm size. But as you can see, I mean, whereas of course we see substantially, to some extent, a more pronounced adjustment in the services side, but all in all, it's a rather balanced adjustment across different sectors. And in general, I mean, smaller firms are more likely, for instance, to be also financially constrained. So as you can see in the lower panel, it's not a surprise that smaller firms on average adjust more. But then, of course, thinking about aggregate TFP dynamics, so about aggregate investment, of course, manufacturing also has a bigger role in innovation activities more generally. And also larger firms contribute more, so it's not clear ex ante whether the mechanism is more importantly operating through one sector or the other, or through one size category or the other. And yeah, so I think we have more additional results coming up as well, but I think it's time to conclude for the time being. And yeah, so what we do is we show micro-level evidence in favor that firms cut investment in technology in a recession. We document a fall both in frontier innovation, R&D, and non-frontier innovation and technological diffusion, and through that document a slowdown in technology growth at the firm level. We show that the respective cuts are substantial, about 65% versus for R&D and 70% for adoption. We view this as firm-level empirical evidence in favor that short-run fluctuations, including demand shifts, transmit to innovation and hence to medium aggregate supply, or at least medium-term aggregate supply. And we view this as evidence in favor of substantial implications also for macroeconomic modeling and policy, which first of all means that, as we can see, that policy support work to alleviate financial constraints and also towards alleviated degree of innovation investment cuts, which suggests that stabilization policies can also have a role in preventing the persistent effects of recessions. And more broadly, that the strict division of cycle and trend, this dichotomy, which is underlying many of the models we're using, such as the New Keynesian model, may be treated with care in that context, and especially like the potential, the concept of the potential output and gap measures we typically employ. That's all I have at this point. Thanks.
Thank you, Mihaela. Just on time, perfectly on time. And Paloma, you have 15 minutes.
Okay. Can you hear me, everybody? So, good afternoon, everybody. Thank you very much to the organizers for having me in the program today. Thank you to Michaela for the excellent paper. Always a pleasure reading her. Thank you to all of you for being here. I mean, this is the last mile or last kilometer of the of the conference, and you made it. Good for you. So, I mean, we'll do our best to wake you up and make it together in the last mile. So, in my discussion, I'm going to start not by summarizing the paper, because Michaela did a great job in really putting together all the main results of the paper. So I'm going to tell you my main takeaways. And then I'm going to talk about a couple of major points that I had while reading the paper, which I know is still ongoing progress, and maybe they can be taken on board for the revised version of the paper. So first of all, this is a paper that contributes to the strand of literature that shows that short-term shocks, demand shocks, can have long-term implications. And this is a very important literature. There is part of it that looks at the scarring impacts of the crisis on the labor market, and then there is another strand of literature that looks at the impact of demand shocks on investment in innovation, TFP growth, and therefore on long-term growth. Now, this paper has a very cool empirical part that is based on survey data from Germany, from a representative sample of firms in Germany that answer questions about planned investment in innovation and then executed investment in innovation, which is really a very cool way of identifying what is the impact of the crisis on the decisions of the firms, optimal decisions of the firms in terms of R&D and technology adoption. One thing that I found really interesting also of the survey results was that it shows that expectations about future demand shocks are also playing a very important role in terms of the investment decisions of the firms on innovation. So it's not only the current demand shock that we are suffering, and this is making firms rethinking about their optimal strategy in terms of investment in innovation, but it's also the expectation in terms of demand or financial constraints. And then, as you saw, the availability of finance is really a mitigating factor for the negative impact of the demand shock on the decisions of investment in innovation. There is a sizable share of firms that say, I am affected by the shock, but I'm not going to change my investment decisions because I have sufficient finance. There is also an interesting result which says it's a very small share of firms that say the major driver of the decrease in investment in innovation is the lack of finance. Actually, the most important factor is uncertainty, and then is the drop in demand. Now, the thing that I really like the most of this survey is that it asks not only about investment on R&D, but also investment on technology adoption. And why is this very, very important? Diego is here, so I'm saying something that he knows and you all know. But investment in R&D is really concentrated on few firms. I have here a table from the EU Industrial R&D Investment Scoreboard, and it says that basically the 10% top investors in R&D concentrate 70% of the investment in R&D. So really, the aggregate impact of innovation is going to depend very much also on how this innovation is spreading through the economy. And this is going to depend on how firms are adapting or adopting the new innovations into their production processes. And we know, there is a lot of evidence on that this technology diffusion is actually slowing down in Europe, and this is one of the causes of the very poor TFP growth that we are experiencing. I'm showing here a chart that is defining technology diffusion as the gap between TFP growth of frontier firms who are actually doing the R&D and laggard firms, here defined as the median firm in the sector. And you can see that above all in services, this gap is increasing over time. So technology diffusion is slowing, so anything that helps us really understanding why this is the case, and above all, what is the impact of shocks on technology diffusion, and not only on investment R&D, is really welcome. Now, this is the slide on questions on the survey. And my main question is, how representative is the COVID-induced crisis in terms of crisis? So can we really generalize the findings of this survey? And I'm asking this because there are three characteristics of the COVID-induced crisis that could be driving some of the results of the survey, and they are really not general to other crises. The first one is that the COVID was really the first time we all experienced a pandemic. There was a lot of uncertainty. We had no idea when the vaccination was coming in, when we were going to be able to return to work, when we were going to be able to return to our normal life. So maybe that's why uncertainty plays such a really big role in the changing plans in the corporate sector, and maybe that's also why expectations have such a big impact, in my opinion, on the investment plans of the firms. The second characteristic, which is really not normal in terms of previous crises, of the COVID-induced crisis, was the very generous and huge and widespread liquidity support to the corporate sector. And maybe this is what is driving the relatively small role of financial constraints in the results of the survey. The third characteristic is actually firms needed to invest in technology adoption during the crisis, because they needed to adopt all these technologies to increase the connectivity between the firms and the workers in order to enable teleworking. Okay, and there is therefore a very counterintuitive result that Michaela didn't show, that says that during the crisis there was a substantial share of firms that increased investment in technology adoption. So this is my main point. How can we, or can we really generalize these results to other crises? Then I have two very small points. One of them relates to the fact that the survey finds that the decrease in investment in innovation is similar both in manufacturing and in services. And I was a bit puzzled with this result because, of course, at least in 2020, manufacturing firms were much less affected by the shock than services firms. But then I thought, services is including many different types of activities. On the one hand, we have the contact-intensive services, and on the other hand, we have health services. The contact-intensive services maybe suffered a big decrease in investment plans, but the health services had to increase the investment in innovation. So maybe if we could disentangle these different types of services, we could get a better view on the sector differential impact of the shock. And this is not really talking to the objective of the paper, this is talking to my own worries and questions. My question is whether we could use the survey results to really understand better what makes certain firms invest in technology adoption and other firms optimally not invest in technology adoption. I think it's really important that we better understand why technology is diffusing so slow in the economy. Now, let me move to the model. So the mechanism at work in the model is that a transitory demand shock is going to lower expected payoff of the R&D and the technology adoption relative to the cost of the investment. And this is turning investment in innovation and technology adoption pro-cyclical. It's going to reduce GFP growth permanently, and it's going to turn the long-term GDP growth is going to make it below or go below the pre-crisis trend. While reading this paper, I was thinking that there is an alternative mechanism that could actually work and could deliver certainly some different results under certain assumptions. And this is what we call the opportunity cost theory. This theory was very much discussed in a paper by St. Paul in 1997, also Guillaume et al. In 2008. And it is based on the fact that firms have limited resources, and they have to decide whether to invest these resources on current production or on future production. And to increase future production, you have to invest in productivity-enhancing activities. And in the theory, the cost of this investment in productivity-enhancing activities basically is foregone output today. So what happens is that when there is a transitory demand shock, this is going to reduce the opportunity cost of productivity-enhancing activities, because what I'm going to get from my production today is going to go down because my sales are going down. Therefore, the foregone output of investing for the future is going to go down. So optimally, the firms are going to decide to increase the share of R&D in total investment. So it turns counter-cyclical. But the theory goes firms might need external finance to finance the productivity enhancing activities. And if my current revenues are going down, my ability to borrow might go down as well. And this means that the share of R&D investment is going to turn pro-cyclical for credit-constrained firms. So in this model, if you want, it's very, very important that there are limited resources, that firms sometimes have to go to external finance to finance the investment in innovation, and the cyclical position of the economy is going to condition that. So from here, I have 3 questions, because if I understood it correctly, in the model, we don't see how firms are actually financing the investment. There is nothing talks to that. And so far, and I'm sure that this will be included in the future, there are no financial constraints. So I was thinking maybe we can model access to external finance as a function of the collateral of the firm, and this would mean that small firms have more difficulties in accessing this external finance, which is talking to the survey results. We also could bring a role for monetary policy in the paper in order to stabilize and to help going through the crisis. The other question I had is, what is the relative cost of the different types of investment? Is investment in R&D more expensive than investment in technology adoption? Does it make a difference? Does this make a difference? And the last part is what happens with the other investments on fixed assets? Is there any kind of substitution? So my main comment here in the model is we have to understand how the investment is financed and whether all firms can finance the investment without constraints. And I think that if you include that in the model, it could really deliver interesting dynamics. And I'm going to leave it here. Thank you very much.
So, Mihaela, do you want to respond to Paloma?
Sure. Before I forget it, so thank you very much for reading the paper and for the very important comments. So maybe I'll start actually backward, because that I have fresh in my memory. So about the model. So again, like whether firms adjust upward or downward, I mean, in the survey, we see it clearly. We have some firms which may have experienced actually also a positive shock, because I mean, as we know, there was an unbalanced crisis altogether. So we do see some evidence of upward adjustment, but first of all, both in the extensive margin, how many firms adjust, and also how much they adjust on average. The tendency, no, it's not tendency, so the evidence clearly goes into negative. So on average, as we've seen, like 750,000 for R&D, and this clearly outweighs the respective increases, which are very minor. So the aggregate downward adjustment in response to the crisis is clearly negative. This is also why in the model we consider mechanisms which are consistent with the data, what we find, because I mean, what we see in the data is clearly the pro-cyclical pattern for R&D investment and for technological diffusion. So this is why we also have used a model which captures that. So basically, the role of the model is to work out the aggregate dynamics and to speak a little bit about the role for macro modeling and so on. And in that sense, it's also not completely new, because I mean, there are other frameworks who have worked with this mechanism before, but I mean, we want to bring it in the context of the macro dynamics here. But I mean, in a way, I mean, also between these alternative mechanisms, which would give a counter-cyclical response of TFP, so we see.
So of investment in R&D relative to total investment. So that means that the R&D is going to decrease less than other investment. It could decrease, but less than other investment of the share.
But that's
maybe it was not clear.
But that's not really the question we're answering here. So we're focusing on technology enhancing investment only. And then about the role of financial constraints, I mean, we could think of a model which would have maybe an ad hoc financial friction in there, and then we would get an amplification of the demand shock. I mean, we can think of ways of doing this. What else? Oh, about the role of monetary policy. I mean, in this framework, even in the absence of financial frictions, you do have a role for monetary policy, and that comes also through the demand side, basically through the breakdown of long-run non-neutrality in this setting. Then about COVID, to what extent this is generalizable? Well, I mean, this is understandable how one might think that way, because I mean the crisis is perceived as very exceptional in many ways, but then kind of most crises are when they arise. So this is a cheap way of responding to it. But I mean, first of all, about the role of uncertainty, I mean, that's the nice part about this survey, that we can actually account for expectations, and we can also put a number on it, what they expect. So this is some way we can even control for in the estimates that I have shown. And we have very detailed information also on the liquidity support, which we can use in the estimates. And in general, with respect to the increase, I just said, like, we also see some firms which increased, but again on aggregate, and also for each of the firms that adjust, it's a small margin, it's small compared to the decreases. And actually with manufacturing, and this is actually a good point that you brought it up, because in the new version of the paper, we're also adding a little bit the context of the crisis. And there I want to emphasize that in 2020, actually, manufacturing dropped a lot in Germany. So this is comparable to the extent during the Great Recession. So from that angle, it's not so surprising that we see a lot of adjustment also in manufacturing. And in general, I mean, talking about aggregate implications, you see a bigger role than in the end also how manufacturing contributes to aggregate innovation investment. So I'm not sure if I now responded to everything, but if not, then we talk about it later. Thank you very much again.
Okay, so that gives us time for, I think, for questions. I think Diego was first, and for the online audience, just say who you are, because they don't see you.
Diego Comín from Dartmouth College. I would like to first comment on one comment that Paloma made in her excellent discussion about this opportunity cost. The reason why you get this possibility of counter-cyclical R&D is because, you know, the cyclicality of the cost of doing R&D is greater than the cost of the benefits from doing R&D, which is the profits in the models. Of course, in the data, that's not the case. Wages are are not very procyclical, and profits are extremely procyclical. So the models underestimate the procyclicality of the of profits and overestimate the cyclicality of wages. And that's why you get the reverse result of what you see in the data, which is that R&D is very procyclical. So I would like to push back against that way of thinking. On the paper, I think it's very interesting. Many years ago, I looked at the Mannheim Innovation Survey, and there, like, you have a measure of innovations that are new to the firm but not new to the markets, which is basically like you're bringing things that exist out there. And that was also very procyclical in the time of the Great Recession. I would like to echo Paloma's comments about the abnormality of COVID. You know, together with some co-authors of the World Bank, we have been looking at the adoption of specific technologies during COVID in various countries. And what we have found is that actually COVID fostered the adoption of those technologies, especially in companies that already had some preconditions to continue adopting technologies, and then COVID hit, and they were the first ones to adopt. So you know, probably this is not the best time in the world to draw conclusions about these channels that can be generalized to other periods.
Here, another question. Here.
Thank you for a very nice presentation, Philipp Hartmann, ECB. 3 points. So first of all, you didn't talk much about your theoretical model, more about the empirical results, but you know that in the times of continuous structural change that we face like now, how important I find your work to combine endogenous growth work with new Keynesian work, which allows us to overcome a bit too drastic separation between business cycles and growth in such situations where we have continuous growth, continuous structural change going on. And actually, we had a discussion this morning about the potential extensions of the new Keynesian climate model, and actually that extension would be on top of my list. Why? Because a huge influential factor on the climate transition is the innovation gap. And so I do think that that has to be an inherent part of the different paths that we can have in the climate transition, and therefore in that model would be very useful, I believe, to add these features that you have. Second point, so as several people have said, so I looked at your graph from the German recessions. There are three. There's the dot-com one, early 2000s, there's the great financial crisis, and there's the COVID. So they're all special, not only the COVID, they're all very special. So arguably the first one had a lot to do with the technology bubble, actually, among other things. The second with very peculiar financial developments, and the last was just discussed, very peculiar in other respects. So that makes me think that thinking about the innovation developments, it may not, given that the data are that they are, the recessions are that they are, actually one would want to complement that research with a more continuous view on investment and innovation and growth, because you actually, there are so few, 3 only since 28 years or something like that, and then each of them is very special. So we need to complement that with a more continuous view, also in the up and in the downside. And if you think about that, I don't know whether it was mentioned on the COVID one, there was also some sectors that had a huge innovation boom, like for the peculiarity of the crisis. Now, I realize that that may not be the end of the story in the aggregate, of course, with many shutdowns, but still, it was a recession where there were some sectors that had historical innovation booms, and that enters also the picture for this other view on recessions that we know since earlier of the 20th century about, like a more Schumpeterian view. So that I would find very useful to include. I'm not saying that the recessions we're talking about are Schumpeterian, and actually they prepared the ground for the future prosperity necessarily, but it has to be on the radar screen. Last point on the more current developments. If you look at the recession in Germany after the dot-com bubble, then arguably an overinvestment in certain technologies, or an overinvestment, don't know, financial, real, I'm not sure, the proportions, may have been part of the picture. And if you look at the stock markets today, then you see that most of the booms in the stock market, these illogical booms, is driven by the Magnificent Seven companies in the US and so-called granolas in Europe, which are all these technology firms around digitalization, AI, and so on. So there's a distinct risk also of, there could be a backlash, like if there was a correction of this and innovation, that this investment innovation enthusiasm, we could have a downward factor coming in the current situation. So again, I do think it would be valuable to include these possibilities in the kind of modeling and empirical analysis. But thank you, very nice paper.
We are out of time, Philip, but I would like to allow for one question more. Here, yeah, Dimitri.
Sorry, I'll try and be quick. It's just in terms of longer horizon responses, because COVID was a V-shaped recession, so the economy recovered quickly. But I wonder for your R&D, did it bounce back or maybe even overshoot afterwards to compensate for the initial decline?
Okay. One question here.
Quickly, so much of the innovation literature has been about the extent to which a firm can overtake an incumbent and promote innovation that way. With your data, could you actually document a little bit, like, is it the small firms, the more incumbents, to what extent you see that these recessions are leading to more creative destruction, I guess, but just more generally, what happens to patterns of competition and who's doing the R&D or not? Because one might think that that would, something that you can actually do with your data that would be very informative.
Okay, there are no other questions. Did you write all the questions there?
I hope so. So yeah. Thank you very much for all of the questions and comments. So we can look, for instance, I mean, one thing we can do, we can also look into the plans and then kind of give a bit of an anatomy of the landscape of the innovators across both margins. That could be one. Then about yours, we have the data also following 21, 22, 23. This is what we're currently doing, documenting this on the firm level to think of the patterns you had in mind. Then about Diego's comment. So actually we should look into what you were referring to, and what we also be related to what you said. So we also do see some firms which increased. This may be, for instance, those that you were referring to as well. But it's, again, like on the aggregate, the share of those which downward adjusted and then also the magnitude they adjusted outweighs the other patterns. I'm not saying that there's no evidence at all in favor of this channel in our data either. And actually with the Mannheim Innovation Survey, we're looking now also, so we also have that data and we're showing it over a longer period of time, also to link it, for instance, to the magnitude and the deviation of plans versus investment during the Great Recession, and this also links it a bit to Philip's comment. So we're showing, and currently updated, we're currently updating the paper, and in this one we're also showing, comparing the magnitude and the deviation of plans versus adjustments compared to previous crisis episodes in Germany. I mean, it's a model and also an exercise of it's not really a paper on firm dynamics of entry versus exit, but again, like in most adjustment we see is on the intensive margin of investment here as well. And about the role of climate and endogenous growth in a new Keynesian framework, so this would be an interesting angle, and we have at some point also discussed this to incorporate for these channels where usually the trend or innovation part is basically fixed and exogenous. And yeah, so I mean, Schumpeterian dynamics is not something we can do with this data set, but this is something, another important mechanism.
Okay.
Yeah, thank you very much.
Thank you very much. So now the floor is yours, Michele. You have 30 minutes minus 4. No, you reset. So, and the discussion will be done by Peter Carradi.
Okay, thank you very much. Thanks to the organizer for including our paper, and thanks for everybody to come to the last session on Friday afternoon. So what am I going to present today? Non-essential business cycle. This is joint work with Paolo Surico, who's in the audience and is still from LBS, and Natalie Rickard, who is from LBS, and she's a PhD student, and she will be on the market the coming year. Okay, so what do we do in this paper? In this paper, we try to see whether the split between essential and non-essential can amplify business cycle and can drive distributional consequences of business cycle. So let's fix ideas. What is a non-essential? A non-essential is a consumption good or a service whose share increases as you become richer. An example could be eating at a restaurant. As people become richer, they devote a higher consumption share to do that. A non-essential is something which is the opposite, like grocery shopping or utilities. The definition is that the income elasticity of demand is greater than 1 for an essential. Now, let me motivate the paper with 4 facts. The first fact is an angle curve. So what I'm showing you here in this graph is across earning decile in the US economy, the proportion of non-essential consumption share. Now, the first thing might not surprise you, and almost by definition, as people become richer, they consume a higher share of non-essential. What I think is more interesting from this graph is that non-essential consumption is something which is broad-based in the US economy. Starting from the poorest household to the richest household, we see that everybody consumes a substantial amount of non-essential consumption. The second fact is the flip side of this, but rather than on consumption, on the labor market. Again, here I'm showing you across earnings decile in the US economy, whether people work in essential or in non-essential. And here we see the opposite pattern. Poorer households are more likely to work in non-essential than richer households. An example could be servers at restaurants who are relatively poorer, and they work in non-essential. Now, these are 2 cross-sectional facts, and then I'm going to give you a time series one. This shows you the path of consumption and labor earnings following a start of an MBR-dated recession. In orange, and I'm going to use orange throughout the talk for this, I'm showing you non-essential. Consumption in the first panel, and labor earnings in the second. In green, I'm showing you the counterpart for essential. What do we see? When a recession hits, households cut their non-essential consumption a lot, by more than 3% following 1 year from the beginning of the recession, and they cut much less their essential consumption. And we see the same pattern, even more striking, on labor earnings. Households who produce non-essential, they see their labor earning decline by about 2.5% after 2 years, whereas we see much muted effects for people who produce essentials. And now, given these 3 facts, I can give you the paper in 1 slide. It's 5 p.m., it's almost 8 p.m., so I hope I will get your attention throughout the talk, but if you want to remember 1 slide from the paper, on the presentation, it should be this one. Okay, so let's say that there is a recession, maybe because of a monetary policy shock, which lowers household income. We know, and we show, that people cut their non-essential consumption. Why? Because non-essential is easier to anticipate or to postpone in the face of economic adversity. Now, why does this matter? Because this can affect poor people in 2 ways. First, as rich people substitute away from non-essential toward essential, the relative price of essential increases, and because poor households mainly consume essential, this makes them poorer. But also, and more importantly, as people cut non-essential, the firms who hire workers in non-essential will cut their labor demand, and the earning of people who work in non-essential will fall. And as we know that this is mainly poor people, this is going to drive the earnings of low-income workers down. An example is when there is a recession, people don't go to the restaurant anymore. Who loses their job? Servers who are relatively poorer. Now, why do we care for amplification? Well, we care about that because poorer households in general have higher MPC. And then because they have higher MPC, they further cut their aggregate spending, and then this lowers aggregate demand, and then this lowers household income, and then we have a cycle, a non-essential business cycle. That's the paper. However, remember I promised you 4 facts and only gave you 3 so far. And the last fact is a time series application of non-essential consumption share. What I'm showing you here is the non-essential consumption share built with a chain consumption index from the 60s until the recent period. And you might not have seen this before. It might not be surprising to see that as the economy became richer, the share of non-essential consumption has increased. Or in the structural transformation, people have shown it, but not with this data, possibly. However, the point here is that if you believe the story that I'm going to tell you today, the channel is going to likely become more important. So amplification to this channel of business cycle might become stronger. And with this, I can summarize what we do in this paper and what our contribution. We have 3 separate ones. The first is a data one. We build macro time series at monthly frequency for essential and non-essential, starting from microdata. We build this from consumption, prices, labor earnings, and as the project progresses, we're going to make this available to other researchers. We are going to use this time series to identify this new channel of business cycle amplification. And the story is what I just told you. People don't cut non-essential in a recession. These hurts poor households. We work mainly non-essential, and because they have high MPC, this creates amplification. Now, as a first step, we show this when we model monetary policy shock. I think this is important for an audience at the ECB. But however, we don't really tie our hand to the fact of this being only a monetary policy transmission, but we think this as a broader business cycle amplification. So we also show that this channel is present with main business cycle shocks. And then finally, we use the intuition that non-essential are easier to anticipate and postpone, meaning the interaction between the income elasticity of a good and the intertemporal elasticity of the same good to build the model. In this model, this is a 2-agent New Keynesian model where we add on top non-homothetic preferences and labor market heterogeneity. We use the model to quantify our channel and also to show when non-homotheticity matters for amplification and when it does not. What we show is that if it does not interact with relevant heterogeneity, such as in the representative agent New Keynesian model, non-homotheticity will not matter for amplification. OK, so let's dive into the meat of the paper. I will skip the literature for sake of time and go directly into measurement. Now, we want to create this time series for essential and non-essential, consumption, prices, and labor earnings. So the first thing that we need to do is we need to classify whether consumption categories are essential or non-essential. And the definition is a good is a non-essential if the income elasticity of demand is greater than 1. How do we do that? We run angle curves on CX data, and then we can create a classification of consumption categories. An example of essential is food at home or utilities. An example of non-essential is food away from home, like going to the restaurant. With this classification, we then map this and we merge this to PCE data in order to create a time series of consumption, quantity, and prices for essential and non-essential. What we show is that 36% of expenditure are essential, 44% are non-essential, and 20% is left unclassified, where we cannot classify things like banking services, where we don't have good data on the CX. Now, we have now consumption data, but we also get labor market classification. And for this, we need to classify both final sectors and intermediate producing sectors. Now, if you work in a final producing sector, like you work in a restaurant, it's easy to classify whether you are a worker who sells essential or non-essential, but it becomes harder if you work in an intermediate producing sector. To classify those sectors, we take the input-output matrix from the BEA, we run a Leontief inverse, and so we see whether downstream an intermediate sector mainly sells toward essential or non-essential. With this classification, we then merge this to the CPS data and build essential and non-essential employment and earnings. In our data, we have 62% of employments, which is non-essential, 30% which is essential, and 8% which is unclassified. OK, so this is how we create our data set. What do we do with this? We look first at a monetary policy shock. In this case, as our baseline, we use the Gertel and Karadi shock. Then we also show robustness to the Yerochinsky and Karadi shock in a robustness check. In our baseline, we take this shock, we run the same proxy var, and then we extract the monetary policy, the structural monetary policy shock in an approach that Paul has used in another paper. Then we use the structural monetary policy shock in a smooth local projection IV done by Barnichon and Browlis. What does this do? Well, we instrument a change in the one-year rate, and we have some outcome variables that we care about, let's say consumption of essential or non-essential, and the smooth part simply goes in between LP and the VAR, but we can interpret them as local projection results. And we try to use our standard control, and we try to maximize our sample whenever possible. So we start from 73 for consumption, 76 for employment, 78 for pricing, 82 for earnings. However, crucially, in our baseline exercise, we cut our sample before COVID. Why? Because in COVID, the government did lockdowns, which basically forced people to not be able to consume non-essentials, and we don't want to contaminate our results from government's lockdown. If we include COVID, the results become even stronger. OK, so this is the empirical approach. What do we find? Here, I'm showing you the effect of a 1% increase in interest rate on consumption. And for now, I want you to focus on the blue lines, which are the outcome, which are the impulse response function from the LP. Now, I guess many people in this room will have run the regression on the first panel. This is the aggregate response of consumption to a 1% increase in interest rate. Consumption falls by about 0.6, 0.7% after 2 to 3 years. Now, this is something that many of you have seen already, but this is not our contribution. Our contribution is what is under the red square. And here we split between essential and non-essential consumption. What we see is that people cut their essential consumption much less than the aggregate one. Essential consumption declines only about 0.3 or 0.4% following 2 years after the shock, whereas non-essential consumption declines much more, by about 0.8 or 0.9. If you wonder whether the difference between these two impulse response functions is statistically different from 0, well, this is the last panel here where we plot the ratio, and the ratio becomes negative at minus 0.5 and is clearly different from 0. I told you to focus on the blue line, which is the empirical LP, but you can see also some red line in the background. Well, I will not have time to discuss how we do model estimation, but these are the impulse response functions from our structural model where we can match the empirical one. And this is the first result on consumption. But then we also have one result, and we think it's an even more striking result, on labor earnings. Following a 1% increase in interest rate, labor earnings declined by about 3.5% after 3 to 4 years following the shock. Now, there is aggregate effect masks a huge heterogeneity. If you work in producing essential goods and services, you really are not affected by a monetary policy shock. There is no statistically different from zero effect on the labor earning of people who produce essential. All of the effect goes through non-essential, where these people lose about 5% of their labor earnings 3 years after the shock. And clearly, the ratio between these two is different from zero and negative. What I showed you until now, though, are only aggregate results. What we want to dive into next is, what about heterogeneity? Who is losing their job? Who is losing their labor earnings? And to do this, we dive into the heterogeneity across earning deciles. OK, the first fact, which is what I showed at the beginning of the presentation, is that poorer households are more likely to work and produce non-essential than richer households, and this is in the cross-section. What about in the time series? Here I'm showing you always the same effect of a 1% increase in interest rate, but rather than showing you a full impulse response function, I'm cutting the horizon at 3 years after the shock, and I'm contrasting how rich you are, from poorer households to richer households, for those who work in essential and non-essential. The first result is that if you work in producing essential, there is a mildly negative, but not statistically different from zero effect on your labor earnings. And crucially, this does not change throughout the income distribution. Whether you're rich or poor, you lose a little bit of your labor earnings, but really not much. On the other hand, we see a huge heterogeneity on non-essentials. If you're a richer household who produces non-essential, you don't really see a decline in your labor earnings. All of this decline that we saw in the aggregate is coming from poorer households who produce non-essential. Again, an example might be servers to fix ideas. And this may be one possible explanation for counter-cyclical income inequality. Why do we see higher inequality in recession? Well, because it's those people who are losing their job. This result is robust. We try to include the information effect for monetary policy. We look at broader business cycle shocks to argue that this is not only a monetary policy transmission channel, but this is an amplification of business cycle more broadly. We try to see whether other consumption categories can confound, and we don't find evidence. We run with alternative sample, with alternative econometric methodologies, but overall, these results carries through. Next, I want to show you a model to rationalize what we found. And the idea of the model is, let's take a two-agents new Keynesian model and add two new ingredients. The first one, because we are talking about essential and non-essential, is non-homothetic preferences. Our non-homothetic preferences are very similar, are very simple, and where people like to consume essential, they like to consume non-essential, and they have a CRRA utility on essential and non-essential. Crucially, our important assumption, these are additive, and they don't like to work. Now, with this preference, but more generally for any separately additive preference, we have that the good with a higher intertemporal elasticity substitution is also a luxury, or a non-essential. What's the intuition here? As long as I go on vacation, I really don't care when I go. So this is easier to anticipate and postpone than an essential. I really want to eat and have grocery shopping and have my house which is warm or cold in the summer, and I don't really want to shift this intertemporally. And so we are using this intuition to bring this to the intertemporal elasticity substitution, which is clearly a very important parameter in new Keynesian model. And this is a general result which was proved by Browning and Crossley for any separately additive utility function. Our function here just makes it very easy and very transparent. And then in addition to that, we had labor market heterogeneity. We have two types of workers. We have low productivity workers who are also hand-to-mouth, and they are more likely to work in producing non-essential. And we have high productivity workers who are also Ricardian, who are more likely to work in the essential sectors. So these are the two new ingredients. The other ingredients of this model are quite standard. So for household, we have sticky inattention in the monkey rice style to match the hump-shaped response in consumption. We have Ricardian agents who receive profit in order to do the two agents new Keynesian model. And then we have two firms, one for each sector. And the only way they differ is how many low-income workers they hire compared to how many high-income workers they hire. But then they have sticky prices with the same price stickiness. The government is also boring. There is a central bank with a Taylor rule. and a transfer and profit rule. What do we find? Well, first, we can match our impulse response function when we do model estimation. And these are the red line that I showed you before, where inside the empirical impulse response function. Also, we are bringing an estimation for the difference in the intertemporal elasticity of substitution between essential and non-essential. And to the best of our knowledge, we are the first to do this in a macro setting, or with a macro estimation. What do we find? Well, we find that the difference in the intertemporal substitution of the non-essential and the essential, or gamma n minus gamma e, is 0.687, and this is statistically different from 0. This is, we think, a reasonable but non-trivial magnitude for this. And we can match the impulse response function. OK, now we have a model. What we do with the model is we run a counterfactual to see which of the channels we introduced is the most important and is driving our aggregate results. And we realize that we have 3 key features of this model on top of a standard textbook version of the New-Keynesian model. We have non-homothetic preferences, hand-to-mouth households, and earning inequality among workers, meaning some people work more in one sector and other people work more in the other sector. In the counterfactual, what we do is we switch all of the features off, and then we add them one by one. We add them back one by one. What do we find? 2 key results. First one is there really the interaction between non-homotheticity and earning inequality that is key to drive our amplification on both consumption and earnings, whereas each one on its own doesn't really drive much aggregate amplification. Also, what we show both in the counterfactual example but also analytically is that non-homothetic preferences on their own wouldn't drive amplification, meaning you have more intertemporal substitution for one good and then for another, but as long as you are in a representative agent, the only thing that matters for aggregate amplification is the average intertemporal substitution, and the split between the 2 goods becomes irrelevant. OK, let me show you what we do in this counterfactual with numbers. So in this table, I show you the cumulative impulse response function for consumption under our model, our estimated model, which we use as a benchmark. Our estimated model has heterogeneous agents, earning inequality, and non-homotheticity. So we take the cumulative impulse response function, and then we divide what we have in each other case by our estimated model. So our end game is to arrive to a 1 here. Where do we start from? A textbook version of the New-Keynesian model where we have homothetic preferences, representative agents, and therefore there is only one sector. What do we find there? Well, we find that aggregate amplification is much lower, only 22%. And now we're going to start from here, and then let's add one by one the various features. So the first feature is let's start from the representative agent, and let's add non-homotheticity. What do we find? No change in amplification, no change in aggregate consumption. And this is not only a feature of our numerical case, we prove that this is a case analytically. Now, what in the other hand, we start again from the homothetic representative agents, and we do what the literature on 2 agents, heterogeneous agents models has been doing, meaning let's add hand-to-mouth households. Well, in this case, we do see a fairly big jump from 22% to 35%, and this is in the order of what Patterson or Bilby have found in terms of magnitude, of like 50% more amplification going from the representative agent to the heterogeneous agents model. But clearly, this doesn't yet arrive to our full results. OK, so now let's start now from the standard 2-agent New-Keynesian model, and let's add non-homotheticity on top. Do we go somewhere? Well, we increase a little bit amplification, but almost nothing. The only reason why this increases a bit is because the Ricardian agents have a little bit higher IS because they consume mainly non-essential, but this is clearly not enough to drive to arrive to our estimated model. So what if we move from 35 then to having also earning inequality? Well, we do see something, but this is only 12 percentage points, which is, again, nowhere near what we need to arrive to our case. It's only when we add both non-homotheticity and earning inequality that we arrive to the overall amplification. And this is because there is an interaction between these two features. People cut non-essential. Why does this matter? Because it's poor households who work and produce there. And this is the result from the counterfactual simulation. And with this, I think I can conclude even a little early. What do we do in this paper? Well, we do three things. The first is creating new macro time series for producing for essential and non-essential. And with them, we identify a new channel of business cycle amplification. After a contractionary shock, non-essential consumption declines. This matters because this disproportionately affects low-income workers who mainly work in producing non-essentials. And joining these two is what is driving amplification. In theory, we bring this intuition, and we build a model which has both non-homotheticity and labor market heterogeneity in G. Now, we are at a conference at the ECB, so I guess I must say something about what is the policy implication of all of this. Well, why should we care about it? Because we think, first, this is an important driver of business cycle amplification. However, I will not leave you with a very clear-cut implication for conduct of monetary policy, because it's not clear how this direction would go. Because on one hand, having low-income workers working in non-essential would drive whether should you target their consumption or their labor earnings. And so the fact that you have non-essential and essential would differ not only across the intertemporal substitution, but across the labor market and potentially price stickiness, each might have an important effect for optimal monetary and fiscal policy. And so we don't have a clear-cut way of saying the ECB should more target essential or essential consumption or prices. Thank you.
Thank you, Michele. So Peter, you have 15 minutes for your discussion.
So let me start by thanking the organizers for having me discuss this paper. I really enjoyed reading it. It's really a kind of a full package paper with very, very interesting results. I learned a lot, and usual disclaimer applies. So just quickly the overview of the paper. So it really proposes and brings corroborating evidence for a novel business cycle amplification mechanism, and the components of this mechanism is that there is non-essential sectors. So non-essential good producing sectors are more sensitive to business cycle fluctuations than essential sectors. Also, the second component, and it also provides new evidence on this, is that workers in these new non-essential sectors earn less than those in essential sectors. Actually, I want to point out is that these are not the frontline and not frontline workers during COVID. So there, if you look at what people called essential, they were actually have had usually lower wages than otherwise. But here, the issue is not the frontline versus non-frontline. It's really the whole production process of the essentials and the non-essentials. And the third point of the paper, and this is, I would say, I will talk about it later, more an assumption, is that the workers in these non-essential sectors who have, the authors show, have lower earnings, are assumed to have higher MPCs, so they are hand to mouth. And they provide a new theoretical model, and they show that the three-way interaction of the components are necessary to actually have quantitatively meaningful amplification of the business cycles. So I really like the paper. I think this is also a paper that everyone should look at. It's really a convincing story, and it has kind of a potential to become kind of the main story of when one partitions the sector into sectors, so potentially more important than looking at durables, non-durables, manufacturing services, tradable, non-tradable, when we are looking at kind of business cycle amplification sector analysis. And it's really a kind of well executed paper. So in terms of my comments, because it's a discussion, so I kind of need to look at kind of the issues of the paper. So I'm going to start with kind of talking about relationship to relevant literature, in particular one paper. I'm going to talk about one issue which was not raised in the presentation, and it's the heterogeneity in the price and wage rigidity across sectors, issues about earnings and MPC, and then I will start with a kind of unfair question of why should we care. So so there is a related story already proposed in the literature, and that's a paper of Jaimovic, Bello, and Wong about trading down during business cycle. And there the idea is that households actually substitute to lower quality goods in recessions, and they also point out that there is heterogeneity between production of lower quality versus higher quality goods. In particular, their point is that lower quality goods use less labor. So then when the demand for lower quality goods gets higher, then there is a drop in labor demand, and that kind of feeds back and amplifies the business cycle. And the story that the authors provide is different, but I would say it's related. So this story is about within sector substitution, while the author's story is kind of across sector substitution. But we kind of know that elasticity of substitution within sector can be potentially much higher than elasticity of substitution across sectors. So it's kind of, if I want to buy a kind of milk, then going to kind of a lower quality milk is probably easier than kind of really changing my behavior in the crisis. So I think it might be important to kind of look at the relative relevance of the two mechanisms, even though they are complementary, and kind of assess how important they are, and whether kind of looking at trading down is there kind of big room to explain the kind of the across sector substitution. So the second point is kind of heterogeneity in price and wage stickiness. So the paper, the current version of the paper assumes homogeneity across sectors in price and wage stickiness, but it can potentially be important. So if you have heterogeneity, it can affect the amplification in the model. So for example, if the prices of essentials drop during downturns, then it leaves more room for non-essential spending to drop less. So that is potentially a mechanism that kind of change so not potentially not qualitatively but quantitatively the strengths of the mechanisms. And actually the paper in the appendix they provide evidence of what happens to these prices. They have they did their homework, and they actually could look at also prices in there. But actually here what you can see is that actually there is kind of big heterogeneity in the prices. So essential prices drop sizably on impact, while the non-essential kind of decline smaller. And another potential way of going about this is to look at microdata. And here what I did is that so Nakamura and Steinson in their paper they look at in the US different price change frequency measures across different sectors. So they have like around 300 sectors. I kind of tried to do it myself to put these into the essential sectors that the authors characterize. So here, and what you see is that the average frequency in the essential sector is around 40%, and this is much higher than the average of all of them, which is like 20%. So this is kind of also in line with the previous evidence that there is a substantial difference between the frequency of price changes in the two sectors and two sets of sectors. And this is not that surprising. They have used cars and gas and utilities. These are known to be sectors with frequent price adjustments. So turning to kind of earning distributions, it's really I really was amazed by the results that the authors document. So they find that earnings in the non-essential. So these are kind of the luxury sectors that we sometimes model as providing differentiated goods. Here they find that in the data these sectors have workers with lower earnings than in essential sector, and this is a figure from the paper looking at this. I think it would be important to show a bit more robustness which sectors drive these results. So I think if they could report earning distributions by major sectors and see, because in some sense it's just important to see whether the particular categorization that they ended up using is, so how much it matters in changing these results. And another, I mean, on my wish list is there a story that they have and potentially could look at where this relationship is really a consequence of some deep features of being an essential versus a non-essential sector, or this is just kind of happens to be the case. So is this something that there is some difference in the production process of producing essentials and non-essentials that make this difference kind of really kind of comes from the primitives, or this is just something that is like that, and it might be that it's different, for example, in other countries, which would be important to know. Also, that the model assumes that low productivity and low earning agents have high MPC, and I think this is a very reasonable assumption, and we know that MPC does decrease with income on average. However, we know from previous research, it's also from the authors, that income itself is not a sufficient statistic. So you have the kind of high income, high hand-to-mouth agents. So it's also kind of, I'm a bit missing the smoking gun to really show that these are kind of in the non-essential sectors, the MPC is really higher than in the essential sector. But I understand that empirically this is a hard thing to prove. Okay, so my third point is kind of I would say it's an unfair question. But the question is why should we care? I think we should care because we really are about to improve the understanding of the reality, and I really do believe that a good story it really improves the attractiveness of a theoretical framework. However, I think if our goal is to arrive to the simplest realistic model, and we are interested, for example, policy conclusions, then the question is whether a model that has kind of more simpler amplification mechanisms, like just a textbook Nuño model or Hang model, which is estimated, it can potentially capture the same business cycle co-movements than this paper. So in some sense, what I think would be very interesting to see whether are there kind of new key business cycle puzzles that this model can explain while these kind of more standard models can. So why do we kind of need to make our existing model more complicated to incorporate this particular way of amplification? What are we gaining for that? And why? Yeah. I'm saying it's unfair because it kind of comes from a particular way of looking at models. Okay, so just to conclude, I think it's a great paper with a very convincing story. It provides a structural model and also supporting evidence. And I just basically listed a couple of wish lists. I think it would be important to point out the importance relative to kind of within sector trading down. It's also important to check, especially in the model, the robustness to heterogeneity in wage and price stickiness. It would be good to kind of get closer to proving that really there is MPC difference between the sectors. And finding puzzles, important puzzles that the model solves. Thank you very much.
Thank you.
So, Michele,
okay.
You want to respond?
Yeah. Thank you for the discussion. I mean, this is great discussion. This gives us a number of things to think about. Let me maybe reply to a couple of points. Relationship to the literature and to trading down in the business cycle paper. I agree, I really like that paper, and I think what we are doing is complementary to what they are doing, because they're looking whether somebody trades down changes the quality of what they buy when there is a recession. And to me, it makes a lot of sense, and it seems that the idea is similar. I don't need sushi now. I can go and eat pasta and beans when there is a recession. And the overall idea is the same. However, we have a trade-off when we go into granularity versus universality of the consumption basket and then the implication for macro. The cost of going into very granular detail, well, the benefit of getting very granular is that you can really see whether people buy sushi versus pasta. But the cost is that you cannot then match across the whole economy, both for consumption or consumption categories, but more important, for the labor market, because in that way you lose all of the intermediate inputs, and you lose everybody who works in intermediate inputs. And so to me there is a trade-off between going very granular or being a bit coarser, but then seeing the universe of all workers and all consumption category. One thing, we actually can get our result even with the zero elasticity of substitution across the two goods, because this is what implicitly we're assuming with an additive utility function. So we do get that people cut the non-essential, not because there is a high elasticity of substitution between essential and non-essential, just because they can postpone it and they can just avoid consuming that. On heterogeneity in price and wage stickiness, I mean, I agree. I take the point, and I think it would be a natural extension of introducing wage and price stickiness in the model, because there could be relevant heterogeneity. We can match overall the path of prices, even when we are assuming that prices have the same stickiness. So for this paper, we are mainly, there's already quite a few things, so we are mainly pushing to the idea of let's keep it as simple as possible to tell a story. But I think that quantitatively would be very important to add price stickiness, and thank you for giving us the estimate. On which sector should drive the result? It's in the to-do list. We want to see exactly among all of the final goods sector whether there's many poorer or richer people who work in each one of the sectors, and we would like to do that. In terms of deep relationship, I think there probably is. I think we should ask to the structural transformation literature, what is the reason why are poorer households more likely to work working in non-essential than richer households? So for us, what we want to do is we say, let's take this as given, and then let's see what is the business cycle amplification. I don't have a good reason why that might be, there could be potential different reasons might be the case, and I think that would be something interesting in the structural transformation literature to see why they might arise. However, I think that our conclusion are, for whatever reason we are having, now we see that these poor people who work in non-essential, and when they lose their job, they cut their consumption. So we think that our channel exists independent of what is the deep structural reason. But I agree that would be an interesting paper to write. In terms of MPC, it's true we don't show here directly that poorer households have higher MPC. We bring this as some agreement in the literature, because where it's true that there are some richer households who have high MPC, like the wealthy and to mouth, I think even the work of Christina Patterson broadly shows that poorer households, when we try to estimate their MPC, Or in the workshop, another paper that I wrote with Paolo, we do see that poorer households generally tend to have a higher MPC than richer households when we try to estimate, or the Iappelli-Pistaferi type of evidence. That is why here we are not bringing new direct evidence for this, and we are taking this as given. Why should we care? I think it's always important to ask. And why should we care? For now, is understanding is true. It's only understanding a little bit better the transmission of business cycle. But this is what we don't have yet, which is the optimal policy part. Why should we care? Because for doing targeted fiscal policy and potentially for monetary policy to think differently about different type of price indices, we really need to go the extra step. Why I don't think we can make the conclusion now? Because the labor market and the consumption side point to two different results. On one hand, maybe monetary policy should care more about the inflation of non-essential, because it's where high MPC, low-income people work, and so if they stabilize consumption and inflation of non-essential, we see less fluctuation there. The cost of that is that you do this by subsidizing the consumption of the rich, and so then the distributional consequences would go in the opposite direction. This is why we think this is not a straightforward question that we can answer without doing optimal policy seriously, but I think that is the next step that we should take into account. Thank you.
Okay, are there any, of course? Ricardo?
Given this difference between the essential and non-essential sectors, and especially the striking fact that you have different kinds of workers, you went on the direction of income differences, and a little like Peter said, then made the jump to MPCs. But that isn't, I worry whether you're a hostage of the recent literature and your own work on Hank Malls and others. I would think that, for instance, probably a very big difference here is gender. We know that males and females work in different industries. I would expect that what you label the essentials and non-essentials is going to have a very large composition in terms of the gender of who the workers are. I think you're going to find bigger even than your earnings. And we know that different genders have very different elasticities of labor supply. So they may be as promising or more to understand essentials and non-essentials in terms of whether the labor supply choices and employment dynamics of women versus men in terms of propaganda business cycle and the role of essentials, as opposed to an MPC aggregate demand channel. So I would suggest you look at some of those. But it's not obvious to me that if I do the essentials and non-essentials, I want to look at poor versus rich people, as opposed to women versus men, who I think will distinguish even more across these sectors.
Gonzalo, here.
Thank you. So Gonzalo Paz Pardo, ECB. So I wanted to ask about the relationship of these non-essentials with the non-durable difference. Because, I mean, I guess you will tell me that you find more striking difference between essentials and non-essentials, but it's still true that non-durables have very particular demand dynamics, because there's this coupling between consumption and expenditure. So if I'm in a recession, maybe I go out less to eat, but then I go a bit more. But thinking about the durable, I just don't buy a car, and suddenly the year after, everyone's buying a car together. And that might generate like different dynamics in demand. So basically the EIS is a bit different. So how do they relate? Thanks.
Diego?
Thanks. I think it's very interesting. I would like to push on this fact that you mentioned about the non-essentials being intensive in poor workers and skilled workers. In the paper that you cite of us about income-driven labor market polarization, we show that when you separate between three types of workers, low skill, medium, and high, actually there is a U-shaped relation between income elasticity of demand of the sectors that you work and the skill of the workers. Okay, let me just finish. So accommodation and restaurants is very income elastic. Okay, the elasticity is 1.3. Manufacturing and agriculture is less income elastic, and then you have high skill sectors like like professional services and health and education that are very income elastic. So I think that if you allow, and we show that, if you allow for more work, for a thinner classification of workers, then you are going to have more effects on the medium skill than the others. Second comment I have is that the way you model the demands for different sectors, it's a bit strange. Typically, in the structural transformation literature, we tend to think of utility across periods. That's the one that it enters into the Euler equation, and then you have an intratemporal problem that is the one that defines how. Instead, you have a different Euler equation for each sector, and I'm not sure what to make of that. There are a few things that we tend to like about the way we write demand systems in the structural transformation literature. In particular, income effects should last for a long time. They shouldn't disappear. But if that's the case, then you have a challenge, which is that the system is not going to be stationary. Okay, and so I'm really not sure with this structure you have. I'm not sure where you fit into that quadrant. So it's certainly not conventional. Let me say that.
Thank you. There's a question here.
Yeah, Janko Heineken, University of Bonn. Piggybacking a bit on the discussion and the previous question, it would be really nice to see the breakdown of the overlap of non-essential versus essential with all the other categories that we've seen, just as a summary statistic. Because, if I think about the investment channel, right, if I think about manufacturing versus services, I wonder how much this is competing with your wage channel, in a sense. And I think you have all the tools to check essential and non-essential investment responses, and then horse races in your, maybe you already did it, horse races in your model to think about what is really, is your channel driving it, is more an investment channel through non-essentials driving it, yeah.
It's in the slide appendix, I don't know.
Okay, I'll take a look at the paper then.
Yeah.
So I don't see any other questions, so can you please respond?
Okay, thanks for all of the questions. Ricardo, gender, yeah, point taken. I think it would be very interesting to look at gender. I think on the CPS, we might have it, but I am not sure. Our data limitation is what we can get on the labor market information. And it would be very interesting to see if we had data, which I don't think is there, whether we have married women versus unmarried women, married men versus unmarried men, because there is a potential very strong difference in terms of labor supply elasticity. But I think we take a point and we can check. I think it would be super interesting to see that. On Gonzalo, on the non-essential versus durable, non-durable, also here we think it's very important to discuss how the non-essential, essential split is different from the durable, non-durable, because it's true that people cut their durable consumption, and durables are more likely to be non-essential. So this is a potential concern that what we are actually capturing is not essential and essential, but is durable, non-durable. So we answer this in two ways. First, we look at only within non-durables, what do we see? And why do we think it's important? Because durables are 15% of the consumption bundle, and non-durables are 85%, and essential, non-essential is 50-50. And even when we are looking only within non-durable, we see much stronger responses of non-durable, non-essential compared to non-durable essential. Also, and we think this is even more striking, is we do not see the same labor market relationship. It is true that non-durable, non-essential workers are poorer than everybody else, servers. It is not true that durable, non-essential workers are poorer than everybody else. They are pretty much the same. So the labor market channel, we don't think is present with durable and non-durable. And with Janko, we can maybe discuss later. We tried goods versus services, tradable, non-tradable. So it's and we see the split wouldn't be able to explain. At least we don't think that it would be able to explain the durable, the essential, non-essential split. And on Diego, okay. So there is two comments. The first, let me take the second one, the one for the demand function that we are using. Point taken. This would not be a good demand function to do structural transformation because it doesn't, the sum of CRA wouldn't have stationarity. As people become richer, they would converge to no essential and only non-essential consumption. So we couldn't take this type of utility function to a structural transformation approach exactly because of that. However, we are looking at around that linearized equilibrium where around the steady state for a business cycle, we think that this is a reasonable approximation or a reasonable utility function where we do not have any trend growth. This result of the relation between essential and non-essential income elasticity and intertemporal substitution would hold for any separately additive utility function, which we think that this is broader than the simple sum of CRRA, which just shows the intertemporal elasticity substitution in one parameter. But actually, it's on the to-do list to use your preferences to see how the story would go if. That's been in our to-do list to see how this works. In terms of the non-essential and essential, who is the poorer worker and the richer worker? So what we tried is we are looking at across all percentiles. So we are not fitting a linear relationship between more essential good, more non-essential good, and whether you are poorer or richer. We are looking across all essential good and across all of the percentiles among the poorest percentile, the next poorest percentile, the proportion of people who are working essential and non-essential. And we do see it looks linear, but we are not imposing any linearity in our analysis, where we do see that on average, poorer houses are more likely to work in non-essential than essential. But
Okay, so we've made it to the end of the inaugural conference of the Challenges for Monetary Policy Transmission in a Changing World Research Network, for short, the ChaMP Research Network. I'm sure that we can all agree that it was a great success. We brought together researchers from academia, from central banks, and of course, from our network to address the complexities and challenges of monetary policy transmission. I'm sure that both the academic sessions and also the poster sessions, I hope you had the chance and the time to look at our poster sessions, and of course the policy panel gave us a lot to think and to talk about, and will be a big input, an important input for our network going forward. I was part of the very first Eurosystem-wide research network back in the day. That was the beginning, the early days of the monetary union, the Eurosystem, and at that time, the challenges we faced looked huge without knowing what was going to happen during the last 22 years. And when I think about how we did the network at that time, we had two work streams. One was looking at the interest rate pass-through using individual bank data, and the other one was looking at the bank lending channel using bank and firm level data. ANA credit, B2B, were not on our vocabulary. And of course, a lot of the transmission channels that we know exist right now were not really under our radar at that time. So we have learned a lot new channels. Today I learned about two new channels. I knew that there was a deposit beta channel, but now we know that there's a deposit franchise channel. I knew that there was a risk-taking channel. Now we know that there was a climate risk-taking channel. And I must also say, when we did the MTN, the legendary MTN, we would never think that climate topics would be something we were allowed to think about. So we have come a long way from those early days, and I think that the conference today was a big and first step towards a better understanding of the challenges of transmission mechanisms, and this is just the start of our network, so imagine what is going to happen in the next year or 2 years with all those researchers working together. Looking ahead, as you can see in the slide, we have in the network a very busy schedule for our members. We have a lot of training sessions and also workshops where we can discuss research at early stages. And of course, at later stages, we will present the research of the network in academic sessions, in academic conferences. And of course, we will disseminate our results in working papers and hopefully also in journal articles. So last but not least, on behalf of the ChaMP board, who is partly here still, I would like to thank all the participants, all the speakers, discussants, the organizers, the people in the back, the trainees that's made possible that it was a lively discussion, and of course our scientific committee for the hard work and the contributions that made this conference a real success. Thanks and goodbye. Have a